Good morning. It is 9 a.m. on Wednesday, March 2nd. This is Yahoo Finance Live. I'm Julie Hyman alongside Brian Sazi. Let's take a look at what's going on with the futures here this morning. We've got little change at the moment, slight upside for the major averages. The Dow right now indicating a gain of about 0.4% at the moment. S&P and Nasdaq futures also indicating a higher gain. This, by the way, after we got an ADP report that showed an addition of 475,000 jobs added to U.S. business payrolls last month. That's 100,000 more than estimated. It's ahead of the jobs report on Friday, although remember, those two numbers don't usually match up exactly, but maybe trajectory-wise, there is a positive indication, perhaps, for Friday's number. Also, we have to look at oil prices. That's really the story of the morning. Oil prices have been spiking here. Brent crude now above $112 a barrel. Crude oil futures almost 111. Both of them off their highs of the session, by the way. They were even higher earlier in the day. And they're rising even as OPEC Plus agrees to raise production by 400,000 barrels a day starting in April. That was an increase that was largely planned and expected. Russian oil markets are nearly frozen. Otherwise, SoFi gives an upbeat outlook. CEO Anthony Noto is going to join us with how SoFi will perform in the face of rising rates. You can see the shares are up by 16%. And speaking of rising rates, those higher rates are indeed coming. Federal Reserve Chair Jerome Powell said the rise is coming at the Fed's meeting in 2 weeks. That's according to prepared remarks that he released in advance of his testimony before the House Financial Services Committee. That testimony begins at 10 a.m. and we will have it live here on Yahoo Finance. In the meantime, though, do want to bring you up to date on the latest coming out of Ukraine and Russia this morning. The Russian military does continue its push to capture key Ukrainian cities. Kharkiv, whose central government building was hit by a rocket strike yesterday, came under heavy bombardment overnight, but it does remain under Ukrainian control. Kherson, a port city on the Black Sea, is surrounded by Russian forces, but the municipal government there is still in place and local forces continue to fight. And in Kyiv, the TV tower was hit yesterday, killing 5 people and injuring 5 others, and also causing damage to a nearby Holocaust memorial. Russia and Ukraine are set to hold another round of talks today. And this was a big topic of conversation in President Joe Biden's State of the Union address last night. He had some tough words for Vladimir Putin of Russia.
Putin is now isolated from the world more than he has ever been. Together, along with our allies, we are right now enforcing powerful economic sanctions. We're cutting off Russia's largest banks from the international financial system, preventing Russia's central bank from defending the Russian ruble, making Putin's $630 billion war fund worthless. We're choking Russia's access. To technology. For that purpose, we have mobilized American ground forces, air squadrons, ship deployments to protect NATO countries. And I'm taking robust action to make sure the pain of our sanctions is targeted at Russian economy.
So the president talking tough on Russia there, making some other promises regarding inflation and other parts of the economy in his speech last night. Brian and I were watching all of this carefully. Also watching carefully, of course, was our Rick Newman, who covers business and politics for us. And Rick, I want to start with the commentary around Russia. And, you know, it was interesting because it does look like, first of all, there was sort of bipartisan support for what the president was saying on that front. But can he fulfill these promises of stopping Putin?
Well, those clips you showed, he was basically just reiterating what the United States and many allies in Europe and elsewhere have already done. And then he added a little bit of a rhetorical flourish by saying, we are coming for your ill-begotten gains. And then with regard to Putin, he said he has no idea what is coming. So he kind of made this personal about Putin, and he was talking about going after personal assets, financial assets, other types of assets, perhaps properties, boats, things like that, that Putin and his oligarch buddies from Russia have around the world. And it's not clear how he's going to do that or what exactly he means by that. So yes, there was unity on this whole question of support for Ukraine, but now we enter a long slog, or probably a long slog, and we are not winning this war yet. The West is not winning this war, causing some pain for Russia, but Russia is still encircling those Ukrainian cities.
Rick, did the president do enough, based on what we heard last night, just to quiet or just cool down some of the concerns about people in this country with rising gas prices? Look, we started the day with Brent crude over $110 a barrel, in large part because of the situation between Russia and Ukraine. Food inflation continues. We're nearing interest rate hikes. There's a lot of concerns on the minds of voters right now.
No, he did not do enough. I mean, just saying he understands that inflation is a problem, that's a baby step. I mean, that's the first thing. That's essential, but it's not enough. And he said, basically, I have a plan to do something about inflation, but he did not articulate the plan. And frankly, some of the logic is spacious, past the Biden legislative plan, and that will somehow reduce inflation. Child care subsidies are going to reduce inflation. I think that Biden put out a marker there that it's going to be tough for him to meet, because it's just not clear what the Biden administration can do about inflation. I mean, especially since we're seeing gas prices going up, not down, because of the sanctions on Russia, and just about mainly about concerns that there could be future disruptions to energy supplies. So he said he's going to do something about these two things. He's going to go after Putin, and he's going to do something about inflation. And I think Biden has made some pledges that are going to be difficult to keep in the next months or weeks.
Another interesting sort of tone in the speech, if you will, Rick, is that the president, who had been sort of in his presidency thus far, leaning perhaps more towards the progressive wing of his party, he seemed to bring it back more center. And maybe related to that, there is sort of a rebranding that seems to be going on that I know you keyed in on, of Build Back Better, which did he even say the words Build Back Better? Yeah.
No, he did not. No, and the White House actually hinted ahead of time in some discussions with reporters that maybe we've heard the last of Build Back Better. So he rebranded it to Build a Better America. I thought that was actually a pretty weak effort. Most of this legislation now seems like it has no chance to pass. And I think you're right, Julie, about trying to move a little bit away from some of these progressive themes. But I thought Biden was, he was trying to have it both ways, which is what all presidents do in the State of the Union. So I think the main thing he said to get away from that progressive agenda is, we do not need to defund the police. We need to fund the police and train with training and with other things. So clearly, he's thinking about the midterm elections and some of the allegations that Republicans are going to use to try to gain seats. But then he also said we need to pass the $15 minimum wage. That died early last year, and it's not going anywhere. And then he ticked off the other social welfare things he wants to get done. Progressive ideas also seemingly dead for this year. So he was paying lip service to both sides, and we'll see if, he's able to please everybody, which is basically what he was trying to do there.
Yeah, we'll see if it makes any difference in the midterms, which are still a good way away. Thanks so much, Rick. Appreciate your commentary and perspective on the president's speech last night. Let's refocus now on what's going on in Russia and the implications for the rest of the globe, and implications from an investment perspective. Mark Mobius joins us now. Mobius Capital Partners founding partner, and I think fair to say a legend in the emerging markets space. Mark, thank you so much for being here. I want to start squarely with Russia here, given the freezing of assets that we are seeing from an emerging market investment perspective. I mean, how long before you would even be able to, leave aside the issue of want to, be able to invest in Russia and take a look at Russia as a potential investable area?
It will be impossible for a long time. One of the things that happens when you have such things as custodial banks who say we're not going to do any business with Russia, when you have the payment systems closing down, when and if they want to open them again, it takes time. This is a big bureaucratic process. So I don't see anybody who wants to be investing in Russian equities or debt not being able to do so for, I would say, another year. I would be surprised if it's possible. And of course, we know that this is an ongoing situation. the sanctions will probably get worse. So I think we're going to see a long, drawn-out situation. In fact, I call it Russia's Afghanistan. I think Russia is going to be dragged into a very, very long-term situation, which is not going to be good for Russia, but will be good for Europe because it's now putting Europe together. And it's good for a lot of the other markets around the world. The US market will probably be attractive. And many of the emerging markets have not been impacted, particularly in Asia. Asian markets are moving sideways with the exception of China, which is already down. But generally speaking, you're seeing Brazil actually going up. So it's a very mixed picture. There'll be winners and losers, let's put it that way.
But Mark, could we start to see some of those other emerging markets turn south? We've seen a pretty sizable move higher in oil prices. Inflation in emerging markets remains very high in large part because what's happening in oil markets. Are there other areas overseas that are uninvestable in your view?
Well, the good news regarding oil prices is that these emerging markets have lots of alternatives now. And when we look at $110 a barrel, solar, wind, and many other alternatives come into play in a big way. So there are lots of alternatives that we have now that we didn't have 10, 15, 20 years ago. And you must remember also, China and India depend on coal for most of their power. 70, 80% of their power comes from coal. So higher oil price is not going to have that much of an impact. Of course, inflation generally is moving up, not because only of oil or shortages of oil, but because of the incredible money supply that's been coming into the fore in the financial markets around the world. You must remember, money supply in America last year was up 35%. That's the kind of number that brings inflation up in big ways, big time. So the CPI inflation number really doesn't reflect the real rise in prices. Good news is that technology is pushing prices down at the same time.
Even though that might take a little bit longer than people might like in the short term. I do want to ask another political question with regard to emerging markets. As we know, China has refused to participate in sanctions against Russia. India appears to kind of be wanting to sit it out. Does it matter from an investing perspective how those countries are aligning themselves politically, if not with Russia, certainly not against it, as we are seeing the Western world?
Not really. I mean, when we look at these countries, let's say India or China or any of these countries that take a neutral stance, it's really something that's specific to that country. And after all, at the end of the day, we're investing in companies, not countries. So we focus on what a company is doing, how they're surviving. And very often a neutral stance on the part of some of these countries is probably the only practical thing for them to do. For example, India depends on Russia for a lot of its military equipment. Now, the question is, where does India get spare parts if their markets are closed and you cannot get things out of Russia? So this is a challenge for many of these countries who have depended upon Russia for their supplies, not only oil, but many other things.
And I'm curious about China in particular, because before this latest focus shifted to Russia, we were seeing, of course, a lot of regulatory pressure in China that had caused a steep sell-off, mostly in tech stocks, but really broader than that. And then there was sort of a renewed regulatory push more recently that then sent another wave of selling through the Chinese market. How are you thinking about China right now, given that regulatory regime that we've seen?
Generally speaking, I favored the regulatory changes in China because corporate governance is improving as a result of that. And let's face it, you had some of these big companies like Yahoo and like Alibaba rather, and Tencent, where they had a very big hold on the markets and not allowing the small and medium-sized companies to survive. So I think the regulatory crackdown on some of these big boys is probably a good idea. And will make the market better going forward. But in the short term, what it does, of course, is push the index down. You must remember the weighting of companies like Alibaba and 10 cents is very big in the index. So when the index goes down, then people tend to say, oh God, China's in bad shape. But if you look further down the line to the medium and small sized companies, many of them are doing very, very well. So generally speaking, I think this is probably going to end in this year, and the market will probably turn around.
Mark, you mentioned, I want to go back to what you said on Russia, that Russia may not be investable for another year. Why not go bigger here? Isn't Russia not investable until Vladimir Putin is no longer in power, whenever that might be?
That's a very good point. Let's put it this way. If Putin left office tomorrow and the leadership in Russia said we're pulling out of Ukraine and we're going to try to make friends with Europe, things can change very rapidly. But as I said, the bureaucracy does not move very fast, and it would take months to restore all these payment systems, all the rest of it. So I think, but that's a big, big wish. I mean, for Putin to be out of the picture and for Russia to make amends, I don't see that happening anytime soon. If it did, then of course we're talking maybe about a half year before we get back into Russia.
So Mark, just quickly to be clear, you don't see the prospects for regime change anytime soon in Russia?
No, I don't. I don't see it at this stage. It will take a longer period of defeat, or at least stalemate, in Ukraine to make that happen, I think.
Mark, thank you so much for your perspective today. Good to see you. Mark Mobius, Mobius Capital Partners, founding partner. Appreciate your time this morning. Before we go to break, just want to get another check on what's going on in the oil markets, where we are seeing quite a bit of drama this morning, and not just in the oil markets, by the way, but across the energy complex. Look at those heating oil prices up 8% as well. Crude and Brent both pushing above $110 a barrel. Just remarkable moves that we have been seeing. Coming up next, we're going to check in with Contour Brands CEO Scott Baxter. That's after the company reported revenue growth of nearly 20% last year. We'll be talking denim when we come back.
World is coming out of its COVID slumber, and that's igniting demand for everything from jeans to handbags to even dress shoes. Let's zero in on the demand for jeans with Contour Brand CEO Scott Baxter, who's coming off a better than expected earnings report this week. Scott, always nice to get some time with you. Look, there's a lot going on in the world. There's a lot coming at U.S. shoppers. Inflation, high gas prices, the situation in Russia and Ukraine. Do you see a more cautious U.S. consumer headed into the spring?
No, we think the consumer is in really good shape. Certainly here in North America, we think one of the things that's happening is, you just mentioned it early, people coming out of the pandemic slumber. We think people are getting back into the market and they're purchasing for that after being home for a couple of years. So we think the U.S. consumer is fairly resilient right now.
And what about the consumer around the globe, Scott? You guys don't just sell in the United States. And so I'm curious what markets look like across the world.
You know, we talked a little bit in our earnings call about some of the countries in Europe reopening. They've had it particularly hard where they've really had some lockdowns in Europe. So we find it encouraging that some of those countries are reopening. And then on our report yesterday, we talked a little bit about our China business being fairly good and fairly resilient also during this time. So, you know, right now, pretty good across the globe. We just need to go ahead and make sure that this pandemic, this reopening, kind of stays the course, and hopefully it does for everybody.
Scott, do you have any exposures to Russia or Ukraine? I mean, do you sell to third-party distributors in there? Do you manufacturing anything in those countries?
We do not manufacture anything in those countries, and we do not have any direct operations in those countries. We do have a distributor that utilizes, or that we utilize for the entire region in that area of the world. When we spun off 3.5 years ago, we made the decision not to have a direct operation there. So that was a long time ago decision.
And I want to ask you as well about the president's commentary around last night, because you guys, as a manufacturer, there was a lot of talk about manufacturing in the State of the Union speech, and in particular, the state of manufacturing in the United States. So first, I want to play what the president said last night.
Okay.
To compete for the jobs of the future, we also need a level playing field with China and other competitors. That's why it's so important to pass the Bipartisan Innovation Act sitting in Congress that will make record investments in emerging technologies and American manufacturing. There's something happening in America. Just look around and you'll see an amazing story. The rebirth of pride that comes from stamping products made in America. The revitalization of American manufacturing. Companies are choosing to build new factories here, when just a few years ago they would have gone overseas.
So I'm curious if you guys, how much of your product is made in the United States, and sort of how you think about the economics of it at this point.
Well, one of the things that we did, and we haven't had a chance when I've talked to the two of you to talk about this, but when we spun off, we made the decision to own a piece of our manufacturing operation. And so we actually own plants in Mexico and Honduras. About approximately 40% of our production comes from that area. And then a lot of our parts and components makers are here in North America also. So we're in this hemisphere already. We're one of the few apparel companies that is positioned like that. And we think it uniquely helps us from a strategy standpoint because we're very quick to market. And so we have a much less lead time, and it helps from an innovation standpoint. But I was very encouraged by what the president said last night.
What would convince you to bring manufacturing to the United States specifically? Is it currently for your apparel manufacturing just too expensive to make things in the U.S.?
Well, I think it's a lot of things right now. I mean, very specifically, we already have operations that are running very smoothly and that work really cohesively with our parts and components manufacturers that we have, the partners that we have, in North America and around the globe. But certainly, we always look at everything, and we'll continue to always look at everything, and we want to evolve with how the world is evolving. But right now, things are running very smoothly for us in this North American region.
Scott, there seems to be a budding trend, or strengthening trend, I should say, for the Western look, that Western style. What do you think is driving that, and where do you see that playing in your business?
Well, I think it's a couple of things. I think that during the pandemic, people really wanted to be outside and they wanted to be part of something. And I think that whole Western, feel and the whole Western look and, the feeling of being outside and being active and being part of a culture, I think it's been really significant. And then, of course, there have been some shows like Yellowstone that have been extremely popular. And I think that's helped to drive demand too. And we've had a big collaboration with Yellowstone, on that and have a partnership with them. And it's also hitting, pretty strongly in female too. So I think it's carrying to both genders, which is really important. But it has been really a huge phenomenon, and we have benefited from it. And we think it's here to stay. So we're pretty excited about this Western thing that's happening around the country.
I just can't pull off the cowboy boots, Scott. I can't do it, but I appreciate what you and the Contour team are doing in the Western look. Contour Brand CEO Scott Baxter, good to see you. We'll talk to you soon. All right, staying on retail, straight ahead, Nordstrom shares are skyrocketing after a comeback quarter for the company. We'll be right back with more on that quarter and earnings out of the main meme stock name, AMC. Stick around.
A little under 2 minutes until the opening bell on this Wednesday morning, and we are watching futures that are strengthening. It's interesting because yesterday we had oil spiking and stocks took a hit. And today, even though oil is still spiking, Brian Sozzi, stocks are performing better. So it's interesting here. You just wonder, is the market seeing it as temporary? Or are they looking on the bright side for energy stocks? I don't know what's going on.
It's the action. It really is bewildering to see the rise, the spike. It is a spike. It's a spike at this point in oil prices. It feeds through everything. Feeds through if you're an electric vehicle maker. It feeds into the manufacturing plants at food companies. It means likely even higher inflation on shoppers around the world in the first quarter of this year, and the market can care less. I think it's going to take another, a major warning from another large multinational company on profits in the coming weeks as companies present at the investment banks. Inflation is a problem, and you better pay attention to it.
I mean, at the same time, this spike is clearly something that is being caused by temporary factors, that being Russia's invasion of Ukraine, the sanctions against it, and the choking off of Russian oil to some extent flowing to the rest of the world, but not to every extent, right? Because Europe is still buying Russian energy products, for example. But it's got to be temporary. It's just a question of how temporary it is. And as we know, you and I have been at this a while, when things are temporary, the market tends to price it in at some point. And there we have the opening bell this morning, as we do expect to see a higher open for the three major averages after a lower close yesterday. So again, I'll be watching energy stocks very closely today. I'll also be watching banking stocks very closely today. They took quite a hit yesterday. And we are seeing yields come up a little bit today. Jay Powell, of course, Federal Reserve Chair, is going to be speaking before the House Financial Services Committee in his prepared testimony. He basically confirmed that, yes, there is going to be an interest rate increase at the Fed's meeting in 2 weeks. So that could potentially be a little bit more supportive of banks today. But we want to get to some movers that we are watching today as you see those yields climb pretty significantly today. Want to get to some individual movers. Ford is where we begin. Now, the company is both doing and not doing what has been reported on as of late. That is, it is separating its electric vehicle business, but not from the company, just sort of in the management structure of Ford, if I'm understanding all of this correctly, Brian Sazi, right?
There's a lot going on here, Julie, and I run through the numbers in a written story on our homepage right now. But still, some takeaways here. First, Ford is just doing this internally. Ford CEO Jim Farley said on a media call this morning he is not spinning off this electric vehicle operation as had been rumored. But internally, they will have a business called Ford Blue that will be making gas-powered cars. And then also Ford Model E, that will be focused on making electric vehicle operations for the company. Now, interesting to hear within their guidance, they're looking to shave out $3 billion in structural costs from that legacy gas car powered making business, which will theoretically be applied to making more electric vehicles. So there's a lot of moving parts near. The street likes it because Ford signaled the likelihood of higher profit margins in coming years. I asked Farley if today will go down. There was a media call. I asked him about if today marks the slow wind down of making gas-powered cars in this country. He didn't come and say, yes, today's that big of a day. But he did say likely volumes will decline over time as people go out there and buy more electric vehicles. But you're still likely to see good, strong volumes in Super Duty trucks and other large type vehicles that haul stuff around. And also, too, interesting, Julie, what he told me on the dealership network here, I think Farley wants to move to some form of model with dealers holding less inventory on their dealer lots. You order a car online and you go pick it up, not to the extent that Tesla has, where you walk into their store in a mall and see one car. There will still be cars on the lot, but maybe not as much as we have all grown up seeing for many, many years.
I mean, at the same time, the leap in production of electric vehicles that the company is now targeting is pretty remarkable. 2024, their target was already at 600,000 electric vehicles. Now, by 2026, they expect that number to go to 2 million electric vehicles. So,
with a $50 billion investment. Ford, they also said, Julie, looking to invest $50 billion. Farley added that he does not see the need to raise capital. Interesting comments there.
Yes, all of it very interesting. And by the way, it got a shout out from the president in his speech last night around all of those initiatives. Let's move on to another mover that we are watching, and that is Nordstrom. Now, Nordstrom shares are leaping. I mean, leaping up by 30% right now. I should mention, I noticed this morning, the stock is pretty heavily shorted. About 22% of its float is sold short. So you could be seeing a short squeeze effect in these shares. I think it's pretty safe to say that's at least part of the phenomenon and why it is such a big increase. But to be fair, the numbers the company put up were pretty darn good. Sales were up 23% in its fiscal fourth quarter. That's better than estimated. Earnings per share better than estimated. And the company is now saying revenue growth this year will be 5 to 7%, which is also better than estimated. Nordstrom Rack, by the way, part of the company's strength here. That's, of course, its off-price chain. And so all of this contributing to the gain that we're seeing in the shares today, Saz.
Yeah, I want to be perfectly clear here, Julie. This quarter from Nordstrom came completely, absolutely, utterly out of nowhere. This is a company that's been struggling for more than a year to get the right inventory in store, get its pricing right, get its expense structure under control here. And I think the street was very much shocked here to see sales up in the core Nordstrom banner and also the Rack brand. And of course, that is likely scaring out the shorts. As you mentioned, Julie, stock up over 30%. I liked on the earnings call, it sounded like a different company, Julie. First, they're getting the inventory correct. Seems like they have found religion on expenses, cutting expenses down, and just running a better operation. Now, there is one interesting point. Large part of their quarter was driven by sales in the South. Northern stores underperformed their southern stores by 7 percentage points. So there's a big opportunity for Nordstrom to drive some better sales in the North. I think it's just going to take more international shoppers to come here, get into these stores, and buy.
Interesting. Finally, Saz, are you planning to see the Batman this weekend?
I did not know it was coming out this weekend, Julie. I did not know, but I'm open to going to an AMC and seeing it.
Well, AMC would like you to see it, but they're going to charge you a little more than they will for other movies. AMC, as part of its earnings call, said it's going to introduce dynamic pricing. Adam Aron, the CEO on the call, talking about that it'll cost you, for example, in some cities, it would be like maybe $1.50 more to see the Batman than it would to see other releases that are out. So interesting thing here, Adam Aron saying they do this already in some European markets, which was interesting. The company also came out with its numbers, by the way, and reported a smaller loss than estimated and revenue coming in a little bit better than estimated here. Spider-Man No Way Home helping out numbers at the chain. And of course, as we know, AMC, Adam Aron, big fan, big meme stock, and people still fans of the company. So, this is also a company that's relatively, I guess they've squeezed a decent number of the shorts out of the thing, but it's still a darling of retail investors, Saz.
Oh, I'm just loving these AMC earnings calls. Chief Ape Officer Adam Aron just getting it done again. Here's what he said, quote, on the call, there is so much conventional wisdom floating around that the movie theaters cannot coexist and cannot draw or thrive in a world of streaming. What a load of cow dung. So there you have the CEO of Adam Aron just getting it done again on the earnings call. I really feel bad, though, Julie, for teenagers these days. It is really expensive to go on a date to a movie theater. How are they affording to go to a movie these days? They just can't. Just can't do it.
Do teenagers still go on dates, or do they just like meet in the metaverse or something? I don't know. I don't know that it.
I'm completely not tied into the teen community for many obvious reasons, but still, I mean, it's $70. What, to go to a movie, get some popcorn, go on a date? Why not just, I don't know, stay home?
I think that's probably what a lot of people are doing. I don't know. By the way, one note I should mention here, I stand corrected. The stock is still relatively heavily shorted. About 20% of its float is still sold short. And by the way, the shares are down a little bit as we were just checking them. Coming up next, we are going to go down to the floor of the New York Stock Exchange, check in with our Jared Blickery for everything going on in today's session. We'll have that in just a moment. Before we go to break, let's take a look at some of the stocks that are leading the Dow higher today. Intel, of course, the CEO, Pat Gelsinger, getting a shout out during the State of the Union. He was there in attendance. That's leading the Dow up today.
Let's head down to the New York Stock Exchange floor and check in with our very own Jared Blickery. Jared.
Yeah, we're seeing a little bit of a bounce back today. If you look at the Wi-Fi Interactive, nice to see the major indices in the green, but really been in a holding pattern since that big breakout we had only last week. Here's a 12-day chart, and you can see just kind of flagging here. We'll have to see what comes of this, but until the S&P 500 clears 4,400, that is just the very first step it has to get to in order to right itself. Now, this is the bond market. I'm going to pull up the 10-year T-note yield, which is bouncing up today. It's up 8 basis points, but you can see over the last 2 days, it's just lost an incredible amount of territory there. And not surprisingly, the value in cyclical trade is bumping today, but I do want to check out the VIX because the VIX is maintaining above 30, and that's pretty significant here. More significant, I think, is if you look at the move. Now, this is basically the VIX, or the fear index of the bond market, and you can see it is spiking up. This is a 3-month chart, and is just from the lower left and to the upper right here. You take a look at what's happened over the last 5 days. That is a huge movement in the MOVE index. So let's take a look at our sector action. We can see kind of a mixed board. Actually, everything's in the green now. We got energy up 2%, financials up 1%. As I said, value and cyclical leading the way here. Consumer discretionary finding some love. But along the lines of everything pretty much reversing what it did yesterday, energy is not that case. In fact, futures are just climbing higher, if not screaming higher. I know we've been taking a lot of looks at crude oil here, but WTI above 100, reaching 110 is simply incredible here. You have to wonder, when can it end? And by the way, I just read a report, 80 million barrels of oil have been released by various governments around the world over the last year, and yet the price has doubled. I've seen this. In fact, I haven't seen this since 2007, but when commodities get going, you start worrying about things like daily futures, limits on futures moves and things like that, instead of the underlying fundamentals. We're seeing the dollar heading higher based on not only haven concerns, but on interest rate differentials. And at the same time, you see commodities moving higher. We are in the midst of a super cycle right here, and also a smaller bull market in commodities that's not going to be reversed until the Fed pops that bubble. That's going to take, I would say, at least a year, and the Fed's going to have to be aggressive about it. So we'll see how all of this ends, and we'll get a peek at that in a couple weeks when Chair Powell takes the podium.
Hey, Jared, that scooter you ride to the office, that's electric, right? I mean, I hope it's not gas.
No, it cost me, I think, 50 cents to charge it, and it goes about 20 miles. So I couldn't be happier with it. It's just a little bit cold right now.
You're a true man of wisdom. Jared Blickery, thanks so much. All right, take a look at the trending tickers right now on the Yahoo Finance platform. You have SoFi just dominating that list here, followed in close second by Ford. SoFi is on the list after the company's upbeat guidance last night. We're live with SoFi CEO Anthony Noto on the other side of the break.
Well, the street is liking the outlook from SoFi. The company posted better than expected earnings, or a smaller loss than had been estimated. And SoFi now says it could hit $180 million in adjusted operating profits this year. Last year, SoFi racked up $30 million in adjusted operating profits. Let's talk more about the quarter and what lies ahead. SoFi CEO Anthony Noto is joining us now. Anthony, good morning. It's good to see you. So I want to start, I just want to jump right into it. When it comes to interest rate increases, because we're going to be hearing from Jay Powell in, less than 15 minutes now before the House Financial Services Committee is going to talk about those rising rates. This is something you guys have modeled in. And you talked on the call about some areas of the business that don't do as well in a rising rate environment, other areas of the business that do well. What is that mix going to look like this year? What are you guys modeling out?
Yeah, the great thing about our business is that we are a one-stop shop for financial services products, and that's allowed us to drive really phenomenal results throughout 2021, which has been a changing rate environment with the benchmark rates, and hitting record revenue in the quarter and significantly exceeding our growth in members is a reflection of having a broad array of products, great marketing. So let me talk through the products and how interest rates affect them. We have a checking savings and loans, checking and savings product. SoFi just launched on the back of our bank. We provide 1% interest on that. That's going to be a very competitive rate compared to others on their checking accounts. It's about 33 times higher. And we give you no minimum balance, no restrictions on your spending, free overdraft protection, and 2-day early paycheck. So that is going to be very differentiated in a rising rate environment where people need to get a better yield on their money because borrowing money is more expensive. We have 4 different types of loans. Our student loan refinancing product benefits as people refinance into lower rate loans, and they still have a window to do that. But if rates rise, that will go away. Our personal loans product, on the other hand, is a product that people refinance out of credit card debt, that's variable rate debt, that is going to go up as rates go up, into a term fixed rate debt loan called personal loans. And so that benefits as well. And then on the investing front, we have a wide range of products you can buy on our brokerage account as well as cryptocurrency. So we have single stocks, we have ETFs, we have robo accounts, and we have cryptocurrency. And so depending on your view on interest rates and the type of yield and return you want to drive, you can allocate across that portfolio of different products. We also do have a credit card, which is a very attractive credit card because we give you 1% back. But we also allow you to double your rewards if you redeem into paying down a loan, which you'll want to do with higher rates. You can redeem into checking and savings, and you can also redeem into investing. And we double the points when you do that. So people are going to be looking for ways to save and better ways to invest. And we have many products that will suit them well when rates are higher.
Anthony, I didn't expect I'd be asking about football on a morning like this, but you know what? I'm going to fire away here. With your SoFi Stadium, you mentioned a lot on the earnings call, mentioned on their earnings release. Do you see an immediate pickup in members because you were so out front at an event like that?
Yeah, I think it's important to understand the broad-based strategy and put the stadium in the context of that. So we want to be a one-stop shop for all your financial services needs. We want to be there for every one of the major financial decisions in your lives and all the days in between. And we have all those products available on your phone today, convenient without fees. One of the things we have to do strategically is make people aware of that and build trust. So the strategy behind the stadium was to build credibility through the association with the Los Angeles Rams and Chargers and the National Football League and drive really efficient mass reach. So throughout the season in the fourth quarter, we had 5 nationally televised primetime games. And each game averaged about 22 million household viewers, over 100 million in total. That helps increase our brand awareness. It helps make us a household name. It helps drive trust with us. So when our products are marketed to you, you'll have a higher probability of being responsive to them. So I wouldn't say it's immediate. It's a continuity strategy. It really paid huge dividends in the fourth quarter. We had record member adds. We exceeded our full year estimate for 3 million members, finishing at 3.5 million members. And we had very high cross-buying rates. 30% of our products bought in the quarter, which was also a record at 900,000 new products, were from our existing members. So the stadium is a critical component of the broader strategy, and it's really paid dividends as we saw in the fourth quarter.
I've seen you really lay the groundwork for the future of this company, Anthony, from day one when you started getting the culture right. Now you have the bank charter, you have all these new products. What are your international ambitions? And when you see the situation in Russia and Ukraine, does that make you pause about wanting to be a global company?
Yeah, we have had a really huge year for the company and our shareholders, a number of milestones that you mentioned, but we're really just getting started in the US. There's still about 500 million accounts attached to legacy FDIC banks. And we think as a new bank, as well as a financial services company, we have a unique value proposition, something that's going to build a lifelong relationship with you, which gives you products that meet your needs as opposed to their needs. So for example, we don't charge fees on checking and savings. We don't charge overdraft fees like big banks do. So we have a unique value proposition that we're giving back to our members in unique value because we have lower costs, like the 1% on checking as an example. Outside the United States is a huge opportunity. Our technology platform, Galileo, which is a payment processing capability for debit and ACH. And now that we announced the Technisys deal, it's also another piece of our AWS FinTech strategy. That is our main effort outside the United States, is enabling these financial pioneers in Mexico, in Colombia, and LATAM to innovate in those markets as well. And we're the underlying infrastructure for that. Right now, the SoFi brand is primarily focused in the US and will stay true to that. We do have a small business in Hong Kong that's just in the invest business, but right now our plan is to really prioritize the US. As it relates to Ukraine, it's incredibly devastating to see people with not just the fear of violence, but now the actual violence taking place. And we as a country and the rest of our partners from a leadership standpoint need to continue to press and support the Ukraine effort against the violence that they're experiencing.
Anthony, thanks for being here. I would echo that. Anthony Noto, SoFi CEO, joining us on this Wednesday morning. And when we come back, another check on markets, and then in just a few, we're going to hear from Jay Powell. Stocks are strengthening here ahead of comments by Federal Reserve Chair Jay Powell in just a few moments before the House Financial Services Committee. Right now, we're seeing energy stocks continue to lead the gains. Financials are also strong in today's session, unlike in yesterday's session. And let's get a quick check on yields as well. Ahead of Powell, we have been seeing them push up a little bit this morning after falling back yesterday. That was one of the factors behind the decline in financial stocks. The 10-year yield at 1.8%. We will be right back with the chairman's comments. Just before 10 a.m. on this Wednesday, March 2nd, we are awaiting commentary from Jay Powell in just a moment. I'm Julie Hyman. That right there is Brian Sozzi. Soz?
Yeah, we're seeing some interesting market action here, Julie. Green across the screen, despite that continued advance in oil prices here too. Also getting an advanced look in comments from Fed Chief Jerome Powell suggesting that March is likely to bring that first interest rate hike. I want to get right to Brian Chung, has more on those comments. Brian.
Yeah, we are awaiting Fed Chairman Jay Powell's testimony to the House Financial Services Committee. That's supposed to be kicking off at 10 a.m., of course, give or take a few minutes. But we did already get his prepared remarks as submitted to the House Financial Services Committee. The Fed chairman noting that, quote, we expect it to be appropriate to raise rates in their next meeting. That's going to be happening on March 16th. So it seems like, at least for right now, the geopolitical tensions out of Ukraine have not dissuaded the Federal Reserve policy setting committee from wanting to raise rates as they had messaged over the last few months. Now, on the labor market, they did describe conditions as, quote, extremely tight. And interestingly, they noted that widespread benefits have happened for those on the lower end of the wage spectrum. This is very important commentary because over the last few months, we had seen some of the more dovish members of the Fed perhaps want to stave off any sort of interest rate hike because they wanted to pull in some of those more marginalized workers. But the Fed chairman, the top dog himself, now saying that he feels like the labor market is in a good place to then begin tightening. Again, you can see Jay Powell shaking hands with lawmakers in the committee ahead of that hearing. But what's important here is we did get some added commentary from the Fed chairman with regards to the Russia-Ukraine situation, which has developed very quickly over the past few days. Here's the money shot quote, the near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war, the sanctions, and of events to come remain highly uncertain. So it's not like the Federal Reserve is necessarily holding their hat and hinging future policy on the outcome of what's going to happen in Ukraine, but the Fed just simply saying, look, we're monitoring the situation. Obviously, things are progressing very quickly. If that does spill over into some sort of U.S. economic effect, then the Fed could adjust as needed. But again, not saying it's necessarily there at that point. But again, we'll see what the Fed chairman says once that hearing does get underway in a few minutes, guys.
We will. And it's interesting as well, because one of the other comments that came from President Biden last night, of course, he talked a lot about inflation, trying to attack inflation. And he also exhorted Congress to confirm his nominees to the Federal Reserve. That's a process that, where do we even stand in that process, Brian?
Yeah, there's a lot of moving parts here, and it's important to remember that the committee that he's testifying to today really doesn't have jurisdiction over those nominees. Really, it's the Senate Banking Committee where he'll be testifying tomorrow. So Maxine Waters, who you can see on the screen ahead of you, preparing to begin her remarks, is not necessarily part of that process. But we spoke with Bharat Ramamurthy over at the National Economic Council, who said he's optimistic that they can ultimately get those nominees confirmed. It just might be a little bit more of a delay as Republicans try to stymie those efforts. They want to take a deeper look into Sarah Bloom Raskin, who is the pick for vice chair of supervision. They want to look specifically into her dealings with a fintech company called Reserve Trust, alongside her views on climate change. So they'll be watching for that as well. So obviously the Senate Bank Committee might be the venue tomorrow where we expect to hear a little bit more commentary. But again, in this particular hearing, you shouldn't expect to see the Fed chairman be pressed on what's going to happen with those 5 nominees. Fed Chairman Jay Powell is actually one of those nominees. There's a weird technicality where actually his term as Fed chairman expired, but he's still pro tempore and serving in that transitionary role. But it looks like the head of this committee, Maxine Waters, beginning her commentary. So let's take a listen.
Recess of the committee at any time. As a reminder to all members, we will conclude today's hearing at 1 p.m. Members who were unable to ask questions at our July hearing with Chair Pro Tempore Powell will be given priority to ask their questions today, and we will return to our normal order of recognition once those members have asked their questions. This hearing is entitled Monetary Policy and the State of the Economy. I now recognize myself for 4 minutes to give an opening statement. I want to start by reiterating that I join with President Biden and our allies in condemning Russia's shameful, premeditated, and unprovoked invasion of Ukraine. I stand in solidarity with the people of Ukraine. Chair Pro Tempore Powell, since the last time you testified in July 2021, the United States economy has continued to boom and our recovery from COVID-19 pandemic is strong. Since the beginning of the Biden administration in January 2021, our economy added over 7 million jobs, a record in the first year of a new presidency. In addition, wages and salaries for workers grew by 4.5% in 2021, the highest level in close to 40 years. While these are encouraging figures, we have more work ahead. Families across the nation are facing higher prices because of inflation created not only by pandemic-related supply chain problems, but also giant corporations taking advantage of economic conditions to pass on higher prices to consumers. Importantly, housing is a key measure and driver of inflation. For too long, we have not addressed the shortfall in our housing supply, and this lack of supply is driving up prices. In 2021, the national median rent for an apartment jumped by almost 18%, and home prices rose by 17%. These are the true drivers of inflation, according to experts, despite repeated efforts on the part of Republicans to falsely blame pandemic relief and emergency stimulus as the primary cause. To address housing supply and other inflation drivers, the House passed the Build Back Better Act and American Competes, which make transformational investments, including $150 billion in equitable and affordable housing, as well as improvements to our supply chains. Regarding digital assets, the Federal Reserve recently released a paper seeking public feedback on a possible U.S. central bank digital currency, or CBDC, which would provide an alternative to volatile cryptocurrencies and benefit financial inclusion and promote national security. On the other side of that digital coin is a concern that pariah states like Russia may use foreign CBDCs to relieve the pressure of our carefully coordinated multilateral sanctions. Leadership from the Fed on these issues is more important than ever. Lastly, I would note that for the first time, a chair pro tempore of the Federal Reserve Board is testifying at this hearing. Senate Republicans have chosen to unilaterally block your confirmation. Chair pro tempore Powell and the historic confirmation of diverse and highly qualified nominees to the Board of Governors, leaving key leadership positions at the Federal Reserve vacant when it is tackling an array of economic issues, including those arising from Russia's invasion on Ukraine. This will undermine our recovery from the pandemic and place our economy and financial stability at risk. At a time of enormous economic uncertainty, rising prices, and geopolitical turmoil, the Fed's legitimacy is on the line. Now is not the moment for obstruction, delay, and gamesmanship. So, Chair Pro Tempore Powell, I look forward to your testimony this morning. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Well, look, Chairman Powell, we appreciate you being here, and I say to the chair of the committee that this is the House. The Senate does nominations. If we wish to have an opinion and direct the Senate, we should go run for the Senate. We have the Fed chair here at a time of unprecedented economic conditions and a war that's happening. I think we should stay focused on that. Chair Powell, thank you for your leadership. Thank you for your steady hand and your approach over this quite tumultuous first term of yours, and congratulations on your nomination and the expected confirmation of your second term. As we all know, the Financial Services Committee Republicans have offered and requested that the Biden administration not approve the $17 billion in an International Monetary Fund special drawing rights for Russia's reserves last year. My hope is that my Democrat colleagues will withdraw their support for $60 billion in additional reserves from Moscow in this year's omnibus that is being negotiated right now. We stand in a bipartisan way with the people of Ukraine, and we are grateful for their bravery. And we want to do everything in our power to assist and support them. Again, thank you, Chair Powell, for your leadership. America's facing the worst inflation we've seen in 4 decades because of Democrats' reckless spending here on Capitol Hill. Instead of a course correction, House Democrats keep hoping the Senate will take up the $2 trillion in new spending through Build Back Better, or whatever they're going to call it. This would only make rising prices worse for families across the country. A Wharton budget model estimates the average American family spent $3,500 more last year to keep up with rising prices. Nowhere is this more evident than at the supermarket, where folks are seeing a 22% increase in grocery bills, according to a recent KPMG study. For a family of 4, this can mean choosing between groceries they need and saving for their child's education, their retirement, or even a home. The American people should not have to mortgage their future because of Democrats' love of more government spending to give them the illusion of prosperity in the moment. And despite what we've heard from President Biden last night, simply telling people they're better off does not, in fact, make it true. However, I'm pleased that the president sided with Republicans instead of Senator Warren, Elizabeth Warren, when we renominated you, Chairman Powell, when he renominated you to chair the Federal Reserve. But as you know, Chair Powell, you have an enormous task ahead of you. As one of your predecessors famously said, the Fed's job is to take away the punch bowl just as the party starts to warm up. But the Democrats have drunk deep, and they want to move on to the harder stuff. That is a risk for our economy. We can't let that happen. I was pleased to see the Fed reject the notion of personal accounts by the central bank. As we've seen recently in Canada, and their unprecedented use of emergency powers to freeze hundreds of bank accounts, we need to ask not just how financial authorities can be used, but also how they could potentially be abused. It's disturbing that some Democrats refuse to see this danger and may actually view it as an opportunity to rationalize more government involvement in America's everyday lives. And that's why I sent a letter to regulators today asking for clarity on what this disturbing move that we've seen in Canada could be, if anything to that accord could be done here in the United States, and what we should do to prevent it. And I look forward to hearing their feedback. Again, Chair Powell, thank you for being here. These are unprecedented times that you're serving. Thank you for your steady hand and your leadership and your willingness to answer questions using language that most of us can all understand. And with that, I yield back.
Thank you, Ranking Member McHenry. I now recognize the gentleman from Connecticut, Mr. Himes, for 1 minute.
Good morning, Mr. Chairman. Mr. Chairman, probably the most effective tool we've deployed against Putin's outrageous attack on Ukraine is the sanctions on the Russian central bank and the freezing of Russian foreign reserves. Our ability to do so stems mostly from the dollar's preeminent position as the world's reserve currency. It is time, in fact, it is past time for all of us to lead on creating a regulatory environment in which we, rather than the world's despots, terrorists, and money launderers, benefit from the emergence of cryptocurrency, including a central bank digital currency. Mr. Chairman, one of the headlines on my news feed this morning reads, "Russians turn to crypto amid increasing sanctions," as the chairwoman indicated. The subcommittee I chair and the full committee have done and will do hard work on this topic, but it is time for all of us to act. Mr. Chairman, I can't shake the image of 17th century bankers sitting around London, unable to imagine that their gold pieces and copper plates could be replaced by these worthless pieces of paper. Let's not be those guys. Let's lead and not follow.
I now recognize the gentleman from Kentucky, Mr. Barr, for 1 minute.
Chairman Powell, thank you for being with us today. Inflation has hit a 4-decade high, with CPI surging to 7.5%. Core inflation exceeds 5%. PPI is now pushing 10%. Recently published inflation forecasts predict CPI will rise above 8% in coming months. According to a study from the Wharton School, the average family spent $3,500 more for the same goods and services in 2021 versus 2020. Tax and spend policies are largely to blame. Stephen Ratner, former counsel to the Treasury Secretary under President Obama, put it eloquently In a New York Times op-ed, the $2 trillion American Rescue Plan was, quote, the original sin that, quote, contributed materially to today's inflation levels, unquote. A potent cocktail of excessive government spending creating excess demand combined with a hostile tax and regulatory environment for private enterprise, which has constrained supply, have together produced a toxic supply-demand mismatch pushing prices up. Compounding these fiscal policy mistakes, the Fed pursued for too long an unconventional and overly accommodative monetary policy, which has resulted in an inflation crisis that is hitting our constituents where it hurts. It is clear the Fed is not satisfying its price stability mandate. I look forward to hearing from you on the path forward to address the monetary policy side of this equation. I yield back.
I want to welcome our distinguished witness today, the Honorable Jerome Powell, the Chair Pro Tempore of the Board of Governors of the Federal Reserve System. Without objection, your written statement will be made part of the record. Chair Pro Tempore Powell, you are now recognized to present your oral testimony.
Thank you. Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. Before I begin, let me briefly address Russia's attack on Ukraine. The conflict is causing tremendous hardship for the Ukrainian people. The implications for the U.S. economy are highly uncertain, and we will be monitoring the situation closely. At the Fed, we're strongly committed to achieving the monetary policy goals that Congress has given us, maximum employment and price stability. We pursue these goals based solely on data and objective analysis, and we're committed to doing so in a clear and transparent manner so that the American people and their representatives in Congress understand our policy actions and can hold us accountable. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but with cases having declined sharply since mid-January, the slowdown seems to have been brief. The labor market is extremely tight. Payroll employment rose by 6.7 million in 2021, and job gains were again robust in January. The unemployment rate declined substantially over the past year and stood at 4% in January, reaching the median of FOMC participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has ticked up, labor supply remains subdued. As a result, employers are having difficulties filling job openings. An unprecedented number of workers are quitting to take new jobs, and wages are rising at their fastest pace in many years. Inflation increased sharply last year and is now running well above our longer-run objective of 2%. Demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus, and price increases are now spreading to a broader range of goods and services. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. The committee will continue to monitor incoming economic data and will adjust the stance of monetary policy as appropriate to manage risks that could impede the attainment of its goals. The committee's assessments will take into account a wide range of information, including labor market conditions, inflation pressures and inflation expectations, and financial and international developments. We continue to expect inflation to decline over the course of the year as supply constraints ease and demand moderates because of the waning effects of fiscal support and the removal of monetary policy accommodation. But we are attentive to the risks of potential further upward pressure on inflation expectations and inflation itself from a number of factors. We will use our policy tools as appropriate to prevent higher inflation from becoming entrenched, while promoting a sustainable expansion and a strong labor market. Our monetary policy has been adapting to the evolving economic environment, and it will continue to do so. We've phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target range for the federal funds rate at our meeting later this month. The process of removing policy accommodation in current circumstances will involve both increases in the target range of the federal funds rate and reduction in the size of the Fed's balance sheet. As the FOMC noted in January, the Fed funds rate is our primary means of adjusting the stance of monetary policy. Reducing our balance sheet will commence after the process of raising interest rates has begun and will proceed in a predictable manner, primarily through adjustments to reinvestments. The near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war with sanctions, and of events yet to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition that the economy evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. Maintaining the trust and confidence of the public is essential to our work. Last month, we finalized a comprehensive set of new ethics rules to substantially strengthen the investment restrictions on senior Federal Reserve officials. These new rules will guard against even the appearance of any conflict of interest. They are tough and best in class in government here and around the world. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you very much. I now recognize myself for 5 minutes for questions. Chair Pro Tempore Powell, as you know, the Fed is required to conduct monetary policy in a manner that fulfills its dual mandate to promote maximum employment and stable prices. But as you have explained, most of the inflation we're experiencing right now can be traced back to supply chain issues related to the pandemic, and the Fed cannot directly affect supply side conditions. These supply chain constraints seem likely to only significantly increase as Russia invades Ukraine and the full effect of our sanctions take hold. If the Fed's tools are mostly useful in stimulating or constraining demand, how can we expect monetary policy to rein in inflation that is largely driven by supply side factors?
Our policies really cannot, as you point out, affect supply side conditions. Our policies affect demand. What we're facing now is, though, an elevated level of demand in the face of supply side constraints, and it's the collision of those two things that's creating inflation. So there is an important job for us to move away from these very highly stimulative monetary policy settings to a more normal level of rates and perhaps tighter at a time when inflation is highly elevated, and that is what the committee plans to do.
So it seems clear that the Fed has limited tools to address inflation and that Congress has an important role to play. The Monetary Policy Report notes major shortages in housing supply as a factor in high prices. If Congress were to make investments to alleviate these shortages, do you think this would be helpful in addressing inflation?
Major investments in housing supply? So I think housing prices are high for a number of reasons, actually. Difficulty in getting lots, materials, difficulty in finding workers, very high demand. It's been extraordinarily high. So those are many of the features, and also low interest rates have made credit widely available. Mortgage rates are going up. That will probably begin to cool off demand. I wouldn't want to comment on congressional legislation, but I do think there's no doubt a role for Congress.
So I suppose I could conclude without having you comment directly on fiscal policy, that you agree there are ways to manage inflation outside of monetary policy. It's not only monetary policy, that others have a role to play.
I do think that's right, but more in a sort of medium or longer term sense. I think the Fed does monetary policy, and inflation is largely a monetary phenomenon, and it's our tools that can be used to address inflation. Over time, though, of course, anything that expands the productive capacity of the United States over time would, in principle, make greater potential output and a less constraining economy.
Fed forecasters expect that inflation will subside as supply chain disruption issues are resolved. However, housing and rent prices, as you've said, account for roughly 1/3 of the consumer price index, and most economists do not expect the problem to be resolved as quickly as supply chain bottlenecks due to both the time it takes to develop housing and the lack of investment in housing that is affordable to low and moderate income families. Currently, there's a shortage of nearly 7 million rental homes that are affordable and available to America's lowest income renters, and a shortage of more than 5 million homes for potential home buyers. In my district, there's a shortage of more than 34,000 rental homes that are affordable and available to the lowest income families, while the state of California has a shortage of more than 962,000 affordable rental homes. If Congress does not make the investments to increase supply and access to the affordable homes in this country, how concerned are you that the Fed will not be able to contain inflation?
Well, you're right that housing inflation is a significant part of the CPI. We also look more prominently at personal consumption, PCE, which is a different measure, and it's something less than that. And unlike these temporary supply-side constraints that we see, housing inflation really is much more of an indicator of the tightness of the economy rather than supply-side problems. So it's something we watch carefully, along with wages, frankly, and it is a major contributor to inflation. As I mentioned, higher interest rates housing is a very interest-sensitive sector, and higher interest rates, really interest rates that move back toward a more normal level, should act to cool off the housing market over time.
Thank you. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Chairman Powell, thank you for your leadership in tumultuous times, and this is certainly interesting times internationally, challenged times internationally. Everyone else on the Open Market Committee, it seems, has opined about the March meeting. Everyone, whether it's a tweet or an interview or anything else. What are your thoughts going into the March meeting?
The March meeting. Okay, so here's how I'm thinking about the March meeting. And I guess I would start, of course, with the U.S. economy, which is very strong, the labor market extremely tight, and inflation running well above target. The way we think about our work is we develop working plans for making adjustments to monetary policy over the course of the coming months, and then we are flexible as plans meet the real world. So we're never on autopilot, obviously, and at a time like this, what we aim to do is lay out our principles, and then with whatever clarity we do have, and then proceed to implement those policies carefully and nimbly. So coming into this meeting, let's say before the Ukraine invasion, the committee was set to raise our policy rate, the first of what was to be a series of raises expected for this year. Every meeting was live. Decisions would be based on incoming data and the evolving outlook. I also expected we'd make great progress on our plan to begin to shrink the balance sheet. And so the question now really is how the invasion of Ukraine, the ongoing war, the response from nations around the world, including sanctions, may have changed that expectation. And so it's too soon to say for sure, but for now, I would say that we will proceed carefully along the lines of that plan. The thing is, the economic effects of these events are highly uncertain. So far, we've seen energy prices move up further, and those increases will move through the economy and push up headline inflation, and also they're going to weigh on spending. We're seeing effects on other commodities and perhaps from declining risk sentiment and weaker growth abroad. The thing is, we can't know how large or persistent those effects will be. That simply depends on events to come. So this is where that leaves me. I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike. We're also going to write down our new summary of economic projection, individual forecasts, which will show each participant's views of the path forward in the economy and with rates. I also expect that at this meeting, we'll make good progress toward an agreement on a plan to shrink the balance sheet. We will not finalize that plan at this meeting. We'll do that when we think the time is right at a coming meeting. The bottom line is that we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war for the economy. We use our tools to support financial stability and macroeconomic stability. We're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. So that's how I would think about it.
Very specific. Now, you mentioned 25 basis points. From all the analysis about what the Fed will do over the course of the next year, is 25 basis points the floor, the ceiling? Is it the speed limit? Is that the max you think the Fed could take on? How do you think of that?
So here's how I think about that. We have an expectation, those of us on the committee have an expectation that inflation will peak and begin to come down this year. And to the extent inflation comes in higher or is more persistently high than that, then we would be prepared to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings.
Now, you mentioned the balance sheet, a plan for the balance sheet, and that is to come. But what I'm hearing clearly from you is that the Fed is very interested in financial stability given what's happening, and you're willing to make quick decisions on a question of liquidity, on a question of market stability, those important works that you've focused on as Fed chair. And so it's actually substantial news for the House to be the first rather than the Senate to break news. So thank you for your forthcoming, being so forthright about your views on this. And with that, Madam Chair, I yield back.
Thank you. The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Madam Chair, and thank you for ranking member for holding this hearing. Chairman Powell, thank you very much for being with us here once again. As we look at the unprovoked criminal Russian invasion of Ukraine, one of the most notable national security responses has been the president's recent announcement to cut off much of the Russian financial sector from SWIFT financial services. Our EU partners have also joined us and excluded 7 Russian banks from SWIFT. Chairman Powell, what practical effect would this have on Russia, its economy, its financial sector, and its people?
So thank you. I should point out that the Fed does not impose sanctions on other countries, that we, in this process of developing sanctions, we are not a principal. That's really a job for the administration, particularly the Treasury Department. So we provide technical background support and things like that. But I think questions about sanctions and their effects generally would be more for the administration and the Treasury Secretary. I think you can see, I will just add, though, that the effects of the sanctions so far appear for now to have been significant.
Yeah, I mean, we saw what happened to the ruble. We saw what happened to the market. The market's still closed. Is a way around it for them cryptocurrency? Could you talk a little bit about that? I know it's a little bit out of your bailiwick, but as you said, it's an interesting moment in time. You know, we haven't had to face this since really World War II, and even all the comments that you made about inflation and watching the market, so much of it is tied to obviously what the Russians are doing with respect to their unwarranted and criminal act there in Ukraine.
So I don't have any private information on the extent to which that is happening, but that is something you read about and hear about. And I just think it underscores the need really for congressional action on digital finance, including cryptocurrencies. We have this burgeoning industry which has many parts to it. And there isn't in place the kind of regulatory framework that needs to be there. It was probably no different with railroads or telephones or the internet. And ultimately, what's needed is a framework, and in particular, ways to prevent these unbacked cryptocurrencies from serving as a vehicle for terrorist finance and just general criminal behavior, tax avoidance and the like. So I guess that's what I would say there. I don't really know the extent to which it's happening, although you do hear that and read it in the paper.
Seems like an outform since we did go down this road. Could you comment a little bit about then the central bank digital currency? It seems like that would be something that would be helpful in situations like this.
Yes, so we issued a paper after much thought and many drafts. We issued a paper, was it late last year? I guess it was late last year, seeking public comment on the costs and benefits of a potential central bank digital currency issued by the Federal Reserve here in the United States, digital dollars. And we await, I think we gave an extended comment period, and we very much look forward to reading those comments. This will be something that we invest a fair amount of time and expertise and hiring people and things like that to try to get it right, but also to understand whether the benefits actually outweigh the costs, which I think is an unanswered question both here and around the world. Nonetheless, it's our obligation to move vigorously to understand the answers to that question so that we can deploy a central bank digital currency if it's appropriate. So would it, in principle, it depends on why people are using unbacked digital currencies. If they're using them to evade, visibility and evade the law, then for us just to have a law-abiding CBDC won't change that. They'll still be able to use those currencies for that matter. The existing digital currencies that again are not backed are really vehicles for speculation. They're not used in payments. They're not a store of value. They're speculation like gold. That's what they're used for. Whereas, potentially a U.S. CBDC would have a wider view. I do want to stress we have not decided to do it, but we do understand our obligation is to really get to the bottom and understand both the technical and the policy issues that need to be answered.
Thank you, and I know my time's about up. I'd just say from your lips to God's ears, I hope that the inflation does peak this year and does come down because people are hurting. And thank you very much again for your steady stewardship.
Thank you very much.
Thank you.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Welcome, Chair Powell. It's good to see you in the chair. We appreciate your time and service. Chair Powell, since the last FOMC meeting in January, the global economy has become markedly more complex. Russia's unprovoked and unwarranted invasion of Ukraine has led to a very steep increase in the price of energy. As of this morning, when I checked, a barrel of crude oil was priced at $112 per barrel. And this steep increase in the price of energy risk pushing U.S. inflation potentially even higher. How does, and you've touched on it a little bit, but how does the war in Ukraine affect your thinking as you prepare for the next FOMC meeting?
So I think the first thing, again, to say is that the ultimate economic effects of the war and all of the sanctions and events yet to come are just very highly uncertain, and we need to understand that. And so, as I mentioned, I think it's appropriate for us to move ahead. Inflation is high. The committee is too high, and the committee is committed to using our tools to bring it back down to levels of price stability, which is to say 2% inflation. So, but I would also say that given the current situation, we need to move carefully. And we will, and we'll be nimble. We'll be looking at the situation as it evolves, and again, we will use our tools to add to financial stability, not to create uncertainty.
So at this point in time, you don't think that it significantly alters your expectations for the rate increases that you've discussed this year?
I don't think that's knowable yet. I mean, so we've run what we like to do is run alternative scenarios, and we've done some of that, as you would expect. And it's easy to find cases where it would affect, but we don't know that yet. We honestly don't, and we'll see.
Thank you. Chair Powell, could you explain the role of the Federal Reserve in implementing U.S. sanctions on Russia? How you're working with OFAC, how this actually is implemented?
Right. So sanctions are really designed by the administration. They're part of what the elected government does, where we provide technical support. We implement those sanctions, or we make sure that the banks obey them, that we supervise and regulate. That's one thing that we do. We also consult on, we have knowledge about financial markets and financial institutions, so we're providing technical support, but we're not the decision makers on those things. And honestly, these are decisions that are made at the level of the government, not at the level of the elected government, not at the level of the Fed.
And I know things are happening quickly and in real time here, but what actions has the Fed taken to date since the invasion of Ukraine?
Well, I'd say, first of all, since late last year, we've been on very high alert for cyber attacks. We haven't seen any notable incidents about that yet. We consult. We're making sure that the banks we regulate and supervise are also on high alert. We communicate with the reserve banks, where there's a lot of expertise in these areas and other parts of the government. So that's one thing that we've done. We're, as I mentioned, we are in very close contact with the Treasury Department, as you would expect, between every central bank and every finance ministry around the world. But again, we're not the ones who design the sanctions.
Right. Well, cybersecurity is certainly, this committee is, and especially at the Fed, is a top priority. I'm glad that you're watching it closely. Chair Powell, does our U.S. financial system have the necessary capital and liquidity to handle any economic fallout from this war? What kind of data will we be seeing?
I mean, the evidence to me strongly suggests that the answer to that is yes. We just went through a rather enormous shock with the pandemic and the near closure of the global economy, and U.S. banks' capital levels are at multi-decade highs, liquidity levels the same. It's hard for me to look at that and say that a lack of capital is a threat at this point. There are certainly issues. Cyber for private financial institutions is a huge issue, and one that they spend a great deal of time on, as do we.
In 2015, the Obama administration blocked the development of the Keystone XL pipeline, a decision reversed by the Trump administration, and President Biden canceled the permits, again, depriving the U.S. of over 800,000 barrels of oil a day. Wouldn't expanding the supply of oil by 800,000 barrels a day reduce energy inflation and lower prices at the gas pump?
We're not responsible for energy policy. That's a matter for Congress and the administration. Of course, the laws of supply and demand do work.
Laws of supply and demand do work. I've used my time, and I yield back.
Gentleman from Guam, Mr. San Nicolas, is now recognized for 5 minutes.
Thank you so much, Madam Chair. Good morning, Chair Powell. And I'd like to first recognize one of my senators all the way from Guam, Senator James Moylan. Thank you so much for making time to join us here today, Senator. Mr. Chairman, over the course of the uptick of inflation in the last year, you testified before the committee on multiple occasions that the Fed believed that the inflation that the country was experiencing was transitory. And since that time, especially today, there's a seeming change in that tenor. Could you elaborate more on that?
Sure, I'd be glad to. So I think very widely among macroeconomists and other central banks around the world, we looked at it as akin to an energy shock and a supply side shock. And the textbook on monetary policy would have you look through that, because a supply shock comes and goes, and by the time monetary policy is having its effect, which happens with long and variable lags, we think, the supply shock is already gone. So we looked at it that way. And, I think we expected to get relief, particularly going into last fall, I would say. We expected when schools reopened, vaccinations, raised, kids back in school. We expected supply of labor to come in, that kind of thing. And it didn't happen. But it didn't happen because the supply side constraints didn't ease. They didn't ease. So it's not like, as a practical matter, what was wrong was not the theory. It was just, in reality, the supply side constraints have been much, much more durable and persistent than we had expected. So we knew that we could be wrong, and I think I always thought we could pivot pretty quickly and catch up. And we did pivot when we started to pivot in the middle of last year, and then pivoted hard at the end of the year. But in the meantime, the economy was really healing incredibly quickly over the second half of last year. Record job growth and record decline in unemployment, record tightening in the labor market. So, we know that what our job is now, which is to move away from these highly accommodative settings to more appropriate settings, given the very hot nature of the labor market and the level of inflation.
There's chatter, Mr. Chairman, public chatter, that the intensity of the inflation that we're dealing with today is a reflection of the Fed not taking policy action soon enough, not taking enough policy action. And there's chatter, public chatter, that causes the Fed's credibility to come into question as to whether or not it is acting responsibly and appropriately with the data sets that are coming in. And I bring this up, Mr. Chairman, because we have a duty to the American people to be able to raise these questions as pointed as they are, and to give individuals such as yourself an opportunity to really speak to the credibility question that's really out there in the community. If you could elaborate further on that.
Sure. It's for others to judge many of the things you mentioned, and we understand that. But so we, starting in December, at our December meeting, we began talking about significantly more rate increases. The market took us very much at our word, and as this year has gone on, the market so market participants do appear to be reacting, what I would call as appropriately to our assessment, our ongoing assessment and reassessment of what's appropriate. And I'll just assure you and everyone that we are committed to achieving price stability. We will use our tools to achieve price stability. Really, that is an essential bedrock element of everything else we want to achieve in the economy, including a strong labor market.
When we faced the financial crisis in 2008, a lot of lessons were learned about the need for the Fed to be more responsive to the liquidity traps that could take us by surprise. Given the circumstances we're dealing with today and the frustrations that the American people are facing, can you share with us any lessons that the Fed has learned with respect to its responsiveness to the inflation that we've been dealing with over the past 12 to 18 months and the intense inflation that we're dealing with today?
So the inflation that we're experiencing is just nothing like anything we've experienced in decades. It's higher, of course, much higher than anything we've seen since I was much younger. But not only that, it's different. It's coming from the goods sector. The goods sector has been a source of disinflation for a quarter of a century because so many manufactured goods have been manufactured.
But just specifically, Mr. Chairman, reclaiming my time, what specific lessons has the Fed learned from the outcome that we're dealing with today?
Well, I mean, we're still living through it. So the main focus we have is not on doing a retrospective. It's on conducting policy appropriately to return us to price stability while also sustaining the expansion.
Gentleman's time has expired. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, thank you for being here, and congratulations on your nomination to continue your job for a second term. I think it's well-deserved. Before I get to my questions, though, I want to hold up something here. This is a Ukrainian dollar. It's a hryvnia. I kept some of these when I was in Ukraine several years ago doing some ministry work, and I think it's interesting to think that what happens in the next few days may determine whether this is another defunct piece of currency and the nation returns to a ruble, or will this maintain some of its value? But as you look at it, you can see it's a fraction, physically a fraction the size of the US dollar. It takes about 30 of these hryvnias to match a US dollar, but when you look at values, our dollar has decreased in value, as you have mentioned, due to inflation. Now, A year ago, when you testified before this committee, I asked what your outlook was for the economy, and you said you expected economic growth to be strong for the rest of 2021. But at that time, I warned that the $2 trillion stimulus bill that was making its way through Congress at that time was unnecessary and far too big, given the economy was already recovering. Lo and behold, these predictions came true. In your opening statement, you mentioned that you didn't expect inflation to continue at the rate it is right now, but I also recall throughout 2021, we heard that inflation was slight, it was going to be temporary, but I also understand that that prediction probably didn't include the actions and the roles that Congress had, as you had said. Now, according to a report from the Federal Reserve Bank of San Francisco, because the American Rescue Plan was so extremely large and was passed when the economy was already recovering, this was a significant contributing factor to inflation. Do you agree with that report from San Francisco's bank that our reckless spending is a contributing factor to our inflation?
I wouldn't like to comment on any particular law, but I'll say this. All of the things that we did after the pandemic were we turned our dials as hard as we could. So did you, with the CARES Act. And the economy did benefit from that. We have the strongest economy in the world now. But part of that, no doubt part of what we did and what Congress did without naming any particular laws is also part of the reason why inflation is high now.
Right. So there are multiple contributing factors to that, being the reckless spending, which devalues our dollar, is one of those. And what we heard last night was that there is not going to be a change in the direction this Congress is going or the White House. It sounds like we're just going to repeat the same mistakes we made in 2021. Now, I know that you have the tools of adjusting the interest rate. You mentioned increasing 25 base points, and you mentioned that it may be necessary to go higher. Understand that. Do you still think that inflation will be temporary? And I believe that you said it would be short-lived going forward because of resolving our supply chain issues. But since there are other contributing factors to that, are you anticipating that Congress or the administration will undo some of the failed policies, such as the spending policies and the suppressing of America's energy supply, which has been a significant contributing factor? Let me rephrase that. If Congress and the White House does not change the policies of 2021 and continues down that same path, do you still believe that inflation will stabilize? Price stabilization will come this year?
Well, first, we've had this expectation, as you all know, for more than a year, and it hasn't actually come true. So we're humble about the fact that we can't really call with any confidence the turn, but it does seem that this year we'll be withdrawing policy accommodation. Actually, a lot of the fiscal policy spending has happened now, and so the impetus to growth will be declining and, in fact, negative from fiscal policy as it stands now. And those are things, and just the natural improvement of supply chains and labor supply and things like that. Those are the things we're looking to for relief on inflation, hoping for. Very difficult to say when they'll happen. And our job is to achieve price stability one way or the other.
Okay. I see I'm running out of time. I've got several other questions, but I'll submit those for the record. Now yield back, Madam Chair.
Thank you. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member, for this hearing, and thank you to Chair Pro Tempore Powell for joining us. It's been a challenging year. Rising prices at the gas pump and the supermarket cause real distress to working class families like my neighbors in Chicagoland, and improvements in employment and wages are real, but not nearly enough. My constituents saw a decade of stagnation after the last recession. Working class Latinos and immigrants like my neighbors are always hard hit. We simply can't afford that again. Chair Powell, you've said that inflation has been driven by bottlenecks in the supply chain. And last night, President Biden highlighted their role in corporate concentration and price increases. I'll note that CEOs from Kimberly-Clark to Tyson Foods have bragged to investors about their power to raise prices without facing competition. And last night, President Biden said, and I quote, "Lower your costs, not your wages." And my constituents were glad to hear that. So, Chairman, can you explain how raising interest rates will lower prices for diapers or chicken? Last time it was because my neighbors lost their jobs and couldn't find diapers or chicken. So is that the idea?
Well, the idea is that right now the federal funds rate is still set close to zero, and that is a very stimulative level. I think it's 8 basis points today. So that is not an appropriate level, we think, going forward. We think it's appropriate that we engage in a series of rate increases over the course of this year and also let our balance sheet shrink. And so what will happen then over time is demand will moderate as interest rates get into the economy over time, and these annual price increases in everything where prices are going up will moderate as well. That is how it has always worked with interest rates. We don't do competition policy, so I can't really comment on that part of it. But I will say that that's how we think about inflation, and that's how we use our tools to get inflation under control.
Changing gears, we discussed corporate concentration, and last July, the president issued an executive order on competition that encouraged the Fed and other regulators to increase scrutiny of bank mergers. It's been a long time since regulators blocked a bank merger, even an acquisition by a globally systemically important bank, or GSIB, in 2020. Chairman Powell, do you think it's appropriate to issue a moratorium on pending mergers while the Fed updates its framework for their review?
Well, I think we have a statute that Congress has passed that gives us the rules for evaluating potential acquisitions and mergers by banks. I think we have a widely developed framework for that work, and we're continuing to implement that. I mean, any changes that would come would either come through legislation or through new personnel at the Fed, neither of which we have right now.
As we learned from Wells Fargo, frontline bank workers are an important resource for regulators. They see firsthand how banks implement or ignore internal controls, and they can identify problems as they develop. Incorporating frontline workers' voices in our banking regulatory system would improve the information we have and diversify the voices that get heard. Chairman Powell, will the Fed commit to adding bank workers to your various advisory councils? Why or why not?
Very interesting question. We do have quite a diverse group of people on our various advisory councils, including people who are representatives of workers. I don't know that it's, we don't really, I don't know that we have ones that work councils, outside councils that advise us on bank supervision per se, but we do always seek out in all of our, in our reserve bank boards and also the advisory councils that we do have representation from labor and also from people who live and work in and represent the interests of, pardon me, low and moderate income communities.
Thank you. Appreciate it if you would consider that. And Madam Chair, I yield back.
Thank you. The gentleman from Tennessee, Mr. Kostop, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chair Powell, for attending this morning. If you can, a lot of times we look for historical references when we try to reference an event, a current event. A number of people, a number of pundits, when they look at inflation today, they reference it back historically to the late 70s and the early 1980s. From your perspective, is that the proper historical reference to what we're experiencing today as it relates to inflation?
That's the proper historical reference for what we're what we're trying not to replicate. So We look back, obviously all of us have looked carefully at the history of post-World War II inflation and business cycles and all that kind of thing. One of the things that's different now is that central banks, including the Fed, are very squarely take responsibility for inflation. That was actually not the case in the 1970s. There was a school of thought that really there were certain things that an independent agency just couldn't do because it was too hard and Congress should do it. So now I think central banks around the world have an inflation target. They have transparency so that they can be held to account for it. You know, we're not waiting. We are using our tools now to, and that's really different than it was in the 1970s. So also inflation expectations have been anchored for a long time. They really weren't then. They were allowed to become unanchored without much of a response. That would not happen in today's world and will not happen.
A few weeks ago when the CPI number came out, I was on my way to a breakfast meeting in Jackson, Tennessee, where I represented one of my constituents and I, when we were talking about the new CPI number, he said, I don't care what the number is because I know that I'm paying 50% more in gas than I did 12 and 18 months ago. I know I'm paying 20 to 25% more in grocery prices than I did a year ago. I know what the price of a new car and a used car is. If you were me, if you were a member of Congress, what would you tell your constituents about the rising cost, the expensive cost to just live today?
Inflation is too high. We understand that, and we're working on it. It's going to take some time, but we're going to get it back under control. By the way, we're seeing this everywhere in the world. We're seeing it more in the United States because our economy is stronger, but we're seeing it everywhere in the world.
Let me, if I can, follow up on a few questions that some of my colleagues asked about. Ranking Member McHenry asked you about the next meeting and your plans for the next Fed meeting, and I think you eloquently laid it out. But you also talked about the situation that's developed in Russia and Ukraine. My inference from your answer is that if Russia had not invaded Ukraine, that the Fed would be more aggressive as it relates to the balance sheet and to rate hikes. Is that a proper inference?
No, I think that remains to be seen. As I said, we are moving ahead at this meeting. It would be my expectation in 2 weeks with a rate increase. And we're going to make progress on agreeing on a plan at this meeting to shrink the balance sheet, and I'm confident we will. The question of when we implement that plan is not answered yet, so I don't think that's clear at this point. It's certainly something that we can't answer now.
Mr. Garcia referenced the President's State of the Union remarks last night. The President, when he talked about addressing inflation, said that we need to control cost. Did you hear him say that?
I did not. I was too busy getting ready for this hearing. I did not watch.
I won't tell the President.
I probably just did.
When the President said he wants to control cost, or that businesses should control cost to address inflation, would you have any idea what he's talking about?
I really can't comment.
Fair enough. In follow-up to my questions from Congresswoman Wagner, she asked you about cyber. I know pre-pandemic, pre-invasion, one thing that you talked about that kept you up at night was a cyber attack. If Russia were to retaliate against the United States in some form of a cyber attack, what degree of confidence do you have in our nation's banks to thwart a cyber attack from Russia?
What I can tell you is that everything that we can do to protect ourselves against cyber, we're doing it. We're doing it. The private, large financial institutions are doing it. They have been for some time. So it's very hard to say what's possible to happen, but we're certainly on high alert, and we will continue to be.
Thank you very much. The gentleman's time has expired. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Put it on, please. Thank you. Thank you very much, Chair Lady Waters, for your leadership in calling this hearing. Mr. Powell, first I want to say that at a time when we are still recovering economically from the COVID pandemic, and we're facing challenges at home and now in Ukraine. I think and I feel deeply that the Fed should not be subjected to political stunts in the Senate with boycotts by the Republicans, and the Senate should consider the pending Fed board nominations as soon as possible. The Fed has an important job to do, and President Biden has put forward qualified nominees, and we need to get this done. So that's just my main point. With that said, as you and I have discussed in the past, the economic recovery has not been even, and we still have a ways to go to ensure our economy works for everyone. Just as one example, the black unemployment rate remains at nearly 7%, which is more than double the white unemployment rate. And later today, the Select Subcommittee on Corona Crisis is having a hearing where we will be looking at the depth of the pandemic's impacts on child care providers and workers and the results that has on our families and our economies. So I want to ask you about the monetary policy report the Fed released on Friday. The Fed notes that the labor force participation rate remains well below estimates of its longer run trend as a result of retirement and people out of the labor force and engaged in caregiving activities. From both a macro perspective and a micro perspective, what does this drop in labor force participation mean for the U.S. economy, and what does it mean for those workers who leave the workforce to care for their children or family members?
Well, having a lower labor force participation rate now, it's about a little more than a percentage point lower than it was. It reflects a lot of retirements. And, you know, what it means is that our labor force is smaller. That has consequences, including it's contributing to the labor shortage that we're seeing across industries all across the country. If we had a few more million people working, then we wouldn't be feeling that quite so much. It also means the potential output of the country is lower. Many of the people who are not in the labor force are retirees who have made a choice, but some of them are still people who want to come back but perhaps can't because of childcare activities or fear of COVID or other factors. In any case, it's been the decline in labor force participation that we've seen has been much larger than that of other comparable nations. And it was not something we expected, and it's certainly something that's now contributing to wage inflation and actual inflation and to the labor shortage that we're currently seeing.
Thank you. It's been announced as a result of the Ukraine war and other disagreements that Russia and China are now moving to trade completely in their currency, no longer using the dollar. And Pakistan has flown in to meet with Russia. There's some talk that they may be part of it. What effect would that have on the U.S. economy if China and Russia no longer use the dollar in certain block trades around the world and with each other? What effect, if any, would it have on our economy?
Well, we do benefit from being the reserve currency for the main reserve currency for the world. And that really is because we have open capital accounts and the rule of law, and we have inflation, you know, over a long period of time under control, so that the dollar preserves its value. And so our markets are the most liquid, and it's the place where people want to be. Over time, the question is, if some want to move away from the dollar, what will be the effect on us? I don't think it's something you would feel right away. Over time, they would have to create an ecosystem, economic ecosystem, whereby another currency becomes, you know, a better currency for them to use. You know, what we can do is we can make the dollar the most attractive currency by continuing to have the rule of law and open capital accounts and make it an attractive place for people to invest and to use in their businesses. There wouldn't be any short-term effect of that. Over time, though, you know, it would. I suppose it would diminish our status as the reserve currency. It's also possible to have more than one large reserve currency, and there have been times when that was the case, and so it's not really clear.
Thank you. My time has expired. Thank you. I yield back, Madam Chair. Thank you.
Thank you. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair, and to continue several points that a number of my colleagues have raised. As Putin's aggression in Ukraine has continued to escalate, the U.S. and its allies have responded in a unified voice to condemn Russia and apply economic pressure. Chairman Powell, could you discuss the difficulty of predicting what the implications will be of locking Russia out of SWIFT?
So again, on sanctions, we're not the right folks to ask. We don't design them. We don't implement them. So it would be really a question for the administration.
Let me word it this way. How sweeping do you foresee the ripple effects through the U.S. financial system? Is there an effect on us as those actions take place?
With big actions like this, there may well be unintended and unexpected effects, and hard to say what those might be. In the economic sphere, you're seeing, not directly to your question, but we're seeing concerns over palladium and neon and corn and wheat, shortages of those potentially, but so it would be difficult to say exactly what the effects could be over time. The United States, our financial institutions and our economy do not have large interactions with the Russian economy. It's a relatively small thing, and it's gotten smaller and smaller in recent years. So there wouldn't be, direct effects from these kind of things on the U.S. economy. It's hard to think what the second-order effects might be.
Thank you. You've answered my question. As Congresswoman Wagner touched on, the price of oil has continued to climb during the past year to its highest level in more than 7 years. And we now see international banks appropriately shunning Russian oil, even without energy sanctions. Could you describe the range of different scenarios the Fed projections paint in regard to this? And along with that, how do you see this potentially impacting the already rampant inflation issues?
Well, obviously the price of oil depends on events that haven't occurred yet. It really depends on where this goes going forward. We have seen prices move up, including just in the last couple of days. And they moved up quite substantially since, if you go back 3 months before this incident kind of began, prices are up quite a bit. The effects are going to be passed through into gas prices, into lower economic activity, and into inflation, headline inflation. And the larger the increase, the larger the effect. But the question then will become, that's a price level change. Is that going to lead to repeated inflation increases at that time? And that is not necessarily the case, and of course we would use our tools to make sure that it's not the case.
And of course, representing the constituency I do, which is both oil and gas and production agriculture, we take very careful note of what those actions will affect, how they will affect world crude oil prices, and of course, the Ukraine being a very historic major grain producer, my wheat people also are prepared to step up and match that. But it all underscores, I suppose, the increase in energy production in the United States and supporting policies that will not penalize or drive capital away from domestic oil and gas production. That's more of an editorial on my part, Mr. Chairman, but I note that we stand ready in this country to replace resources that may not be available or affordable for the rest of the world, and we just need a little incentive and encouragement from this side of the room to utilize those things. So my last question in the time I have remaining, the economy is currently operating in what I think we'd all describe as, at the very least, massive economic uncertainty. And when you deal with this 40-year inflation and the supply chain issues and the COVID-related issues, hopefully as we're in that final stage, can you elaborate on how critical it is for the health of the economic system to be reliable and to maintain liquid markets so we can navigate through all of whatever lies ahead of us?
Yes, so I would say our markets have been functioning well. There's a great deal of liquidity out there. We have now, between our swap lines and our repo facility for other foreign central banks and our standing repo facility in the Treasury market, we have institutionalized liquidity provision. And I think just the knowledge that that is there will help support good market function, which despite all this volatility, we still have.
Thank you, Mr. Chairman. I yield back, Madam Chair.
Thank you. The gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Business, is now recognized for 5 minutes.
Thank you, Chairwoman Warder. Chairman Powell, thank you for being here today. Given what you said about the upcoming meeting in March and the illegal invasion of Ukraine, how is the Fed coordinating with other central banks around the world and accounting for their actions when considering adjustment to interest rate policy here at home?
So we're in ongoing contact, it's fair to say, with our major central bank colleagues. And actually, we have a meeting of all of them on Monday morning at 7, a virtual meeting at 7 a.m. on Monday. So it's something that we do regularly. That said, we conduct monetary policy to achieve domestic objectives, specifically here in the United States, maximum employment and price stability, and that's what we use our tools for. But it's, of course, the foreign events are very much top of mind right now, and it's enormously helpful to understand the perspectives, particularly of the Europeans who are so much closer physically to what's going on. So that's an important channel for us.
Thank you. And Chair Powell, last week, the Fed published its 2022 Small Business Credit Survey. Among other things, the report found that small business applicants that used online lenders for their financing needs reported more challenges with their lenders than did applicants at other sources. The top challenges faced by borrowers from online lenders were high interest rates and unfavorable repayment terms. Can you explain the report's finding and what it could mean for small businesses that utilize online lenders to satisfy their financing needs?
So if I recall that survey, it did raise some interesting questions, and our people looked at it and actually saw differences in data gathering. So it's not clear that the data in the two surveys was comparable, but I do think it raises interesting questions, and we'll come back to your office on that.
And it might raise interesting question where we, through legislation, could provide some relief and regulations so that small businesses are not shortchanged when it comes to the most important element for any small business, access to capital, affordable capital. Chair Powell, during public remarks last month, Acting Comptroller of the Currency, Sue, stated that in the not too distant future, the OCC, Fed, and the FDIC will issue a joint notice of proposed rulemaking to update the Community Reinvestment Act. Does the Fed also believe a joint NPR is possible, and when do you expect it to be released?
Yes, we do. We think that will be ideal, and we're working very closely with the OCC and the FDIC and to come up with a consensus notice of proposed rulemaking reflecting all of the comments that we got on our advance notice of proposed rulemaking. I think the timing is soon. I wouldn't want to put a specific date, but I know that we're going back and forth, and it feels like we're getting very close.
Right, thank you. And Chair Powell, a note published by a Credit Suisse strategist over the weekend warns that a decision to exclude certain Russian banks from the SWIFT system, which I support, could result in missed payments and giant overdraft with significant consequences for money markets, thereby forcing the Fed and other central banks to intervene to enhance liquidity to offset missed payments. Do you see this scenario as likely?
No, I don't see that as likely. Of course, we always appreciate looking at different risk scenarios. But again, given the relatively modest exposure that our banks have directly to Russia, and given the existing tools we have to provide liquidity, I don't see that as a likely outcome.
Okay, thank you. I yield back.
Thank you. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Madam Chairman, thank you very much. Chairman Powell, thank you for taking time to not only join us today, but your insight into monetary policy. The monetary policy report of February 25th, seemingly still hot off the press, brings about, I think, a good review of the Fed's analysis of where we are. And I know there's that temptation by members of Congress to hold you accountable for things which are not within your purview. But on page 3, you talk about special topics. Page 3 of your February 25th, 2022 monetary report. Special topics: low labor supply. Next, it goes to several other issues, then supply bottlenecks. As a member of Congress from Texas, both of these are highlighted to me on a daily basis as I receive feedback. This is inflationary also. We have taken a bit of time with you to probe with you your ideas that I think you have professionally handled on behalf of yourself and the Fed, the issues related to energy. But the bottom line is we can't get people back at work. We find that turns into a low labor supply, and then we've got bottlenecks. These are all hand in hand, glove in glove together, in my opinion. I took a few minutes just now to look at the labor unions and schools, teachers unions. But let's move to the federal government. Where is the federal government on their employees coming back to work now by OPM?
I don't know. We're an independent agency. I'll tell you where we are, which was we're in the middle of that process. Probably closer to the beginning than the middle.
I know you are, but you see, if they don't come to work, then others don't come to work. So I think your point and my point is well made. I believe that what we need is your robustness, not just your acumen in these issues, and your robustness within the administration to actually let them know that for this report, monetary policy, to be correct, that you believe inflation is a short-term, meaningful hindrance on our economy. They're going to have to make, meaning the White House, policy. They're going to have to understand what caused this. And I think that this administration, I think the Democratic Party, I think this Congress has made friends with inflation to encourage it. And that if your prognostication is going to come forth that we end this inflation, we're going to have serious changes. Because right now in Texas, which has been relatively open, I don't see relief on the horizon. And I think that this administration, this Congress has a lot to do with it. So without chastising you, I meant to help you. I would like for your voice in this administration and within halls of Congress, perhaps doors that are shut, for them to understand that they have actually made friends with and are continuing inflation, whether it be with teachers unions or whether it be with OPM. And we've got to get serious about getting people back to work, because as you tap down the amount of money that is put in the economy, as that moves, it's going to have to correspondingly have people that come to work, that pay taxes, that move the economy, GDP as a term we used earlier today. It's shifting this big, massive task. So you've almost got a whole 30 seconds left. But I'd like you, without defending yourself, to say to you, I'd like for your voice of reason, of prosperity, of future to come true as you would like. Did I ask you a question? Okay, I'm going to support you. I'm for you. How can we help you?
I do think honestly, we have the tools and we have to use them we will use them to get inflation under control. But to the extent we get help from the supply side, it'll make that job so much easier. It's about labor force supply. It's really about supply constraints and shortages and that kind of thing. It's also about exogenous events like a war, which will drive up the price of oil and gas, and that'll get into prices, certainly, and we'll make sure that it doesn't provoke a cycle of inflation.
This is what happens when you have to rely on other people for your food, cheese, and energy. Thank you very much, Mr. Chairman.
Thank you, Mr. Sessions. You can help Mr. Powell by asking your friends on the Senate side to confirm his appointment. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agriculture Committee, is now recognized for 5 minutes.
Chairman Powell, how are you?
Fine, thank you. How are you, Mr. Scott?
I want to sound the alarm here this morning. And I want you to listen to me, and I want the nation to, because I'm the chairman of our House Agriculture Committee. And I'm very worried about this turmoil over in Ukraine and Russia's violent, illegal, and criminal action that they're taking, and the impact that this has on global trade, and most importantly, our own food security. We could very well be on the verge of a hunger crisis all over this world. I want to share with you some research and the nation so we can understand what this Ukraine-Russia situation is causing. Today, Russia alone is producing more than 2/3 of the 20 million metric tons of fertilizer used to grow corn and wheat around the world. One country producing 66% of the fertilizer that is needed. And when you combine Ukraine and Russia, also, these are the two largest exporters of wheat, corn, and barley, producing 1/4 of the world's wheat in these two countries, making this impact a crisis of soaring magnitude when you have this much, and these two countries are warring each other. So I want to sound the alarm on this. I want to ask you this question. I want to ask you, Chairman Powell, the disruptions and rising prices from these commodities will destabilize global food markets and threaten our food stability and social stability. So my question to you, Mr. Chairman Powell, to what extent could these developments create a financial stability risk here at home and abroad? And what must we do? We can go without a lot of things in this world, but the one thing we cannot go without is food. And when you have this much power on our food security for the world in the hands of these two countries warring at each other at this time, what can you do about it?
Sir, I think your point is very well taken, and I think it's shipping, it's corn, it's wheat, as you pointed out, it's fertilizer, and we see that getting into food prices and into the food supply just in these early days after the sanctions have been put in place in the war, less than 2 weeks old now. The Fed doesn't really have the tools to address this. This is really a matter for Congress and the administration, I think. But you're right to call attention to it, and I do think that this is understood and understood that that help will be needed here.
Well, I just want to say that we cannot allow the world to get into this desperate situation. So I'm giving this as sort of a Paul Revere moment here. I'm not saying the British are coming, but I'm saying the Russians are already at the door, and they could cause worldwide hunger. And I hope that free nations around the world can come together and realize that this is not just Ukraine's fight. It's our fight. And we have got to win this fight. And hopefully we can get more of our nations to come together and end this situation in Ukraine and Russia before it causes truly a worldwide war.
Thank you very much. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Chair Powell, when your former deputy, Mr. Quarles, came before the committee last May, I pointed out to him that just a week before the April inflation rate had been reported at 4.2%, the highest since 2009, the rate in March 2021 had been only 2.6%. I asked him if we were paying the price for monetizing a huge federal debt, what the late Dr. Friedman and former Chair Bernanke both called helicopter money. Mr. Quarles told me that he didn't believe the Federal Reserve was monetizing the debt. Mr. Chair, looking back a year, does the Fed continue to deny that it has been monetizing the debt? And do you believe that you should have acted before now to rein in the inflation rather than let it now exceed 7.5%, the highest rate since 1982?
So I think by monetizing the debt, what that means is for the central bank to purchase the debt with the intention of holding it. And that's not the intention of here. You know, we're about to start shrinking the balance sheet, and we will return the balance sheet to, you know, a size relative to our economy that it was before. So also that is not at all our intention. We purchase longer-term securities in order to drive down longer-term interest rates to support economic activity. I'd also say that that's not really what we think of as the source of inflation. Admitting that inflation, proclaiming that inflation is far too high and that we are committed to using our tools to get it back down, it's really about very, very high demand, particularly in the goods sector, related to a spending shift that happened in the pandemic, and supply constraints that we didn't foresee. International supply chains, labor constraints, low labor force participation, right across the economy. It's a very different kind of inflation story than we've had in the past, but it's one that we have to deal with, and we will deal with it.
Chair Powell, when you appeared before this committee in March of last year, and I asked you to clarify the purpose of the Federal Reserve collecting data and employing stress tests related to climate change, you assured us that the Federal Reserve would be collecting the information to help financial institutions learn about climate risk and wouldn't be using the information for regulatory purposes. In recent weeks, considerable controversy has emerged in the confirmation process to fill 4 vacant seats on the Federal Reserve Board. One of the nominees has a record of advocating for aggressive Federal Reserve regulation related to climate change, including actions that would regulate capital allocation away from fossil fuels. I won't ask you to comment on the confirmation process, but can you continue to assure us that the climate data and stress test proposed by the Federal Reserve won't be used for regulatory purposes and driving investment away from traditional energy sources here?
We call them climate stress scenarios, and we haven't, we're actually just building the capability to do this. And the idea is not to use them the way that we use the traditional stress tests to set capital levels, in effect. The idea is more to allow financial institutions and also regulators to understand better, the extent to which and the ways in which climate financial risks has any implications for the banks. That's the purpose of it. I'll add, though, that it is not our job to tell, we don't think, to tell banks which legal companies they can and can't lend to, and I don't see that as an appropriate role for us.
I'm really glad to hear that. So that's an absolute, unequivocal, guaranteed answer that the data will not be used for regulatory purposes in any way whatsoever.
I can just say that, first of all, we're not even doing the tests yet, or scenarios yet. But certainly that's not going to be their construct. The construct will be what I said, which is to help us understand better, not to set capital or otherwise put further regulatory requirements on. Okay.
Thank you so very much. I deeply, deeply appreciate that, and I yield back. Thank you.
Thank you very much. The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Good morning, Mr. Powell. How are you?
Fine, how are you?
I'm good. And I just want to thank you. You've been getting picked on inflation, but I'd like to start with chart 1 of your book. I always ask about your charts because I love them. And chart 1 shows a tremendous growth in employment, as does chart 2 shows a tremendous drop in unemployment, the converse of it. And it's like dropped from about 14% to 4%. Do you think that the Fed's monetary policy helped in reducing the unemployment rate?
Yes, for sure.
Okay. And, 2 years ago, we were going into a pandemic, and you and I had a conversation about the potential for a worldwide recession of a magnitude we'd never seen. Did we hit that? Did we get that recession?
No, we didn't.
And you may recall, I'm a bankruptcy lawyer. That's what so I look at things kind of with the pessimist eye. I expected many bankruptcies. Did we have those? Did we have the bankruptcies that we thought we might get?
We sure didn't.
Okay. Do you have any idea how much the gross domestic product has grown in the last year?
I want to say 5-point-something%.
Well, it's actually more than that. And one of your charts has that, I think it's on page 23, chart 14. It's went from 2020 to now, it went from less than 17.5 trillion up to 20 trillion. So it's substantial, about 15%. Now, I don't think it's that much, but it's substantial. Did we expect that when we went into COVID?
You mean since the trough? Yeah. No,
yeah.
I was just giving you the last year. So, as you know, we were looking at some really bad scenarios and hoping they wouldn't happen in the first half of 2020.
Now, the Fed took some pretty dramatic actions, as did central banks around the world, did it not?
Yes.
Okay. And the Congress, led by the Democrats, took some pretty substantial and dramatic steps, including the CARES Act, the American Rescue Plan, the infrastructure bill, to build a better America and to help us get out of what looked like it could be a tremendous recession. Now, I could ask you, did it not, but I'm not going to lead you in that one. But what I do want to talk about is the fact that despite the one flaw that Republicans can find, which is inflation, we have lower unemployment, a bigger economy. Do you know how many other countries have higher inflation around the world than America? 64, according to Trade Economics Inflation of country by country. 64. This is a worldwide phenomena, is it not?
Yes, it is.
So I want you to take a look at a couple more of your charts, because I think these are probably the most important. And they are the median wage growth found in chart C on page 12, and the change in the price index for personal consumption on the next page, found on page 13, diagram 8. According to your chart on page 12, the bottom quarter of wage earners have had their wages increase by almost 9%. Do you see that?
Yes.
And the next quarter, by 6.5%, 7%. Do you see that?
Yes, I do.
Okay, and then you look over to the next page, and we're running, I think you said it, about 5.5% inflation. So wage earners in the bottom half are making more money than they are potentially, if I do the math, they're making anywhere 8-9% against a 5% increase in cost. Now, it's not apples to apples, but wages are going up, are they not?
So wages at the bottom, in the bottom quartile, have gone up in real terms. I do not think that's true for the second, third, and fourth quartiles, but it is true for the bottom quartile that their wages, nominal wages, have gone up higher, more than inflation.
Okay. So last question. When you and I spoke at the beginning of this year, and my time has expired, I'll ask it to you later on. And I thank you for your service, sir. I thank you for keeping us out of a recession. I think we built a better America by staying out of the recession. I yield back.
Thank you so much. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thank you, Chairman Powell, for coming here. And I also appreciate your book and the work. And frankly, just yet again want to highlight the really heroic work that the Federal Reserve did to create stable markets, particularly in March and April of 2020. Since then, of course, there have been a lot of economic distortions, one of which is the ongoing inability of the Federal Reserve to stabilize its own balance sheet, which is now over $9 trillion. I appreciate Mr. Perlmutter highlighting some of the good news. And frankly, I'm positive that he has previously operated a lemonade stand, because he can always turn something good out of the lemons. So there's no good news, but the concern is that in the long term, this has come at the expense of sound money. And so just over a year ago, I talked to you about sound money, and as the U.S. dollar represents sound money, because many of us anticipated that inflation was not transitory, and that the quantity theory of money might have some impact on inflation. So in light of the fact that we have seen substantial change in the rate of inflation now versus what was showing up then but was anticipated, do you still think that the U.S. dollar is sound money? And either way, what are the threats to the U.S. dollar as sound money?
The U.S. dollar is sound money, yes. The threats to the U.S. dollar as the reserve currency really, in the near term, are to displace the U.S. dollar as the reserve currency, if that's your question. You need to be a very attractive place to hold large amounts of reserves.
It's really different than that, because we are probably still going to be the reserve currency, since the world grades on a curve, and frankly, the planet's never had this much debt since World War II. So all of the countries around the world did similar things. The discipline of the Bretton Woods era was gold. I don't know that there's magic just in gold, but there is magic in discipline. So if you look at sound money being defined by a stable store of value, an efficient means of exchange, and a trusted record of an account, you've at least taken some dings on store of value. And so as you've seen people decide to filter transactions and develop technology and regulatory frameworks that are intended to be able to filter transactions, it's not as trusted or efficient as a means of exchange or a record of account. And so those kinds of things, not so much do we do okay on the curve, but is it truly sound?
Yeah, I'm not sure I followed the last part, but I do think that, look, inflation is indisputably too high. We are using our tools to bring inflation back down to levels of price stability, and we will accomplish that task. Longer term, the U.S. dollar is, is easily the best currency, and it's because of what I just said. It's also because of the rule of law and the fact that we're the incumbent, and we, as long as we observe the rule of law and keep the dollar relatively, keep inflation low and predictable, that will remain the reserve currency.
Yeah, okay, so thank you, Chairman. And look, historically, there have been multiple reserve currencies, and generally, when something loses its status as reserve currency, it's not just because of other things that unfold, but it's because the value is debased. And we can come up with fancy words like modern monetary theory or quantitative easing or, similar to quantitative easing, but not really the same. When the Federal Reserve's balance sheet's growing, in a way it represents the Fed as the lender of last resort. We're not constrained by the taxes we collect. We're not even constrained by the amount of money the world will lend us. We're constrained only by the will of Congress to not spend more. And what are you going to do? Not cover the spending, the prolific spending by Congress. So moving on, just talking about, the Fed's role, of course, stable prices is really one component. The other is full employment. And I wonder if you think, in light of Mr. Perlmutter's reference to Chart 2, if Chart 4, which is the labor force participation rate, trends the right way. And as you link to the next thing, as a regulator, there's a lot of pressure for you to do ESG. What can the Fed do, and what does Congress need to do to strike those balances?
With relative to ESG?
And full employment.
Well, full employment, I think most members of the FOMC now think we are at labor market conditions that are consistent with maximum employment.
With 60% labor force participation, 62?
I mean, the maximum employment can never be higher than the level that's consistent with price stability.
The gentleman's time has expired.
I think we're at that level.
Thank you.
At least.
The gentleman from Illinois, Mr. Foster, who is also the chair of the task force on artificial intelligence, is now recognized for 5 minutes.
Thank you, Madam Chair. And I'd like to add to Representative Perlmutter's list of your triumphs the record level of small business formation. And so I think that when you try to preserve the very strong economic recovery, I realize you have a dual mandate, but keep an eye on that one too. It's one of the most important successes we don't talk about enough. Do you remember the misery index?
I do.
Yeah, and so that when unemployment drops from 14% to 4%, so drop by about 10%, and then the inflation goes from 2% to 7%, so up by 5%. Does that mean the misery index is increased or decreased?
It would be decreased.
So thank you for that. Now, you actually mentioned repeatedly that the inflation problem was largely one of goods and not so much one of demand and also of labor shortage. And so can you make any rough estimate of what fraction of the inflation we're seeing was due to sort of those three effects?
So I should be clear. Inflation is also too high in the service sector. I wouldn't want to oversell that. But the real big change has been in goods, which had negative inflation or close to zero inflation for 25 years. I don't have off the top of my head the ability to just tell you what the contribution of that is, but it's big, and it's a significant part of it. It's a lot of it also is energy, which is not
obviously a worldwide problem.
Yeah,
and so that this is, if you could get back something a little more quantitative from your staff on that, I'd just be really interested in knowing your estimate. Now, in terms of the labor shortage, back in the days when we had a different Senate, they passed comprehensive immigration reform that was then, of course, blocked by Republicans. And many studies at the time indicated it would be a huge positive for our economy to pass comprehensive immigration reform. And that was at a time which didn't have an extraordinarily tight labor market. Is there anything you can think of that would invalidate those studies that showed that comprehensive immigration reform in both the low skill and the high skill sectors would be a huge plus? if it was passed?
If I can answer that this way, if you look back at the trend, let's say 5 years ago in that range of immigration, legal immigration, people coming in, and look where we are now. We're now several million people, many of whom would be in the workforce short of that. So lower immigration is definitely part of the story of the labor shortage. But that's what I would say.
And so is there anything quantitative you can say about the time scale for unwinding the balance sheet? Do you think of this in terms of a fixed time scale that we want to go back to normal in the next 2 years, 3 years, or do you say we're going to take it down by 1%, 1% a month, or you anticipate some sort of feedback loop? Well, we look at the taper tantrums or the equivalent and sort of adjust it as you go.
So the way we did it last time is we set a cap on the amount that will run off, and anything above that gets reinvested for both MBS, mortgage-backed securities, and for treasuries. We haven't had that discussion at the committee. We will have it in 2 weeks. But I guess it takes, it turns out that the level of the cap doesn't really matter that much for how long it takes, something in the range of 3 years to get back to where you're trying to get to. And the way we define that, what is the end? We look at the size of the economy, the size of the banking system, and we ask, what's the level of reserves that we'll need at that point? And so we set a course for that place, and then as we start to get close to it, we might slow down a little bit, like as though it were an airplane, and that's the way it will work. But I think something in the range of 3 years to get back to what the balance sheet needs to be, which is basically reflective of the public's demand for our liabilities plus a buffer, and what we call ample reserves.
Yeah. Do you have an estimate for how many hours of your life have been spent attempting to explain the difference between quantitative easing and monetizing the debt to members of Congress?
No, sir.
Okay. All right. Now, one of the most valuable functions of the Fed is to provide the emergency assistance to the financial systems of the free world. And you mentioned that you stood ready. Are there specific things you're worried about in Eastern Europe where the economies are more tightly tied to Russia, where you may really have to step in and get involved? Any specific worries?
What we're watching is sort of the global markets and the dollar funding market, and we're seeing markets that are functioning, and of course we have tools and we have things in place to deal with stresses should they emerge. That's really what we're doing, and as I mentioned, markets are functioning, so we haven't had to deploy any of those tools.
Thank you, and my time's up. I yield back.
Thank you. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. Good to see you again. We're in the middle right here of a really disastrous situation with Ukraine, and the part of the approach to corralling the Russian advance there is on the financial side. And it would appear to me that we probably didn't do this as quickly as we should have. Didn't look to me like we had a plan. If we really wanted to get involved financially, we should have been sitting here saying when they move the 1st battalion or regiment or wherever amount of troops you want to talk about on the border, we should have said something, well, okay, if you move another one there, we're going to start doing things to you. And we didn't do that until they started to invade. And now all of a sudden we're playing catch up. So that begs the question, we know that China is watching all of these actions very, very carefully. They're looking at what Russia does, how we react, what we do, how the rest of the world reacts, what they do. So to me, we need to be sitting here as a country, as the Fed, as congressional individuals saying, we need to be ready for the Chinese when they invade Taiwan, because I see no reason why they will not do that shortly. So if we don't prepare for that, shame on us. So my question to you is, are you beginning to think about what kind of actions you would take, or support, or suggest to the administration should China take over Taiwan or attempt to do this? Because this is going to be a completely different scenario because of the size of China, the size of the military, the size of Taiwan versus getting into Eastern Europe. So that's kind of a large question, but can you like to jump into it?
Sure. So, you know, I mean, those questions are really questions that are dealt with at the National Security Council and the Defense Department and the intelligence agencies and the Treasury Department. You know, we're interested students of all that, and we have our technical expertise that we can contribute, but honestly, we're not, you know.
Well, Mr. Chairman, now, I listened to you very carefully a while ago, and you made the comment that you're looking at making policy for anticipated situations in the coming months with regards to a number of things. What happens with the economy, what happens with inflation. And so if you're not doing that, I understand you may not want to tell me today because that would be helping the Chinese who are probably watching this right now. I understand that. But just a sort of wink and nod to say, yeah, we're looking at that would certainly be nice because it will give us a level of comfort to know that we're not going to be, you know, behind the eight ball again.
Well, I mean, as I also mentioned, we do model alternative scenarios of various kinds. And, you know, we, in fact, with every Teal book, which is our document that we use at the FOMC, we run half a dozen of them in great detail, and people study those, and it helps them think about alternatives. So I'll just leave it at that, if I could.
Okay, thank you. I'll let you off the hook on that one. With regards to inflation, we've talked about it significantly here today, and I think sometimes that you're giving way too much credit for it and giving way too much criticism for it. I think that there are a lot of things that are outside your control that happen that basically affect inflation that you have to react to. You don't make monetary policy from the administration side. You don't make legislative policy from the legislative side, and yet you have to react to all those things. So I had an economist, I'm the ranking on small business, I had economists come in to talk to our committee the other day. And I asked him to break down the different causes of inflation. And I said, well, let me identify at least what I think are four significant causes. One is money supply, the amount of money that's pumped in, either through Fed actions or through our actions as Congress, regulations, supply chain / workforce situations, and energy. And he broke it down like this, and he had some charts, and he started going off, and I said, just give me the percentages. And so he said, roughly 40% due to money supply, the money that goes in as a result of Fed actions or congressional actions, 20% regulations, 20% supply chain, and 20% energy. So if you look at that, and I know Mr. Foster, while ago, was looking for some answers, so hopefully I've helped him with this question. If you look at that, basically you don't have a lot of control over regulations, you don't have a lot of control over supply chain, and no control over energy policy. And money supply, if the Congress gets involved and passes these massive bills and throws a lot of money in there, you haven't control of that either. So the amount of control over this is probably in the neighborhood of 20 to 40% at best. So, you know, my concern is that when you say that you're trying to help things with inflation, it really goes back to the administration and to us as Congress. You know, the administration, first thing they did was stop the pipeline, stop oil drilling, and prices went up. And so that right there is 20%. So it's important, I think, that we understand that. I'd like for you to comment, if you would, just for a second. I'm running out of time. If you'd like to comment.
Sure. Yeah, interesting breakdown. We can continue this discussion. You know, we would have a little different assessment. I would just say, though, we welcome, you know, this is a lot about supply side issues, and we welcome any help we can get on that, and we're looking for help from improved supply side.
Okay.
Thank you very much. The gentleman's time has expired. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
You know, Douglas Holtz-Eakin.
Thank you, Madam Chair, and Chairman Powell. Welcome to the committee. Before I ask my question or statement, they say one of the benefits of inflation is that you can live in a more expensive neighborhood without moving. And so I thought that was very interesting.
That's a good one.
Statement I had seen, and I thought I would bring it to your attention. You know, according to the recent analysis of branch closures by the National Community Reinvestment Coalition between 2017 and 2021, banks have closed as many as 7,000 branches across this country, 1/3 of which was in low-income and moderate-income communities, neighborhoods of color. To what extent is the Fed considering these banks as in contemplating which reform to implement and strengthening the Community Reinvestment Act and the importance that banks branches play for nearby communities.
So I do think that's a focus of the CRA and also of the focus that we want to strengthen in our proposal that's out for comment. Actually, it's now, we've had the comments and we're getting ready to put a notice of proposed rulemaking out. But we do understand the importance of presence in the community and service to the community, and those things do go into our CRA assessments.
Okay. Mr. Powell, according to the latest forecast from Goldman Sachs and the Federal Reserve, which raised interest rate more than expected this year due to high inflation and labor market approaching full employment, can you speak more on this? Should we expect the Fed to raise interest rate at all several remaining pilot meetings this year? And should we expect the Fed's main rates to be by the end of this year?
So yes, so the inflation is running well above our target. The labor market is extremely tight. The economy is growing strongly, and our policy rate, we do expect to move our policy rate up in a series of rate increases this year, away from the very low setting that we put into place during the acute phase of the pandemic, and to a more appropriate level, given the fast recovery and the strong recovery that the economy has had, given the fact that inflation is running so far above our target. We do expect that will be appropriate. We've communicated that transparently and clearly, and markets have accepted it, and it is our plan to return to price stability while also supporting a continued expansion.
Okay, and I want to make sure that I understood the statement that was made earlier, and I know you had the opportunity to observe other inflations that we've had. With wages going up, as they say, and the bottom half are making more in earning, do you consider that we are in a better situation to deal with inflation that we have now compared to inflation in the past?
I think that this inflation is substantially higher than anything we've seen since I was in college, 50 years ago. So this is strong, high inflation, and it's very important that we get on top of it, and that's exactly what we're going to do. I would say this: the labor market is extremely strong. So from that standpoint, I do think we're in a good place. From the standpoint of trying to get inflation under control, workers are still going to be getting good jobs and pay increases for some time, so the economy is strong, and that means the economy can take the rate increases that we're going to be making. Ultimately, we need to get demand and supply back in alignment so that we can get inflation back to a more appropriate level.
Okay, thank you, sir. And with that, I yield back, Madam Chair.
The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair. And Chair Powell, I appreciate this opportunity. I'm actually going to pick up on what my colleague from Florida was just talking about and add that to what my colleague from Missouri next to me here was talking about. And you may have said that the 40-20-20-20 ratio that came from Douglas Holtz-Aiken, breaking that down, about 40% of inflation being tied to monetary policy and spending, 20% to regs, 20% energy policy, 20% supply chain. You might disagree with that, is what you had said, but do you believe that spending has contributed to the situation of high inflation that we are in?
Okay, thank you.
So I may have misunderstood what your colleague said about.
Madam Chair, I ask that you suspend. I think Mr. Lawson has his microphone on yet, and we're getting a little crosstalk. So if we can maybe add a few seconds back here.
Okay. Is the gentleman muted now?
No, clearly is not.
I think you can resume.
Okay, I'm just like to, would ask that you have a light gavel at the end of my time here. I think we were having a little crosstalk as we have to go back on that.
So I may have misunderstood. I thought that the 40% was money supply, but you made it sound more like a monetary policy. And so I would, look, I mean, look, we can discuss those numbers, but that makes more sense to me.
Point being, has spending contributed to inflation?
Yes, I think a number of factors have, including fiscal policy.
And I would agree with that. And, you know, frankly, many of us have sort of warned or talked about this situation. We have record debt right now, previously without conflict. Now, war and rumors of war that we hope aren't going to happen may even increase that debt. And I'm afraid that our spending habits are putting you and all policy decision makers in an even tighter box. Look, we all know that inflation is real. It's hitting, whether it's gas, $3.79 versus $2.74 a year ago, groceries, you name it, housing. And when you were here in July, I talked about the housing situation. My family's in construction and what that means. And we can't just magically wave a wand and say, oh, we're going to lower prices. That just simply isn't realistic. But what I heard last night is that the president is acknowledging people are living paycheck to paycheck, and he understands that. Yet the message I keep hearing from the president and my friends on the other side of the aisle is we need to spend even more. And I'm concerned that is going to put us, again, into an even tighter box than we currently are. If you care to touch on that before I move on.
I should stay away from fiscal policy if you don't.
Well, and look, I'm not asking whether you support a particular bill or not. Theoretically, we're your classroom. America's your classroom as they're watching this right now. Spending is a contributing factor to inflation, correct?
It is, but it's not really our job and not ours to comment on. We do have a role here, and we need to do it.
Fully understand that. I just the facts. That's all right. So I'm going to move on to another issue, which is rules-based approach to monetary policy. In the 114th Congress, I think it was in 2015, I introduced the Fomc, which would lay out a rules-based monetary policy. And I know in your testimony today indicated that a rate increase is expected, and you confirmed that with the ranking member. So what I'm curious, though, is since 2017, the Fed's monetary policy report included a section on monetary policy rules. And you've been very clear, and now Secretary Yellen has been clear that a lot of rules are modeled and looked at. The only exception to this was 2020, the first year of the pandemic, and maybe more surprisingly, the report that was just released this month. For example, in 2017, monetary policy rules section of the report stated, quote, monetary policymakers consider a wide range of information on current economic conditions. It's not included in this report. Can you shed some light on why it was omitted this year?
I honestly didn't know if that was the case, or if someone talked to me about this before the thing was printed and sent up here. I don't remember it. That's also a real possibility given the number of things I have on my mind right now. But as you say, we didn't have it in July of 20. We'll have it in the next one. I don't think there was no big thought, as far as I know, going into that. It's just sometimes we include it, sometimes we don't. I will say that I think thinking about policy through rules is something that I learned a lot about monetary policy doing that. When you're actually implementing policy, no committee has ever really used policy rules as a way of setting policy, but they use them to inform your thinking.
Yes, and I guess my idea with the Fomc was to then inform the market, and that includes us as citizens as well. And I'd like this committee to re-examine that. So I appreciate the indulgence, Madam Chair, as we had that crosstalk at the beginning, and I yield back.
Thank you. The gentleman from Illinois, Mr. Caston, who is also the Vice Chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Pro Tem Powell. You know, I'm always struck that there's a real risk of hubris for those of us in our line of work, at least up here. If we get to write laws, sometimes we conclude that that means we can write the laws of physics as well, which is dangerous. And I am troubled by some of the questioning of my colleagues and, you know, some of the debates around confirmation of your colleagues around climate change. The IPCC report that came out last week said climate change effects are outpacing our ability to adapt. We're seeing communities that sort of simultaneously have droughts, floods, and fires, and money is moving in surprising ways. We've seen, personally, I've seen stories just in the last month of one coastal community where the roads are being washed out that haven't yet paid off the bonds that were used to pay for the road, and they don't know how to reconnect those communities. Another community on the coast where the mayor is sitting there realizing that one neighborhood he can afford to build a seawall, and in another neighborhood it's cheaper to relocate people, and dealing with the political fallout of that decision. We have massive political risks that are coming, and we know they are coming because the laws of physics do not care how we vote. And I'm concerned by your response to Mr. Posey when you said that I think you said we've not even done the scenarios yet, excuse me, on the climate change. And I understand these are complicated, but if those scenarios haven't been done, I want to start, you know, if we don't deal with the financial fallout, the political fallout's going to be far worse. And so I just want to start with a very specific question. NOAA and NASA came out with a report, I think last week or 2 weeks ago, saying that Florida is looking at 12 inches of sea level rise in the next 10 to 20 years and 18 inches by 2050. That means that there are whole communities in Florida where there's going to be complete property loss before a 30-year mortgage is repaid that was issued today. Are Fannie and Freddie changing their lending standards in response to those risks in those communities in Florida and elsewhere that are now within 30 years of being unable to repay those notes?
I don't know.
I asked the question there because in the CFTC report, Managing Climate Risk in the Financial Sector, came out about 2 years ago. They noted that the higher an area risk for coastal flooding, the more likely the commercial banks are to be offloading their risks onto Fannie and Freddie. And so if the sophisticated players in the system are seeing this risk and we are at a federal level are backstopping, how are we isolating our federal balance sheet from that risk exposure?
I think that's a very likely outcome, actually. I think as private lenders will move away from that, and will the government force people to move away from the coast, or will they wind up government, that's us, wind up picking up the tab? More likely the latter, it seems to me.
So moving away from the offloading risk onto the taxpayer, back when I was in the energy industry, one of the tells that we had that we knew there was a downturn coming in energy markets was when the big banks started creating Special Opportunity Fund 5. You know, and we all knew that was code for taking your Dodd-Frank compliance debt capital, moving it into an equity pool, and selling it off to the least sophisticated people in the equity space. We all know, anybody who spent time in the banking industry has seen that game. To what degree does the Fed or the Treasury have the ability to monitor where the sophisticated folks who are seeing this coming are shifting the risk off to the less sophisticated folks in the private sector?
You know, there's a lot of thinking going on about this. I'd have to think about that. But there's a lot of thinking about what will happen over longer periods of time in coastal areas and things like that. I can look into that for you.
Well, and it's not just coastal, right? I mean, it's California fire risk. Do you rebuild that house where the fire is, and who's holding the paper, if it burns the second time before it's paid off? It's drought risk in communities, running away, the capital movements. And to be clear, we are going to create so much wealth in the transition to a clean economy that I think we can find more winners than losers if we're smart about this. But there's this huge capital flight, and the nervousness I get is, as I said, partly that we're shifting risk onto the public sector, and partly that if we don't have a real good understanding of what the capital structure looks like in these communities, we're not seeing it. As you know, Senator Schatz and I have introduced this bill to push and encourage you and your colleagues to do these climate, whatever we're talking about, scenario analyses. But we know the sophisticated people are going to offload the risk. And as the IPCC report said, the effects are outpacing our ability to adapt, and we need to get ahead of this much quicker.
I would want you to know we are working on the scenarios. It's just, it's an active effort on our part.
Well, let us know how we can help you, make sure you have the resources to move a lot quicker. Thank you, and I yield back.
Thanks.
Thank you. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Good to see you again, and thank you for your testimony today. I appreciate your testimony that overspending has contributed to the inflation crisis we're facing right now, but I also appreciate your humility with respect to the Fed failing to meet its price stability mandate, and the fact that you admit that inflation is primarily a monetary policy phenomenon. So I want to focus on monetary policy in my questioning. And I know you understand that this has human costs. I want to share a couple of anecdotes from my district. A painter, Gerald Holland from Nicholasville, Kentucky, says a gallon of paint costs $10 more today than a year ago. The Suffaletta family from Georgetown, Kentucky, they've been in the retail home furnishing business since the late 1940s. In a conversation last week, they informed me that in the last year, the cost of goods from their manufacturers have increased 30 to 40%. And they're still receiving price increase letters every week. And like most small businesses, their cost of labor and overhead have gone up over 25%. So now they are having to determine how to operate without passing those costs on to the end consumer and still have some profits left at the end of the year. I could share dozens, as many of my colleagues could share dozens of these kinds of stories, including from constituents on fixed incomes who cannot afford the dramatic reduction in their purchasing power. Before November 2021, Chairman Powell, when you declared it was time to retire the word transitory in relation to inflation, my colleagues and I repeatedly in these hearings last year, after the $2 trillion spending bill, we cautioned you that inflation wasn't transitory, that we were hearing from our constituents, individuals and small businesses, that inflation was hitting them hard and was sticky. But the FOMC kept up with the unconventional monetary policy. And even after you retired the word transitory, as late as February 2022, the Fed was continuing its QE liquidity injections, even though inflation was at a 7.5% 40-year high, and the Fed had rejected an immediately halt to QE at both its December and January policy meetings. This week, economist Mohammed El-Arian published an op-ed in which he states that the Fed's insistence that inflation was transitory is, quote, an error that will likely be remembered as one of its biggest ever. And pardon me for contributing to your humility on that. But my question is, has the FOMC learned from its mistake? Has it learned that unconventional monetary policy at a time when it's not needed is harmful for the economy? Has it learned that QE during a time of recovery is a recipe for inflation? And has it learned that we cannot print our way to prosperity?
Well, I think the main thing we've learned is that the supply side constraints that we saw were not as transitory as we had hoped and thought. And as I mentioned, every other mainstream economists and central banks around the world made the same mistake. That doesn't excuse it, but we thought that these things would be resolved long ago.
Does the FOMC, do you and your colleagues concede now, in hindsight, that the overly accommodated monetary stance for too long was a mistake, a monetary policy mistake?
So I'll just answer for myself. You know, that's for other people to assess. I would say that we had an expectation, and as I said earlier, I thought that always thought there was a chance we'd be wrong, and that if we were wrong, we'd be able to pivot. And we did pivot, and we pivoted pretty quickly, but by then the economy really was moving very, very fast.
Well, on the pivot, how quickly do you expect a higher Fed funds rate, removing the accommodation, to bring down inflation, and how does that affect the pace at which you will tighten?
Well, I expect, as I mentioned, I expect the Fed funds rate to go up in 2 weeks, and I expect a series of rate increases this year, but as I mentioned earlier, given the current situation, we're going to move, carefully.
But my concern is that to break this inflation fever now, you don't have a lot of good options. It's going to take some aggressive tightening in order to break a historically high inflation level. So, but not to belabor the point, just real quick, final time on the climate stress testing. Last year, in response to my questions about the Fed's decisions to join the Network for Greening the Financial System, you affirmed that the Fed's job was not to combat climate change. But in your confirmation hearing, you said that, quote, we are looking at climate stress tests. This will be a key tool going forward. To clarify, what is it? Is it is it that you will not use this, as Mr. Posey asked you, to support capital surcharges for banks serving fossil energy companies?
That's not the design or intent of the stress scenarios that we're working on right now. It is really to assist us and financial institutions who are doing these things themselves very actively, the larger ones, to understand the risks.
Well, my time has expired, but as we look at a global energy crisis with the Ukraine invasion,
gentleman's time has
critically
expired.
important we don't redirect capital.
The gentleman from Massachusetts, Mr. Lynch, who is also the chair of the task force on financial technology, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for your service and your great work. I do want to ask you a question about the SWIFT network. And I realize that the sanctions piece of this is owned by Treasury, but I'm curious if in any of your risk analyses, you've looked at the possibility that if we did completely ban Russian banks from use of the SWIFT network, and it became a target of the Russian cyber forces, have we basically gamed that out, how that might happen, and do we feel comfortable that structurally and architecturally that SWIFT network would be able to resist a state-sponsored assault on that messaging service?
I'm sorry, Mr. Lynch. I'm really not the right person to answer that question. That's really a question that our Treasury Department or and our administration more broadly and the intelligence groups would be able to address.
I'm a little surprised at that because earlier in your question you talked about cybersecurity and how that was in your lane in part, but I'll let that go. You did mention the recent Fed report on CBDC, and in that report, it more or less pushed responsibility back to Congress to resolve some of the major issues around the creation of a Fed CBDC, and I know that we have a working group at MIT and the Boston Fed that are doing great work on this. It started under Chairman Gensler, but now I believe Neha Narula is running that effort. In all honesty, I'm not sure that Congress is equipped by itself to make those key decisions around architecture and the shape and form of any CBDC for the United States. And, I think we are relying on yourselves at the Fed and Treasury to help us. And so I was hoping for a little bit more instruction with the Fed paper. And is there any way we could collaborate rather than pushing the responsibility on Congress with all the other issues we've got to deal with, and also with the disparity in background in dealing with CBDC and those crypto issues?
So let me address that. So what the great people in Boston are doing is really technical experimentation around how you would build a CBDC if you were going to do one, looking at different structures and options and technologies. And so that's separate from the policy questions of whether we should do this. So what we're thinking of how we're thinking of this is there's technical experimentation, there's all the technology questions that have to be solved, but there are also the policy questions of should we do this and why and how and what should be the structure and that kind of thing. So we'll be working on this project in coming years, and we hope building trust in Congress and in the public that we're doing it as a fair, honest, independent group who really is just looking out for the best interests of the country and of our citizens, and we'll be making recommendations on the appropriate structure if we do come to make a recommendation. The point is, though, that we you know, our existing statute doesn't really contemplate a central bank digital currency. So we would need, ideally, we would get legislation that would be authorizing legislation, and we would take part in it. It's not that we'd be asking Congress to start this from scratch and figure out all the answers. We would be working with you to build trust in our process and ultimately come to you with a proposal, and then Congress would work its do its work and authorize.
Thank you. But Mr. Chairman, the concern is that the architecture and the security of the system will guide policy. So I believe we need to work together. But thank you. And Madam Chair, I yield back.
No, I would agree.
Thank you. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for being here. It's always good to have you come before the committee. There hasn't been a Federal Reserve chairman since Paul Volcker in the 80s that has dealt with inflation at these levels that we talk about today. And historically, the Fed has been unable to reduce prices without sending our economy into a recession. And to further complicate the situation, the central bank has previously never had to deal with winding down such aggressive asset purchases to go along with increasing interest rates. You are going to have to take action on both of these pressing issues with the backdrop of what we see in Ukraine, between the Russians and the Ukraine, and the general global instability that we have. So needless to say, you have a very tough job ahead of you. So, Chairman, how do you plan on getting inflation under control without completely hampering growth or worse, causing the economy to go into a recession?
So that is exactly our objective. We're going to use our tools. We're going to raise our interest rates, and we're going to shrink our balance sheet over the course of this year. As I mentioned, during this critical phase of global events, we're going to do that with care, and we'll always move with care, but particularly now. And that's how it works. We remove accommodation, and the very high levels of demand that are to some extent a result of our accommodative policy. Those rates will go up. And take housing, for example. The housing market should cool off. It's very, very hot right now, and that should happen broadly in the economy over time. We talk about getting to neutral, which is a neutral rate, which would be somewhere between 2 and 2.5%. It may well be that we need to go higher than that. We just don't know, and we don't know what events will intervene in the meantime. But we haven't faced this challenge in a long time, but we all know the history, and we all know what we need to do. I also do think, and I think it's more likely than not, that we can achieve what we call a soft landing, and they're far more common in our history than is generally understood, and that would be what you described, which is get inflation back under control without a recession.
Yeah. Well, some of us in this room remember the 80s.
Sorry? Yeah.
Some of us in this room remember the 80s and what it was like. We know that there is a lag period between the Federal Reserve's actions and the inflammatory implications being felt in the economy. The San Francisco Fed, which we've mentioned today, admits that this latency period could last anywhere from 3 months to 3 years. And for families and business owners like myself, 3 years would be an extremely long time to deal with prices in these elevated levels. So, Mr. Chairman, when the Fed eventually decides to raise interest rates, what tools will you have at your disposal to ensure your actions are felt with as little a delay as possible, so we can once again have price stability like we've talked about?
In this world that we live in now, when we make a decision about interest rates, or frankly even talk about a decision to raise interest rates, markets pick it up like that. Financial conditions have already tightened. We haven't actually lifted off from zero, but as of a week ago, the market was pricing in, literally already reflected in financial conditions to some extent, 6 or 7 rate increases. Now, it's less than that now, and we haven't made decisions to do that yet, but our decisions get into financial conditions very quickly. It does take time, of course, for that to affect economic activity, and that's where you get 3 months to longer than that. I think by the end of a year, much of the effect is generally thought to be in. So, but that time period has already started because monetary policy really works through expectations, and we're now expecting rate increases, and they've already happened in effect, and we have to ratify them, of course.
Yeah, we're seeing them. Finally, in the past year, you have referenced productivity gains as being key to increase the living standards for American workers over time. Unfortunately, we've seen the Biden administration implement many new time-consuming regulations that are forcing businesses, again, like mine and others, away from productive activities. The American Action Forum conducted a study that estimated that new regulations from the Biden's first year in office will culminate in over 131 million new paperwork hours. So quickly, Mr. Chairman, can you discuss the correlation between the company's regulatory burden and the effect on productivity?
So it's been, I'm a little bit familiar with the research, and it's actually been it's been difficult to make those connections in research. But we know, as a practical matter, you know, we all want just the right amount of regulation, not too much. And to the extent you're spending resources unnecessarily, that'll hold you back.
Thank you very much, and I yield my time back, Madam Chair.
The gentleman from New York, Mr. Torters, is now recognized for 5 minutes.
Thank you, Madam Chair. During his State of the Union, President Biden reported that the U.S. has seen the fastest job growth in history. The U.S. has had the fastest economic growth in more than 4 decades, and the U.S. among advanced economies has had the fastest economic recovery from COVID. And so the inflation that we've seen is the consequence of a strong economy colliding with the supply chain disrupted by COVID-19. Given the Russian invasion of Ukraine and the inflationary pressures that could likely follow, is there a risk that raising interest rates could backfire, that it could cause a recession without actually reining in inflation? How significant is the risk of stagflation?
Well, there's several questions in there. So our goal, of course, is to raise interest rates in a way that restrains inflation and gets it back to levels that we would call consistent with price stability, and do that without while still sustaining an expansion and a strong labor market. That's our goal, and that's how we'll use our tools. There are no guarantees in life, but that is our intention and what we propose to do.
The U.S., as you know, has severely sanctioned Russia, and Russia is expected to engage in cyber retaliation. There are financial institutions, commercial banks that invest up to $1 billion every year in cybersecurity. How much does the Fed invest in its own cybersecurity every year?
I don't have a dollar amount for you, but it's quite substantial. We have very good cyber people, and at the reserve banks and at the board here in Washington. And as I mentioned a little earlier, we've been at a very highly elevated level of oversight on cyber issues since for several months now, as this event has increased, and we haven't seen any troubling incidents yet, but we remain on high alert.
The ability of the U.S. to hold rogue states like Russia accountable depends heavily on the SWIFT international payment system. In your view, how easily could China and Russia create an alternate messaging service that could seriously compete with SWIFT and seriously undermine the effectiveness of SWIFT sanctions?
I mean, that's an interesting question to speculate about. I think in the near term, that's not something you can create overnight. I know that China does have their system. It's really a question for the longer term and not for the immediate. It's not something you could do quickly like that, but let me think about that.
Fair enough. I have a question about stablecoin. The leading stablecoin issuers have chosen to peg their stablecoins to the U.S. dollar, which to me represents a vote of confidence that reinforces rather than challenges the status of the dollar as the world's reserve currency. The U.S. has no CBDC of its own and is unlikely to have one in the years to come. Do you believe, as I do, that dollar stablecoins can play a role in outcompeting China when it comes to digital currencies?
Well, I'll say it this way. I think there may well be a role for well-regulated stablecoins. I think there's the possibility over time, and this is not what we see right now, that they could be efficient and popular among consumers and things like that. I think in terms of helping us compete with China? I don't know, but possibly, yeah. I think.
I'm assuming it's better to have stable coins pegged to the dollar than to have stable coins pegged to China's currency or the currency of a separate country.
I would agree with you that, you know, in a way that is consistent with the role of the dollar. And, you know, most of the big stable coins are, of course, dollar-based.
I have a question about the Community Reinvestment Act. Even though the CRA exists to prevent racial discrimination in matters of lending, often referred to as redlining, regulators fail to consider race when enforcing the CRA. Do you think race should be considered?
So we went out with an advance notice of proposed rulemaking a couple of years ago. We took in a whole lot of comments and took those into account, and I think we're now sitting down with the OCC and the FDIC to come up with a notice of proposed rulemaking, and that's one of the issues that we are have been thinking very carefully about. And I don't have any announcement for you, but that's something that's going to come out of those conversations.
But you're open to considering it?
It's something we've been considering. We asked for comment on it.
Okay. That's the extent of my questioning. Thank you, Madam Chair.
Thank you. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Madam Chair. Appreciate the hearing. Mr. Chairman, thank you so much for coming back for your Humphrey Hawkins testimony, and we all wish you the best of luck as you complete the confirmation process in the Senate. I enjoyed hearing Mr. Kustoff from Tennessee talk about William McChesney Martin. And then actually he was talking about the 70s. I guess my friend from Kentucky, Mr. Barr, brought up William McChesney Martin. And it made me think about the 1970s, and you and I both started our business careers in that decade, where inflation was really considered the #1 economic concern in the United States and around the world. And Arthur Burns was your predecessor then. And I read recently a talk he gave called The Anguish of Central Banking. Have you heard of that before?
Yeah, it rings a bell.
Well, I commend it to you. It was delivered in 1979, so he was no longer the chairman, and he was reflecting on his tenure at the Fed and also on fiscal policy of the 60s and 70s. So I commend it to you and the Federal Open Market Committee and to my colleagues here on the committee. And with your permission, Madam Chair, I'd like to insert it in the record.
Without objection, such is the order.
It's a stark reminder that when we abandon fiscal discipline and our core financial principles instead embrace what I consider economically illiterate concepts like modern monetary theory, we get into economic anguish. And in this talk, Chairman Burns reflects on his own mistakes at the helm of the Fed, as well as the abandonment of conservative government finance, when Burns warns fear of immediate unemployment rather than fear of current or eventual inflation comes to dominate economic policymaking. And that was his warning to us, and I think it merits at this time. You said you don't want to go back to the 70s. In fact, you argued that's what we're trying to absolutely avoid. So I do encourage people to read this report because inflation is a thief. You answered a question to Mr. Hazanga from Michigan that you were not aware that in the 2022 monetary policy report that the rules section in the monetary policy was not included. Is that right?
I was aware of it a couple of days ago.
Okay.
What I said was I don't remember any prior discussion.
Right.
But that doesn't mean it didn't happen. It just means I didn't remember it.
Right. Well, in the FOMC meetings, do they still have a presentation, part of the staff presentation, sort of a trend analysis on using those rules that have been traditionally in the policy report? Does that still go on in FOMC meetings?
Yes, it does.
Yeah. So I think that's an indication that's probably best that it be included in the report. I was looking at some forecasting about the so-called Taylor rule dating to the 1990s, which you've testified on many times. Are you aware of what the Taylor rule would indicate now in its formula vis-a-vis the inflation that we have today?
Generally, yeah.
Do you know the range that?
High.
Yeah. The answer I saw was 9.55%, which doesn't mean it's right or wrong, but it's one of those indicators about how far off we are maybe in our funds rate targeting. So I'm glad to hear that you'll consider that being put back in the report.
I also wanted to raise the subject of the Fed mandate. You've taken some questions on that today, too. We've had legislation in the past to reconsider the 1977 approach Congress took in the middle of that inflation to have both price stability and full employment. And we've debated that in this committee before. And in my view, considering to the fiscal policy stimulus and the monetary policy that we've had in the last couple of years, we really have to focus on price stability. And in Congress, we're here to really prevent that kind of inflation. And I recognize, and I'm happy to say, it's both a fiscal responsibility and a monetary policy. And so I'm proposing that we go back to price stability. And we won't be alone. As I understand it, New Zealand, Canada, Australia, and the United Kingdom have that as their sole mandate, price stability. Is that your understanding, too, of those central banks?
Yes. I think the ECB, European Central Bank, so that will be a matter for Congress, obviously. Right. I would say if I were to show you monetary policy response to 5 central banks or 6 central banks, let's say, 3 of them would be like us, a dual mandate, and 3 of them would be just inflation, you wouldn't actually see any difference in their reaction function because they do have to look at resource utilization, which is employment, in order to determine policy. So we basically, you wind up with very similar answers.
Well, I thank you for your testimony, and again, wish you well in your final confirmation process. And Madam Chair, I yield back.
Thank you. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair. Chair Powell, it's good to see you again, sir. I would have preferred to congratulate. Hello? Can you hear me?
Yes, good to see you.
Oh, okay. Oh, thank you so much for being here. Of course, I would have preferred to be congratulating you on your reappointment to the Federal Reserve, but hopefully we can get that done. I did publish an op-ed this morning with Chairwoman Waters and Congressional Black Caucus Chairwoman Beatty and some of my African-American colleagues on the Financial Services Committee calling on Senator Toomey to return to the table and give you and the President, the other 4 nominees, the vote that you deserve. So let me ask you a simple yes or no we'll do here. Do you believe that the Federal Reserve would be better able to serve the American people if it had a fully staffed Board of Governors?
I want to thank you for your kind words and support, but I wouldn't want to comment directly or indirectly on the Senate. I'm a nominee, and I await the Senate's judgment, and I'd prefer not to get into that process other than as a nominee.
Okay, well, thank you, sir. Let me switch gears and talk for a moment about Russia. As we've discussed extensively today, Russia's invasion of Ukraine has consequences far beyond the geopolitical. We've discussed the potential systemic risks the invasion poses to global markets and the mechanisms to keep Russia isolated from the international economy for the duration of its illegal aggression. But I'm concerned about the potential systemic risk here at home. The European Central Bank has identified systemically important financial institutions with ties to Russian banks, and those institutions could potentially require assistance to live up to their obligations. So are there any U.S. institutions that you're monitoring that have outsized default risk as it pertains to the freezes on Russia's assets?
So basically, no. Our financial system and our financial institutions have relatively little exposure to Russia, and even the largest exposures that any of them has are not very big. So it would need to be exposures. It would need to be a second-order thing, whereby a foreign financial institution has exposures to Russia, but also has exposures to our banks, and we don't see that as a primary risk, but it's something we're watching.
Okay, so with my remaining time, let me ask you, your November report indicated that the forthcoming rise in interest rates will have ripple effects throughout the entire economy. Can you speak to the interconnection between the Fed's rate hikes and the freeze on Russian assets as it pertains to the prices of certain commodities?
Well, I think commodities, or the price of commodities, is generally set on the world market by supply and demand. We do intend to raise interest rates this year, as we've said. But as long as we're in this very sensitive phase of events in Eastern Europe, we're going to be careful in doing so. We're going to move, avoid adding uncertainty, as I mentioned a little earlier. And we do believe that over time, as we raise interest rates and as we get relief from supply side improvements as well for inflation, that we'll get inflation back down. We expect to see that happening. And to the extent we don't see it happen, then we're prepared to move more aggressively.
Great. Thank you very much, Madam Chair. I yield back.
Thank you. The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Pro Tem Powell, for being so forthright. I think your answers to Mr. McHenry's questions at the outset were incredibly helpful. I think it was probably the most direct that you've been with respect to how you're viewing interest rate policy heading into the March meeting, and I certainly appreciate that, and I suspect others do as well. So thank you for that transparency. I want to start on Ukraine, and I know this is Ukraine and Russia, and I know this is just evolving. My view, despite some of the, what I thought was a little bit flowery rhetoric last night from the president, is this is the beginning of a long-term conflict. This is not something that will be over in a matter of days, but months and perhaps years, as the Russians encircle Ukraine and our lack of response in many respects. I know you're a student of history and you're a student of monetary policy history. When you look at a world where this is a longer-term conflict, how do you view a longer-term military engagement in Europe impacting rate policy and balance sheet policy? And if you haven't begun that study yet, is that something that the Fed will endeavor in the coming weeks and months?
It's a really good question, and I would have to agree with you that this event does seem to be one that is a game changer and will be with us for a very long time. As I mentioned, we don't understand yet. There are events yet to come that we haven't seen, and we don't know what the real effect on the U.S. economy will be. We don't know whether those effects will be quite lasting or not. But it's something we're going to be thinking about a lot. It's exactly the things we'll be thinking about. Too early to say, but it's not too early to try to imagine and assess.
Thank you, and I know my thoughts and prayers are with the Ukrainian people, as are many of my colleagues, all of my colleagues. I think we were unanimous in that. We hope for a successful outcome, though admittedly the days ahead appear to be quite choppy, and it's hard to see a positive outcome in the near term. I want to shift to another thing the President said last night around companies need to lower their costs, not their wages, and that's how we're going to fight inflation. That sounds wonderful. How do you magically sort of lower your costs as a company? Is that something? It sort of implied that it's corporate greed that's leading to inflation. I've read your comments. I think they're spot on with respect to the supply-demand dynamics. But is there a way for companies to just sort of unilaterally lower their costs that you're aware of?
First time. I
know you didn't see the speech.
Never comment on the president's comments at any time, and I won't do that now. I think my experience in the business world very much was that businesses are constantly managing their costs. That's a lot of what businesses do. They tend, and so it's an ongoing thing. But I didn't watch the speech, and I don't know the context, and I would never comment on anything the president says. So.
Thank you. Shifting to my last question, there's been talk of whether cryptocurrencies represent a good vehicle for sanctions avoidance. I think you've rightly said that's maybe for the purview of Treasury. But generally speaking, a system that transactions occur on a public ledger that are auditable and reviewable by the entire world. Anybody in the world can go and check and monitor these things. And in a world where those same systems have transaction speed limits, essentially. Do you think in that world a public ledger is a good or sort of less good way to launder money or avoid sanctions?
I don't want to, I'm not an expert on sanctions, and it's so I'm reluctant to comment on that in the context of sanctions, just because it's not our field. And I would say a public transaction, there's a balance you have to strike between privacy, which is very important, but also the ability of law enforcement and national security to track payments. And I think to the extent that cryptocurrencies are a means by which you can evade both law enforcement and national security concerns, then that's not something we should tolerate.
Thank you for, again, your transparency, and I yield back.
Thank you.
Thank you. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, and thank you, Chair Powell, for being before us again today with such forthright testimony in such challenging times. I wanted to just start on the question of inflation and something that you said to one of our colleagues in response to a question. You said that inflation is too high. We're seeing it everywhere in the world. Ours is worse because our economy is stronger. Can you flesh out that duality a little bit, maybe by way of contrast with others globally who are struggling with inflation but do not have a strong underlying economy?
Sorry, I think if you look at our, maybe the closest economies and political systems would be the countries of Western Europe and Canada. Advanced economy countries like that, they're all having the highest inflation they've had in a very long time. Places like Germany, which is famously, inflation averse, has high inflation. Now, ours is a little higher. Our economy is now well above the level of output that we were at before the pandemic. If you just look at the output an economy had before the pandemic to where it is now, we're way above that, and other countries are kind of just getting back to that level. So we've just had a stronger recovery, and that is because of monetary policy and fiscal policy, and also just vaccines and a whole range of factors. So our inflation is definitely, of the advanced economies, ours is higher generally. We're going through the same process that the Bank of England and other central banks are going through, which is raising rates and trying to get inflation back under control. Very committed to doing that. It's a common problem. Again, ours is worse because our inflation is higher, I think largely because our economy is that much stronger.
And I know you have a series of meetings and possible rate hikes. You talked about in 2 weeks, likely the 25 basis points increase. For my constituents, my consumers, what impact will they begin to see with the small incremental rate hikes?
So it's a little bit like the rate hikes that took place in the first part of this century. Not the rate hikes that took place after the global financial crisis were much slower. They were every other meeting. But the cycle before that, the rate hikes at consecutive meetings. So what you feel is these are fairly small rate increases, 1/4 percentage point every 7 weeks. And we haven't, by the way, we haven't made any decisions after this meeting. But the thought is that rates move up, our policy rate moves up, and with it, rates on mortgages, rates on car loans, rates on the loans that people take out to buy appliances and things like that. So companies, their borrowing costs go up. And, you get to a point where you've raised a few times it's even still a gradual process, even though it's fast, as much as twice as fast as the last cycle. but still, people start to spend a little bit less, and the economy demand goes, returns to a lower level. By this time, we hope that, that the economy is going back to normal in terms of supply chains and the breakdown between goods and services spending and things like that. So we hope we're getting help on the inflation front from a bunch of things. In any case, we do have the responsibility to generate price stability, and we will use our tools to do that over time.
Thank you for that. One particular area of concern for me is the role that increasing market consolidation has played in contributing to inflation. An example that we've seen is the huge price spikes in the meat industry, which has become incredibly consolidated. To what extent would you attribute supply chain fragility and recent price increases to market concentration?
So we're not the competition authorities, and so I would defer to the competition authorities on all those questions. In terms of inflation, though, inflation really is mainly a macroeconomic phenomenon, and which doesn't link in the aggregate very well to concentration. Some of the most concentrated industries, in fact, were those that drove low inflation. I'm thinking there of warehousing and retail and things like that. Those industries consolidated and they drove lower prices. So it's not so obvious. There clearly are industries where that may be the case, where they've become consolidated and they're able to raise prices. It's not clear they'd be able to generate an inflationary cycle, but they could certainly raise prices in the first instance. It's not a settled question in the economics, but again, we defer to the competition authorities.
Gentlewoman's time has expired.
Thank you, Madam Chair.
Thank you. The gentleman from West Virginia, Mr. Mooney, is now recognized for 5 minutes.
Thank you, Madam Chair. Inflation remains a serious concern for my constituents in West Virginia. Inflation erodes the real value of every paycheck. When the cost of filling a tank of gas or buying groceries increases, all Americans lose money. Today, I'd like to focus on a slightly different aspect of inflation, which is inflation's corrosive effect on Americans' savings. The combination of low interest rates and high inflation has clobbered returns on common savings tools like savings accounts, money market funds, and certificates of deposit. January's 12-month consumer price index of 7.5% pushes the yield on these savings tools into deeply negative territory. In other words, with inflation as high as it is, Americans who have saved responsibly for years are losing their money over time. So Chairman Powell, first question is, how concerned are you about the effects inflation and negative savings yields are having on the long-term health of our economic recovery?
So I would agree that inflation falls heavily on people who are living on, for example, bank deposits and CDs, and this is typically retired people and the elderly, and of course they do bear the brunt of this. So that's why one of the reasons we need to get inflation back down to appropriate levels, and that's what we're working on.
Thank you. Savings is an important way to achieve financial goals like purchasing a new home, paying for college, or retirement. Savings is a way to take control of your financial destiny. Savings is a part of how we can achieve the American dream. So I'd like to raise another potential issue about the declining value of savings and its implications going forward. I'm concerned that our current economic environment will discourage savings altogether. So Chairman Powell, are you concerned about the effects inflation and negative savings yields could have on Americans' incentives to save money going forward?
Interesting. If it were to persist for a long time, I would be concerned. Of course, right now, the level of savings on people's balance sheets is at historic highs because they saved during the pandemic. They weren't able to spend money on travel. So right now, we're looking at a couple $1 trillion of savings above where they would have been without the pandemic. But over time, yes, savings is important, and I would agree that high inflation can be a disincentive.
Okay, thank you. I think it's important we monitor the savings rate closely with this in mind. If Americans save less, that could have economy-wide implications both now and especially in the future. So we should be careful to ensure monetary policy encourages savings going forward. And that's all I had. Thank you, Madam Chairman. I yield back.
Thank you very much. The gentlewoman from Texas, Ms. Garcia, who is also the Vice Chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Pro Tem Powell, for being with us today. And I think I'm going to be last, so I'm trying to try to be soft. In a recent press conference, you had mentioned that forecasters expect inflation to subside as supply chain disruptions issues are resolved. I understand this is being addressed, and my colleagues and I are working on addressing this supply chain crisis through multiple legislative solutions. At home in Houston, one of the nation's shipping and energy capitals, we are focused on expanding and developing the nation's ports and waterways to continue building our role in facilitating global energy and trade. You also said in your remarks today that we understand the high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. So I want to focus some on housing. In Houston, housing costs have skyrocketed, with the median price rising 18% last year and the average 16%. Nationwide, housing and the rent prices account for roughly 1/3 of the CPI. And most economists do not expect this problem to be resolved as quickly as supply chain bottlenecks. In your earlier exchange with my colleague, Congressman Williams, you mentioned a soft landing, wherein the Fed will address inflation first and survey the housing prices trending downward. My question is this: is the Fed looking at alternative plans in the event that housing prices do not trend with inflation? How might that impact inflation reviving if low housing supply continues in the upward pressure?
So we do, as you mentioned, housing costs and housing services costs, and if you're a renter, they're a very big chunk of what goes into the inflation indexes. And to the extent housing prices, we're not saying they'll go down. What we're saying is that the increases will be much smaller. We don't need housing prices to actually decline, just as long as what we can't have is we don't want to have them increasing at very high levels as they have been doing. Largely as a function of supply and demand. You know, supply is constrained. I don't know about Houston, but many places in the country, difficult to find lots, difficult to find labor, difficult to get materials. Materials very expensive.
We're experiencing that.
Yeah, and so demand is very strong. So interest rates are low, and what you get is a lot of buyers and not enough new houses. So what will happen as we raise interest rates, and this is already happening, it's already priced in, is mortgage rates will go up, and you'll see that bidders, prices will begin to go up more slowly, demand will decline, and hopefully we'll get back to a place where demand and supply are well aligned.
Will we ever get back to the pre-pandemic levels? Will we get back to the pre-pandemic levels?
Of price?
Yes, sir.
No, I would only expect that we could limit further price increases. We're not trying to drive prices back down. What we're trying to do is limit future prices.
Right.
Increases.
Now, how concerned are you that there seems to be a lack of investment in affordable housing, and how that could cause inflation to become a long-term problem, even if the Fed is able to get inflation under control in other segments of the economy? So now specifically about public housing.
Public housing is, of course, not our policy tools don't generally meet the need for affordable housing. It's really more of a fiscal policy and a housing policy question. But I know that economic research shows that high housing costs for workers are making it difficult for people to live close to where they need to be going for work, and it is limiting the ability of people to be in the workforce and ultimately limiting our economy. So I will say that.
Last question, you mentioned in your remarks that it impacts essentials like food, housing, and transportation. What does this do to the poverty rate, increased inflation? And because I know unemployment is down, does that necessarily mean poverty is coming down, or does it continue to rise with inflation?
So those things would have offsetting effects. To the extent inflation is going up and faster than people's wages, And that's actually not the case for people at the lowest end of the spectrum, because that's where the highest wage increases have been in the aggregate. But to the extent that were happening, that would potentially increase poverty, but to the extent people are going back to work, that would decrease it.
Thank you. Madam Chair, yield back.
Thank you very much. I'd like to thank Mr. Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask Mr. Powell to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.
Good afternoon. Welcome to Yahoo Finance. I'm Karina Mitchell, along with my co-anchor Alexis Christophers, and we are just wrapping up testimony from Fed Chair Jay Powell. He was on Capitol Hill as part of his biannual monetary policy hearings. And top of the agenda, of course, how to ensure inflation does not become entrenched in the economy. He just wrapped up day 1. Here with more, let's bring in our Brian Chung. And Brian, Powell says there are tools in the box to make sure that that doesn't happen, but warned of uncertainty tied to the Ukraine conflict.
Yeah, well, certainly the uncertainty is high, as the Fed chairman described it in that hearing to the House Financial Services Committee, which you saw just wrapped up a few seconds ago. The Fed chairman saying, quote, "Bottom line is we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war." Of course, this coming only 2 weeks ahead of the Fed's next policy setting meeting. That'll be on March 15 and March 16, where the Fed chairman laid out very clearly that he's supporting a 25 basis point hike, again, 0.25% of an increase, the first increase in Fed funds rate since really 2019. So the Fed chairman said, the money quote here, quote, "I'm inclined to propose and support a 25 basis point rate hike." And for those that are wondering, this is relatively unprecedented. You don't usually see the Fed chairman say, this is exactly what I'm going to support 2 weeks before a Fed announcement, and especially when you consider the fact that we're still due to get an employment report this Friday and then another read on inflation next week, both of which could come in relatively hot. So the Fed chairman trying to commit the Federal Reserve to a standard size interest rate increase, which would likely take a little bit of wind out of the expectation that we had seen earlier in February for perhaps a 50 basis point or a double rate bump. You can take a look at Fed funds futures markets now. Essentially, no one is any more pricing in the chance of a 50 basis point hike in that meeting. So the Federal Reserve charting a course ahead for that policy in that meeting in 2 weeks, guys.
Well, Brian, certainly a very transparent Powell today before lawmakers. So maybe we don't get the 50 basis point hike in March, but he has left the door open for more aggressive hikes later in the year, especially if the situation in Ukraine begins to wrap up in the coming weeks.
Yeah, an absolutely critical point that you bring up there. The Fed chairman was asked later on if he saw 25 basis points as the ceiling for future Fed moves, even if he only supports a standard size move in the next meeting in 2 weeks. And the Fed chairman said, look, anything's on the table when it comes to responding to inflation down the line. So it's possible that if the Federal Reserve wanted to move and launch its first post-COVID rate hike in March, that it could still leave the option on the table for a 50 basis point move in the next meeting, which would be in May or maybe in June, or in the other policy setting meetings that we're expecting to see later in 2022. He said that the response is really going to be all about inflation. And of course, how does the Ukraine and Russia situation play into that? One possible reading would be higher energy prices as a result of the sanctions on Russia could further exacerbate the price increases that we'll see. Again, we might not see that until the CPI reports later into the spring and then into the early summer. But if that is the case, the Fed chairman saying, look, the Federal Reserve has the tools to raise interest rates by more than 25 basis points at a time to make sure that we get this very critical question of inflation back down to more comfortable levels for Americans.
Yep, threading the needle there, Fed Chief Jay Powell. All right, Brian Chung, thanks so much for wrapping up that testimony, day 1 for Powell. I want to stick with the Fed and the markets now and bring in Neela Richardson. She is chief economist at ADP. Neela, always good to see you. So let's start with what we just heard from Fed Chief Powell. Do you believe that these rate hikes should remain on track as he says they are, or should the Fed pause given the war in Ukraine?
I think they should be on track. We are already looking at inflation by the Consumer Price Index, the headline inflation of 7.5%. This is already here with us. And if you look to what's going on in the oil markets with oil prices jumping to over $100 a barrel, it doesn't look like the developments in the Ukraine and Russia by any stretch of the imagination are deflationary at this point. So all indicators in my mind point to the need to act decisively on inflation. And to the point of how big the first step is, I think it matters less whether it's 25 or 50. That first step, how big it is, it's more how far the Fed can walk to contain inflation and get price levels back to a more comfortable rate of change.
And I think that's the question. How far can they walk comfortably, as you put it? Because Powell and company are really doing this balancing act between inflation and recession, or perhaps stagflation. What are your thoughts on the best ways the Fed can sort of maintain balance to get its arms around these higher prices, but not force or plunge this economy into a situation where we could be looking at a recession?
Well, I don't want to downplay the uncertainty, especially given recent events that the Fed is grappling with. But I do want to point out that the consumer, which is the bulk of the economy, looks like it has strong footing. You know, we're seeing spending stay strong in the face of inflation. What we want is to make sure that continues as the year progresses. And so in my mind, it's really about containing inflation. That not only has effects for spending, for markets, but also for the labor market, where wages for the typical worker is not keeping up with inflation. Chair Powell mentions that at the lower end of the wage spectrum, you're seeing that big increase. However, if you look at the typical worker, their wages did not go up by 7.5 or 8% from a year ago. And so it's important for Main Street that inflation comes under control so that dollar goes as far as it did in terms of meeting the needs of the typical American consumer.
I want to talk about the job market. I know last night during the State of the Union, President Biden touted how many jobs have been created on his watch as we continue to pull out of the pandemic. Today, we got the ADP numbers. Companies adding 475,000 jobs in February, much better than expected. But Neela, I think what's really stealing the spotlight is that revised number for the prior month, for January, sharply higher, showing actually a strong job gains instead of losses. Just sort of wondering, how can a number or survey like that be off by so much? And then what are your expectations for the monthly jobs report on Friday?
Right. So that revision was part of the yearly annual process that's been co-developed by Moody's Analytics and ADP in order to adjust the numbers to the BLS revisions and something called the QCEW, which is a near complete census of workers and jobs in the United States. So it happens every year that there is this revision. It mirrors the revision and re-benchmarking that the BLS takes in January. What we saw in that BLS revision is an upward increase in November and December, closer to the ADP estimate at that time. But what the NER model does is it incorporates those revisions into the new estimate. And that's what you see in the January revision and this latest number. What it also means on a macro level is that Omicron has had less of an effect on the jobs market than other variants. And I think that's good news to kind of conclude the point on, is that it looks like that the labor market has created a muscle, gathered some resilience in navigating the pandemic. And as Omicron fades, it looks like as well that the labor market is in good position to see solid gains through the course of the year.
And Neela, before we let you go, want to get your take on the housing market, which we know has been a pillar of strength for this economy, but we also know mortgage rates are moving higher. Jay Powell just said as much to lawmakers. What do you see as the role of the housing market in economic growth for this year and into next?
You know, Alexis, housing is one of my favorite markets. It tends to lead the economy into and out of recessions. What we've seen over the last 2 years is that the housing market has been incredibly hot. But we've also seen a 20% year-over-year price in the median sales price, and inventories at at record lows. So that is not a good position for home buyers. And one thing that we know about the housing market is those price increases trickle down to the affordable segment of the market, which tends to be even more challenged by inventory. So overall, I think housing is something to watch. It's really important. It's the biggest part of the consumer household budget. And price increases are not just being driven by inflation dynamics tied to the pandemic, but this chronically undersupplied market that we've had in housing for the past decade, especially in the affordable segment.
All right, Neela Richardson, chief economist at ADP. Thanks so much for being with us. Appreciate it. And we want you to step up your investment strategy starting today with a free 14-day trial of Yahoo Finance Plus, where you will get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. You can check it all out at yahoofinance.com/plus. Coming up, a theme from President Biden's State of the Union address: inflation, especially when it comes to cars. During his first State of the Union address last night, President Biden said fighting inflation was his top priority as soaring prices on just about everything continues to eat into household budgets. And he called out the auto industry as a main culprit.
Look at cars last year. 1/3 of all the inflation was because of automobile sales. There weren't enough semiconductors to make all the cars that people wanted to buy. And guess what? Prices of automobiles went way up, especially used vehicles as well.
Well, one company benefiting from the state of the auto industry is CarParts.com, one of the leading e-commerce providers of auto parts and accessories. They just posted record fourth quarter and full year results. And joining me now is CarParts.com CFO and COO, David Menion. David, good to see you again. So this is, if we're keeping track here, your 8th consecutive quarter of year-over-year sales growth. You had quarterly sales up 23%, fiscal year sales up 34%. Tell us what drove that growth.
Thanks for having me, Alexis. Yes, you're right. 8th consecutive quarter of growth, 3rd year of record results. I think what drove these results is the execution. We put together a strategy 3 years ago. We invested in talent, in supply chain, in inventory, in technology. Lots of distractions out there, but we just remain focused on execution.
Lots of distractions indeed, including supply chain issues, which did not seem to touch your company. I believe you had a record amount of inventory at a time when many people across many different industries are having a really tough time. Tell us how you did it.
Yeah, absolutely. I think supply chain disruption globally is impacting a lot of different companies. We made a lot of investments 2 years ago in building those capabilities in-house. We were very aggressive for the last 2 years in terms of communicating with our vendors, getting space on ships, and buying inventory. You know, in our space, it's either you have it or you don't, and we made the decision to have it.
Now, gross profits increased 27%, but at the same time, your net loss widened to about 10 million. What was behind that, David?
Yeah, the GAAP number was negative. We were impacted by some non-cash expenses. From a cash perspective, which is what we manage, we were free cash flow positive. We generated close to $6.5 million of free cash flow, and that's what I decided to focus on.
I want to talk about the future and what the short-term and near-term future looks like for carparts.com. You know, today we just heard that Ford is going to be splitting up its EV from its gas combustion units. You know, again, its boldest move yet, really, in the electric vehicle space. As more automakers move to EV, what does that mean for a company like yours and your business model?
It means it's an opportunity. I think long-term EVs are here to stay, and that's why we started making those investments a couple of years ago. We were one of the first retailers to build a platform in carparts.com/EV. So for sure, long-term, huge opportunity for us. I think there is a misconception out there. You know, 90% of the parts that we sell are agnostic to the powertrain. So they'll fit an EV, a hybrid, or a traditional combustion engine. So for us, it's just an opportunity to sell more parts.
What is your outlook for this quarter, but also for subsequent quarters? I don't know how far you're looking out. And what do you see as tailwinds? Because there seems to be no slowing down for demand for cars, including used cars.
Yeah, for us, my outlook is 3 things. It's growth, growth, and growth. And that's driven by execution, the team, financial discipline. You know, for the last 3 years, we've made all those investments. We continue to make those investments. Supply chain, data, technology, marketing. Long term, there's big opportunities in EVs, so we're going to continue executing.
Do you expect these higher prices for new and used cars to last, you know, through at least this year?
Yes, I think, you know, the global supply chain is not showing any sign of easing off. I think the situation in Ukraine is putting a lot of uncertainty. You know, the Fed also talking about interest rates. I think there's just a lot of uncertainty right now in the market, and I expect this to last at least this year, probably into next year.
You also have a lot of sort of square footage coming online soon. Are you opening up a new location, or is it distribution center in Jacksonville, Florida? And where do things stand with that?
Yeah, that is correct. So we expanded our footprint in Texas. We took the building next door. We now have 350,000 square feet. We're opening a second facility this year. It's going to be our 6th one in Jacksonville, Florida, close to 200,000 square feet. We're hiring, we're receiving inventory, and the ultimate goal for us is always the same, is to get closer to the customer. Our goal is to get to 80 to 90% of the population within 1 day's transit time.
All right. Well, so far, so good on the execution part. David Minian, CFO and COO of carparts.com. Always good to have you here on Yahoo Finance. Karina?
Okay, great discussion there. We have much more coming up after the break. The price of wheat and corn, along with other commodities, is soaring. What's it all mean for accessibility for the middleman and for the consumer? We'll get into it ahead. Welcome back to Yahoo Finance. Well, the price of oil continues to spike, hitting $110 overnight amid the Ukraine conflict, now hitting $109 for WTI and Brent hitting $111. That as Putin, Russia, and its oligarchs continue to be sanctioned. And Russian oligarch Abramovich says now that he will sell his Chelsea soccer club amid the Ukraine conflict. Soft commodities also soaring today, including the price of wheat and corn, something Russia and Ukraine are large exporters of. What does it all mean for the availability here at home? To help us discuss, let's bring in Blake Hurst, farmer and greenhouse operator at Hurst Greenery. Sir, thanks so much for joining us. So a quarter of the world's wheat, more, 29%, comes from Russia and Ukraine. We've seen massive moves on both in recent days. How worrisome are these rising prices for you? They couldn't come at a worse time.
Well, we obviously are in the business of selling corn and soybeans, so the prices have been moving in our direction. But the wheat prices, the corn price, Ukraine is a major exporter. There's a lot of concern about how long the ports will be closed. They're closed now. They're unable to export. When that's combined with a drought in South America, which has cut their soybean yields a tremendous amount. It's not clear how much yet, but we know it's a lot. We've got a real shortage, and that's not good for anyone. Even farmers who are enjoying the high prices know that there'll be demand destruction. There'll be cattle and pigs that won't be fed because the price of feed is just too high. So it's not good news for any of us. A little more stability would be a good thing.
What is the immediate impact for you? What are you facing as far as supply and fulfilling orders?
Well, we obviously have inventory. We've what I'm facing is I'm short both corn and soybeans in my normal hedging program. So what I'm facing is a lot of margin calls, but prices are at a profitable level as far as we can tell. But we've seen huge increases in our input costs, whether that be fertilizer because of tariffs on foreign imports from Russia and other places. That's fuel costs have doubled or nearly doubled. Fertilizer prices in some cases have more than doubled. We're seeing commensurate increases in the price of transportation, price of seed, the price of herbicides and pesticides. So it's a great deal of uncertainty. It's very hard for us to plan. We don't know what the prices will be, and they're changing, of course, a great deal every day.
Well, that was my next question, because how do you plan in this sort of environment? Does it make sense to lock in contracts for, the fall and beyond even, when you just have no idea what's going to happen because of all of the volatility and the uncertainty surrounding this conflict?
Yeah, as far as, the things we grow, the corn and soybeans that we grow, we are doing some pricing, but it's very difficult to know because as soon as we did some pricing the week before the invasion and then saw limit high moves. In other words, we were too quick in pricing our products. So very, very hard to plan. But we'll do the best you can. And all we can do is just farmers without any kind of inside knowledge or anything like that is to reward the market when it moves up and hope that we get some stability here so that we can make longer term plans. More difficult is just the supply chain difficulties. Yesterday, we had a supplier for our greenhouse business tell us that they weren't going to be able to supply the things that we'd been planning on for this year. We'd already, it's pots that we'll fill with plants and sell. We'd already contracted to sell all the goods that would be in these pots. Now we have to call our customers and say, hey, we aren't going to get what we expected. So we've got excess greenhouse space. We've got excess plants with no home. Because our supplier failed to meet their commitments.
And sir, the U.S. is a big exporter of wheat as well. And I'm wondering if they need to export more, what does that all mean for consumption here? And, prices for the consumer, for corn, for wheat, for soybean products?
Well, final consumer prices for the food you buy at the store, as it turns out, corn, soybeans, wheat, are a fairly small percentage of the cost you'll see at the store. But that percentage is increasing a great deal. So you're going to see continued price increases at the grocery store. Obviously, as feed costs go up, there'll be less cattle, chickens, and pigs fed because they're no longer profitable. So you're going to see meat price increases. So it's all a part of the overall inflation picture that we're seeing.
And all that as cereal prices and wheat prices and products continue to rise, up more than 7%, almost 7% year over year. All right, thank you so much for your time, Blake Hurst, farmer and greenhouse operator at Hurst Greenery. And we have much more Yahoo Finance ahead. Stay with us. Welcome back to Yahoo Finance. Well, the rally is continuing on Wall Street. All three major benchmarks at or near session highs. So I want to give you a quick check of what's going on. The Dow is now up by a whopping 673 points, more than 2%. The S&P is also up more than 2%, up 89 points, and the Nasdaq up by 229 points. All right, we'll switch gears now. Airbnb is one of many companies stepping in to help aid Ukraine amid the ongoing Russian invasion. Yahoo Finance's Akiko Fujita spoke with Airbnb CEO Brian Chesky to discuss, and she joins us now. Akiko.
Hi there, Karina. Well, the UN estimates that more than 600,000 refugees have already crossed from Ukraine into neighboring countries. And CEO Brian Chesky tells me that he has been in touch with 14 different European governments over the last several days, coordinating with refugee agencies to try to make Airbnb's vision a reality, with the goal to offer free temporary housing to 100,000 refugees.
Well, the idea is really rooted in something that started 10 years ago. 10 years ago, Hurricane Sandy, as you know, being in New York, occurred in 2012 in New York. There were displaced people. One of our hosts reached out to us saying, "I'd like to host people for free." From that moment, we started providing housing for people for free that were displaced by disasters. 5 years ago, in partnership with what is now Airbnb.org, we started providing housing for refugees. Over the last handful of years, we've housed 54,000 refugees. When the humanitarian crisis broke out in Afghanistan, as you know, tens of thousands of refugees fled the country. We have to date housed 21,300 refugees in Afghanistan, and we increased our goal to house now 40,000 Afghan refugees. So all this came about because we have a 10-year history of providing housing for people in need. So what happened was Thursday, Friday, when this crisis became evident that there would be hundreds of thousands of displaced people, the first question we asked is, well, how can we help with this crisis? And obviously the best way we can help this crisis is provide housing for refugees. So we had a team work 24/7 around the clock to be able to get to yesterday's commitment that we will work in a partnership with Airbnb.org and our host to house up to 100,000 refugees, and it's going to be totally free to them. And we can only do this with the partnership of our hosts. So we're trying to get as many people in Poland and Germany and Hungary and Romania and countries even west of those countries to be able to open up their homes for free or a discount. And Airbnb and Airbnb.org, but donors, we're also going to be obviously contributing a significant amount of money to be able to pay for these operations.
We've seen over the last few days a number of Western companies who have announced they are in fact withdrawing from Russia, some companies who are divesting investments that they have in place there. Airbnb has still a lot of listings. I just went on the platform before I talked to you, several hundred listings in places like Moscow as well as St. Petersburg. Does the company plan to continue operating there?
We are looking at this actively. Let me just say a couple things. Number one, we've had our hands very full the last few days. This has been all hands on deck to figure out how to be able to house 100,000 refugees. So I've told our team, this is priority number one. How can we help? Number one, we can help is to be a partner to this humanitarian crisis. Number two, we are absolutely supportive of whatever sanction the United States imposes on Russia. Number three, as a practical matter, a lot of the sanctions that have already been imposed have been imposed on Russian banks, which have prevented many people from paying or getting paid. So as a practical matter, our business is much more limited right now because of the sanctions, but all things are on the table and we're actively looking into this.
Yeah, what's going to go into that thinking? I mean, to your point, with the sanctions already in place, especially these banks being blocked from the SWIFT banking system, that automatically kind of forces your hand that you're not able to do a lot of these transactions. But in terms of the company saying we just need to take a stand here and no longer operate, what's going to go into that thinking?
Well, I mean, I want to make sure that any decision we make, we consider all of our stakeholders, the impact we have on our guests, our hosts, and communities all over the world. And so we try to have a very thorough process for these decisions. And it's just a matter of, this is like a triage situation, trying to be able to provide housing for 100,000 refugees, but we are absolutely discussing these matters.
Brian, I know the last time we spoke, you were talking about the real pickup that you're seeing in travel, especially for the summer season. Right. I know you've got a big presence in Europe, and the hope here really was for these, cross-border travel to pick up. What kind of impact do you think this is going to have on that? I realize we're talking about Eastern Europe, specifically Ukraine and Russia, but we've seen a number of governments move in blocking airspace to Russian planes and whatnot. Do you get the sense that this could have a bit of a chilling effect on some travelers who say maybe this is not the right time to do it?
I mean, there's no question that in parts of Central Eastern Europe, for the immediate near term, there's going to be some limits on the types of travel people have. But I think it's really important for people to understand our business. We have nearly every type of space in nearly every type of community at nearly every price point in 100,000 cities all over the world. What the last 2 years have shown, I think our results have shown, is however the world changes, our business can adapt. We're a highly adaptable model. So where there's less cross-border travel, we typically see a growth in domestic travel. That's what we saw in the United States. So I think that, I'm sure there will be some disruption in some countries. We'll have to see how wide this crisis gets, but our model is very adaptable and we'll be prepared for however travel changes.
And as Brian Chesky said, Airbnb has shown over this last year, some would argue 2 years, that they can in fact adapt to any disruptions in travel. They are, of course, coming off of a record revenue year. As for the European market, this still does remain the largest market for Airbnb outside of the U.S. About 35% of nights and experiences booked on the platform came from the EMEA region, according to the company. So they're going to be watching this one very closely. But for now, Chesky saying that they are focused on being able to house those refugees that continue to come across the Ukrainian border. Karina?
Yeah. It makes such a tremendous difference there. Okay, Akiko Fujita, thank you so much for that interview. We're going to switch gears now. President Biden addressed the American public in his first State of the Union speech last night. He began with a scathing attack of Vladimir Putin before turning to a range of domestic issues. Here with reaction is Republican Representative Nancy Mace from South Carolina. Representative, thank you so much for your time today. I'm sure it was a late night for you yesterday. So let's start with Ukraine. We learned that the U.S. will close its skies to Russia last night, but Ukraine is begging for its skies to be defended. President Biden reiterated the IEA will release $60 million barrels of oil from its reserves, from its stockpiles. But that accounts for just 6 days of Russian output of oil. He talked about made in America, but he never mentioned once making more energy in this country. Crude oil hit today $109 a barrel. It was $110 overnight. Your reaction, please, to his messaging and on his sanctions so far.
Well, certainly it was a good start. But if you take the state of New York, for example, there's enough natural gas there to give to our European allies for the next 150 years. The United States has an abundance of natural resources. And until we can all get on electric cars, know that when you are filling your car with gas, there is Russian oil in there. And I don't think any American today wants to have a single gallon of Russian gas in their cars. We import about 600,000 barrels a day, and those barrels are stained with Ukrainian blood. We did hear today from the White House that they're looking at the economic impact of oil and gas sanctions. This is how Putin funds his wars. He makes money off of oil and gas and uses it to buy missiles, to tanks, and to invade countries like Ukraine. And we've got to put a stop to this. I don't want to be part of funding his cartel in Ukraine, or the genocide and murders and human rights atrocities that are happening in real time. We're all watching this unfold on social media, literally in real time. And I think that's one of the reasons the United States and our European allies have reacted and responded so swiftly. But there's more to do, I believe. In our neighbors to the north in Canada, they decided to put a moratorium on their oil and gas imports from Russia. I would love for us to do the same, but there will be consequences to that. We need to have OPEC increase its production. We also need to look at the natural resources we have here and how quickly we can stand up some of those to provide for ourselves and our allies around the world.
Congresswoman, President Biden spent about 11 or 12 minutes discussing the situation in Ukraine and then went on to domestic issues. In many ways, it felt sort of like two speeches in one. And he made a lot of promises with regards to high inflation. He says it's his top priority. Do you feel like he laid out an actionable plan on how to rein inflation and those higher costs for Americans in?
I was actually confused by the plan. And one of the things he talked about was reducing costs by having government controlled pricing, for example. We know that that isn't going to have the intended effect. And of course, it takes dollars for R&D and innovation out of the market when that does happen. It was very kind of confusing because part of inflationary causes, not only the Federal Reserve printing money, but also taxes contribute to inflation, spending contributes to inflation. But he's asking American companies to reduce the cost of everything, double the wages and salaries of their employees, and oh, by the way, we're also going to tax you on top of it. And so I think the message was gray and confusing from that perspective. Some of the issues he brought up I believe are going to exacerbate the issues that we have with inflation. I know back home where I am in South Carolina, the cost of shelter over the last year alone is up 25% to rent or buy a home. Gas prices in our neck of the woods are also up 50%. When I go to the grocery stores with my kids on the weekends, there are empty shelves. And so this is problematic, but one of the major ways we can do that is by reining in the federal government spending. And meanwhile, in the middle of COVID-19, the federal government had record revenues. And when they told businesses to shut your doors, we continued to spend. The federal government didn't cut one dime. And that has helped exacerbate the situation. And wages, of course, are not keeping up with inflation. Individuals and families on fixed incomes are hurting worse today than they were a year ago. There's so much more that we need to be doing that was not discussed last night.
Midterm primaries are underway now in Texas. Are you surprised there was no real discussion about voting rights? However, he did decide to say that he was in favor of funding the police, while Kamala Harris stood up and applauded that. She's been very vocal about defunding the police.
Yeah, I found it was very striking. That was one of the moments where he had a bipartisan standing ovation, because Republicans have been saying for years we need to ensure that we fund the police, not defund the police. And that message of defunding the police will derail Democrats even more in the midterm election cycle. But it's one of the places where we can agree. Of the few places where we can agree, that was one moment last night where all of us were in agreement on that discussion. We want everyone, regardless of your zip code, the color of your skin, everyone wants to be treated equally and be protected and safe when they're home, and ensure their children are safe in their communities, regardless of zip code or color of skin or gender. So that was a great moment last night for all of us to come together in the same chamber, both parties, both chambers, supporting an effort together.
All right, thank you so much. We'll have to leave it there. Lots more questions, but we're out of time. Representative Nancy Mace from South Carolina, thank you so much. And we will take a quick check on the oil market, because oil has been spiking as the Russian invasion into Ukraine escalates. The White House now starting to downplay an outright ban on Russian oil exports, but traders seem to be doing the work for them. Inez Ferre will be with us shortly. Welcome back to Yahoo Finances. Well, oil prices are soaring again today, up almost 6% on WTI as the Russian invasion into Ukraine continues to escalate. The White House now starting to downplay an outright ban on Russian oil exports. Let's bring in our Yahoo Finances, Inez Ferre, with more. And as traders seem to be doing much of the work for them.
Yeah, that's right, Karina. One analyst put it this way. He said this is a de facto ban. Russian oil has become the persona non grata of the oil industry, and traders are doing it. The market is naturally doing this. Now, Russian Urals is the grade of Russian oil. When you talk about Russian oil, most of it is the Urals, and it is trading at a steep discount. It has been trading at a steep discount for days now over in Europe, down more than $18.50 below Brent International. So that usually the spread is around $2. That difference is $2, but now it's more than $18. And that is because oil refiners, Western oil refiners, don't want to touch it. The insurance companies that are involved don't want to touch it. The vessel companies. So even though Western sanctions tried to stay away from sanctions against energy transactions. I mean, the U.S. put waivers out for energy transactions so that the oil market wouldn't necessarily feel the brunt of the sanctions. The market is naturally doing this. I mean, one analyst said this is a public relations nightmare for anyone that's involved in these transactions. Another analyst told me companies just don't want to commit to buying this oil, to sending the vessels out to retrieve the oil, and then somewhere along the line in this puzzle, there is some way that they are somehow going against sanctions. So so this has happened over the last couple of days since the SWIFT sanctions of last Friday. So you have seen this spike in oil prices, in Brent crude, in WTI prices. And one analyst told me Brent would be anywhere between $15 and $20 lower if it weren't for Russian oil that's being sort of boycotted naturally by the industry. And another told me the world is definitely going to feel it, especially the European market, which uses so much of Russian oil. But the market definitely, the oil market, you are seeing it, you have been seeing it, especially over these last couple of days, is pricing in a disruption of supply of Russian oil.
And Inez, the price of WTI going up even as we are speaking now, up by more than 6%. Inez Ferre, thank you so much. Alexis, over to you.
All right, coming up next, our senior columnist Rick Newman grades President Biden's first State of the Union address. In his first State of the Union address, President Biden last night made a few promises on key issues that our senior columnist Rick Newman says will be hard for him to keep. Rick joins us now for a breakdown of that speech. So, Rick, you point out two things. He said he was going to go after Russian President Putin, and he said he's going to get inflation down, called it his top priority. Did you not hear enough in that speech to tell you just how he intends to do both?
I think that's a fair way to put it. These were the two big topics at the beginning. Of course, he began with Ukraine, and he did a good job on Ukraine. I mean, he's got generally bipartisan unified support. The United States and European allies have done a good job rallying many countries around the world to support these sanctions on Russia. But then he went further and he said, we're coming after Putin. He said, we're coming after your ill-begotten gains. I guess by that he means much of the money that Vladimir Putin and some of his oligarch buddies have siphoned out of the Russian economy. They bought multi-million-dollar properties all around the world, yachts, planes, and things like that. So I guess they're actually going to try to shut down some of those assets. And then he moved on to inflation, and he also basically said he's going to be doing something about inflation. He urged businesses to lower their costs, and he had a bunch of other ideas. I think both of these are going to be hard to execute or hard to fulfill. It's not clear that the West can do very much to find all of these assets that Putin and his buddies have hidden. And then if you move on to inflation, Biden really just didn't make a lot of sense in terms of how he's going to get inflation under control. And at the same time, as you guys have been talking about, oil prices are going up, not down, because of everything that's happening with Ukraine and Russia. And that is for sure going to raise oil and gasoline prices here. I think it seems very likely we're going to see gas over $4 a gallon on average, and who knows, maybe as high as $4.20, $4.30, $4.50. So I think in coming weeks, it's going to look like Biden, good rhetorical flourishes in that speech, but hard to execute on some of those pledges.
All right, Rick Newman, we can go on, but thanks so much. Appreciate your time. Karina?
Hi, guys.
Thank you so much. Okay, let's get a quick check of the markets before we head to a break, because they are the major benchmarks at or near session highs. So taking a look at the three majors, the Dow is now up 696 points. The S&P better by 2%, up by 90 points, and the Nasdaq also higher by 222 points. We are going to take a quick break, but more market news ahead, and a closer look at the energy sector as the price of crude continues to soar. Stay with us. Markets staging a comeback in the session today despite a more punishing turn in the assault on Ukraine. That as investors digest comments from Fed Chair Jay Powell on how the central bank plans to ensure inflation doesn't become entrenched. Zoom was a pandemic darling and just delivered earnings that beat, but what lies ahead for the company on this side of the pandemic? We speak to the CFO to find out. Plus, major problems for Major League Baseball as the lockout continues. What does the delay mean for the 2022 regular season? Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor Alexis Christoforous. Thanks so much for stopping by. Just coming up to 2 p.m. on what is a risk-on session. Want to get you straight to the markets to see what's moving them right now. So let's bring in our Yahoo Finance's Jared Blickery. All eyes and ears on Fed testimony today, and Fed Chair Jay Powell being incredibly transparent. That's something that we don't normally see from him, aiming for a 25 basis point hike come March. 50 seems to be off the table.
Well, he did leave the window open for 50, but the markets definitely heard that 25 basis points. And as Yahoo Finance's Brian Chung has been pointing out, it's very unusual for that to happen, except that it was almost already telegraphed, but that kind of cemented it. Just want to show you the price action. Now, Powell started speaking around 10:15 a.m. The hearing began at 10, and we did see a little spike down on those comments that there may be that 50 base hike on the table still, but nevertheless, it was mostly from the upper left to the lower left to the upper right throughout the testimony. We can also take a look at the bond market. Now, we know that there's been a lot of volatility here, and today the 5-year T-note yield is up 18 basis points. That is simply an astounding move. But in the context of what's happened the 2 days prior, barely clawing back half of that move. You also see that in the 10-year, and let's go there. And then we want to check out volatility as well. But here's a 10-year. You can see that's up 14 basis points, and the 30-year is up 11 basis points. So with the yield curve going up, we are seeing value and cyclical stocks trend higher. So let's take a look at the VIX as well. Still holding above 30, but here's today's candle. You can see coming down. What I don't like is we still have this trend line in place. You can say that's a chart crime to put a trend line on a VIX chart, but nevertheless, that's what I'm looking at here. Also want to take a look at the sector action. Pretty interesting. I said value stocks should be in the forefront. That is exactly what's happening. Financials and energy each up more than 2.5%, followed by materials, industrials, and tech. Each of those up more than 2%. And you can really see the way this is shaking out in the NASDAQ. And you can see Apple up 2%, Microsoft up 1%, NVIDIA up 3%. So really on this particular board, really seeing some nice action here, despite the fact that many of the sectors that are outperforming today, not necessarily represented here.
All right, want to turn things over to the auto industry for a minute because big announcement today from Ford, right? It's going to split its EVs and legacy autos into separate units, and it's also going to spend $50 billion on electric vehicles. And I see some green on your screen.
Yes, let's take a look at Ford, up over 8% today. And if you take a look at what's happened over the trailing year, you can see we did have a big fall off like a lot of stocks did this year, but nevertheless holding on to 44% over the last year. Now, analysts are weighing in on this, and the consensus seems to be that this is something that kind of had to happen, but Morgan Stanley, Adam Jonas, which rates the stock in underweight, saying he applauds Ford's decision to take the first important step to optimize competing missions of the EV internal combustion engine business. That's EV versus ICE. Quote, in our opinion, other legacy auto OEMs may be planning something similar. Ford leads the world in actually announcing it. And then some interesting comments from Bloomberg Intelligence. Ford's announcement that it will separate its EV and internal combustion engine businesses, it's essentially a change in semantics, acknowledging that EVs will require unique talents and processes. The real benefit of change might be bestowing the Ford Model E unit with the operational nimbleness needed to build EVs without the bureaucratic hurdles common in a 100-year-old global manufacturing company. And if you just take a look at the board here, I think it's also telling that GM, kind of in a similar boat, up 4%. And again, as some of the analysts speculating, some of these guys might be doing it as well in competition with Ford, of course.
Yeah, it'll be interesting to see who comes next and does a similar sort of thing in that sector. All right, want to switch gears and talk about Nordstrom because shares there soaring as the results come in and guidance much better than expected, and also trying to squash those rumors that it will split its Nordstrom rack business, which actually performed quite well.
Yes, indeed. And you can see Nordstrom. Now, this is a stock that has been beaten down. This is a one-year chart, down 28%. You can see today's price action. By the way, the best day that the stock has had since November of 2008. That was right after the volatility that Lehman Brothers, its collapse, bestowed on the market. So kind of a blip in the long-term picture here, but is nice to see a 37% move in a stock. And I do have some commentary from the street. Telsey, which rates the stock a market perform, they raised their price target to 30 from 27, so that's $3 above the current price. And they're saying EPS upside came from, quote, much stronger sales growth and also greater gross margin levels, partially offset by higher selling, general, and administrative expenses, that's SG&A costs. Resumption of travel, in-person events, and a return to work are encouraging early signs and should be supportive of growth. Also noting that visibility remains challenging against those macro pressures. And let me just give you a longer-term chart of Nordstrom here. You can see over the last 5 years, trend has definitely been down, but we do have the potential for a lower high, or excuse me, a higher low here. So we have to see if these highs right here can reverse that trend if they're taken out, guys.
All right, Jared Blickery, thank you so much for that. We're going to keep it on the markets and bring in our next guest, Kevin Flanagan, is Wisdom Tree Head of Fixed Income Strategy. Kevin, thanks so much for joining us today. I want to start off with Fed testimony and what Powell had to say. Do you perceive his comments as perhaps being slightly less hawkish, a little bit more dovish at this point?
Yeah, to a very, very small extent. I think, the markets have been waiting to hear from the chairman for quite some time now with all of the various news headlines that we've had, markets pricing in 7 rate hikes, 50 basis points move for March. So it was nice to actually hear from the chairman himself. And I think what's more important is that he knew the markets would be focusing very intently on his wording. So for him to say he is inclined for 25 basis points in March, we should take that for what it's worth, for sure.
And so how many rate hikes do you see coming during the year? And then what about his comments as far as tightening and running off the balance sheet? Is that more or less in line with expectations, do you think?
Yeah, I think at this stage of the game, even with the unfortunate news of what's happening with Ukraine and the Russia-Ukraine crisis, I still think the Fed is where we should be staying focused, the Fed and inflation. So I could see the Fed front loading here and raising rates at the March, May, June, and July meetings, perhaps for a total of 100 basis points. And then they move to their balance sheet in the second half of the year. Remember, a runoff of their balance sheet is akin to another quarter point rate hike. So maybe that's how you get to 5, 6 rate hikes or so, some the traditional way and some via the balance sheet.
I'm wondering how fine a line do you think the Fed is walking right now, hiking into higher energy? Inflation is soaring. How worried are you that they actually stick the landing? They just said, Fed Chair Jay Powell said that they can stick the landing, but how concerned are you about stagflation and potentially recession?
Stagflation, I don't think is really on the radar. I think, if you were to break the word apart, the inflation part, I think that's going to continue to remain sticky. It's going to be difficult for the Fed to bring inflation down any time in the near term. There's only so much they're going to be able to do by raising rates, as we were just discussing, even their balance sheet. On the stag side, I think the good news is that the Omicron variant really did not hit the economy as some were expecting. So we're actually, I think, in a better position moving forward, as one would have not maybe anticipated if we were having this discussion a couple of months ago. So I think we can have nice solid growth. Let's call it maybe in the area of 3% or so, but it's that inflation part that's going to remain sticky.
There's been a monster bid into bonds recently. I mean, today yields are higher, but what do you make from the yields? What are you signaling? What does it signal to you, and where do you think they go from here?
Well, this week's plunge in yields was really, I think, a function of the news over the weekend. From what we saw with Russia being removed from the SWIFT system and some of the other kind of financial sanctions on the central bank in Russia, that there's concerns at any point, whether it was the financial crisis, March 2020, when COVID first created the lockdowns, there's concerns about the funding markets. Are our firms, our banks going to be able to fund themselves? And we really have not seen any kind of red or even yellow signals showing up in those markets of yet, but there was enough caution involved that it was kind of a student body right mentality, flight to quality into bonds. And now, we come back, staying focused again, right? We come back to the Fed, to inflation, Powell speaking. And the next thing you know, you have, as you just pointed out, a 10-year Treasury yield up 15 basis points today. So I think that's the direction. A sawtooth pattern, volatility, but we still feel rates are going to continue to move higher later this year.
And what are you hearing as far as concerns from your clients, and what are you advising them as to means to sort of protect their portfolio at this time?
Yeah, well, I mean, the focus has been on rate hedging. Rising rates has been our primary theme for quite some time now. And when the chairman of the Federal Reserve basically tells you he's going to raise rates 25 basis points, we should listen, right? It's not often that you get the Fed chair actually sort of laying it out as to what is going to occur. So, what we've been doing is talking about a Treasury floating rate strategy, where you have Treasury floating rate notes that are 100% Treasuries. They adjust every week with the weekly 3-month T-bill auction, and it's a nice complement for the core part of your bond portfolio. And there's no credit aspect, right? There's other instruments that can have credit or concentration in financials. This is 100% Treasury. So as the Fed raises rates, this should continue to move and adjust and float higher accordingly, and the duration is 1 week.
And Kevin, what's your take? I'm interested to learn about the energy issues that are happening right now, and news that OPEC Plus will keep output steady, 400,000 barrels to be put out in April, no more despite a conflict that's going on. And then, of course, the IEA releasing the 60 million barrels of oil from its reserves, just a drop in the bucket, really, equivalent to 6 days of Russian output. That's not going to do very much. One analyst saying that, if the number was 200 million barrels of oil, that might make a significant difference. Do you think that we need to be drilling more in this country at this point?
Well, that's certainly going to be the argument from the Republican side of the aisle that we've begun to hear already. I'm not quite sure the Biden administration has moved into that camp yet. But what we're seeing, obviously, with respect to energy prices, it hits home. And it's something that obviously was mentioned in the State of the Union address as well. And that's something the Fed can't really do, or a central bank really do anything about, right? Higher energy prices. And the question becomes, is it inflationary, or is it more of a tax on the consumer? I think as long as we continue to have it moving forward and not being a significant tax on the consumer, it's status quo. I think if we get to the point where it begins to affect economic growth here at home, perhaps then you see the Biden administration maybe consider other aspects on how to increase production here at home.
Well, investors are definitely taking it all into stride today because the benchmarks are at session highs at the moment. We'll have to leave it there. Kevin Flanagan, Wisdom Tree, head of fixed income strategy. Thanks so much for your perspective today. Alexis, I'll send it over to you.
All right, thanks, Karina. Coming up, Zoom offers a weak first quarter outlook, but sets its sights on bigger customers. We'll speak with Zoom's CFO next. Welcome back to Yahoo Finance Live. Zoom was a pandemic darling and just delivered quarterly results that edged past Wall Street's expectations, but the company did provide disappointing forecasts for both the April quarter and the full year. Meantime, the stock is down some 80% from its peak back in October of 2020. Joining us now is Zoom's CFO, Kelly Steckelberg. Kelly, good to see you again. Look, we all saw it coming, I think, even with inside Zoom, as we continue to come out of this pandemic. Growth at Zoom has slowed in comparison to where the business was at the peak of the pandemic. But you announced that the company is going to be pivoting and focusing more on the enterprise customer, the bigger customer. Tell us why you're doing that and what it might mean for the bottom line.
Sure. So first, we were really pleased with our FY22 results. We grew to $4.1 billion with 55% year-over-year growth. And as we're looking forward, we really see the long-term sustainable growth for the business coming from these large customers that are touched by our direct organization. During the pandemic, we really benefited from customers that came to us buying from our online channel, and it's about 50% of our revenue today. But as you said, we're starting to disclose metrics that are more targeted around our enterprise business, which is where we think we'll really see long-term growth, even as organizations are thinking about going back to the office. They want to make sure they provide the flexibility and support for their employees in this new hybrid environment. And that means equipping them with Zoom, bringing it into their conference rooms through our Zoom rooms, as well as Zoom events, which will also start to be the future of how organizations have hybrid events.
Kelly, on a personal note, I just have to say how thankful I've been for Zoom, because I've been able to attend family weddings on the other side of the world, been able to attend gatherings, bat mitzvahs, funerals as well. And I'm so thankful that Zoom was able to help deliver that on a personal note. You know, so many companies have been dealing with margin issues, and yet your company managed to grow margins 76%, up from 74%. What do you think attributes to that?
First of all, we're so happy to hear that we were able to support you during this time. And we hear that from our customers all the time. And in terms of our overall margin structure, so we have always had a very efficient structure. The way that our organization, as well as our hardware and technology, has been built. And so, as you said, we had very strong gross margins during the period. And that is due to the fact that we are working on migrating a lot of our traffic from the public cloud, which we really relied on during the height of the pandemic, back into our own servers in our co-located data centers. And we have a very efficient team that's focused on this. So that's what really enables us to bring a lot of value to our customers, to provide a lot of value in terms of our pricing, and still provide those high margins to our investors.
Kelly, can you tell us what Zoom's exposure is to Russia and Ukraine? And we're seeing more and more corporations take a stand, I guess, against what's going on there. We know that Apple, Boeing, ExxonMobil either taking their products out of Russia, or saying they're not going to offer their services. Is Zoom making any sort of statements right now regarding that?
So first of all, our hearts go out to everybody impacted in the region of Ukraine. And we feel very fortunate as a company that we don't have any employees directly in either of those regions, but we do have some extended family members of our employees there. And we've spent a lot of time thinking about this. And in terms of Russia, we don't feel like cutting off a means of communications for the citizens there would be the right thing to do right now, especially as we're in the midst of this pandemic still. So we constantly are monitoring the situation. Of course, we'll comply with any sanctions. And we are also currently working on lifting our 40-minute limit for the region of Ukraine. So that would make our service available for free for anyone there. And we're very close to bringing that to light.
That is certainly a lifeline, I'm sure there. You know, we've heard so much recently, Kelly, about cybersecurity risks, and I'm wondering, how is your company positioned to try and avoid those should they happen?
So we have invested a lot in security and privacy over the last couple of years. We have an amazing CISO, Jason Lee, who keeps us all ever vigilant around this issue. And given the heightened risk that we're all facing today, they are really front and center. And this is an area, a concern that we take very seriously. It's an area that we continue to invest in as a company. And we do a lot of education because We have almost 7,000 employees around the world, and all of us need to be attuned to this. And Jason does a great job of keeping us all focused on that every single day.
And just a word about the competition in your space. I mean, it's pretty intense. You've got Microsoft Teams continuing to expand and innovate. Ring Central, which I know was a former business partner of Zoom, now looking to become a full communication platform. How are you staying relevant and how are you innovating? I know you have the Zoom phone. How much is that part of the equation going forward, and perhaps differentiating by moving away from some of the video conferencing services that you offer?
So first of all, Zoom Phone, we are thrilled with the momentum that we're seeing there. That is our cloud PBX solution. We had a record quarter in Q4 selling over 550,000 seats of Zoom Phone. And we are continuing to innovate. As I mentioned earlier, one thing we're hearing from our customers is they want to understand how to bring their employees back to the office and do it in an inclusive way. And so we have some amazing innovations around Zoom Rooms, including things like Smart Gallery and Companion Mode, which are really great tools to recreate the experience we've all grown used to during this pandemic of seeing everybody on the screen. We also are thrilled that just last week, we announced the general availability of Zoom Contact Center. So this will be our cloud contact center solution that will be fully integrated into our suite of products built on modern architecture. And so we are continuing to invest in R&D and bring these products to our customers that solve the problems that they ask us to help them with every single day.
All right, we will have to leave it there. Thank you so much. That was a great conversation and great to hear about your efforts in Ukraine. Kelly Steckelberg, Zoom CFO, thanks for your time today. Alexis?
Thank you so much for having me.
All right, coming up next, more reaction to President Biden's first State of the Union address. Heading into his first State of the Union address, President Biden's approval rating stood at 43%, the lowest of his presidency, and only 37% approve of his handling of the economy. So, did last night's speech help move the needle? Let's check in with Ed Mills now. He is Washington policy analyst at Raymond James. Ed, good to have you here. You know, a lot of folks were talking about last night's speech being really a critical moment for President Biden and for the Democratic Party with midterm elections now upon us. Was he able to sort of lift that leadership mantle and say what needed to be said last night to help out his party?
So overall, our takeaway from the State of the Union was unity on Ukraine in divisions domestically. I don't think this is a speech that fundamentally changes the political picture for President Biden, but I do think it was a speech that was at first trying to lay a foundation with his base, trying to get the leaners for the Democratic Party, independents who have gone away, which has been part of those lower approval numbers, back into his fold, back towards the Democratic Party, seeing if he can build upon that. You saw it very heavy on that domestic agenda that allowed him to be elected president. We'll see if it actually makes a change, but probably from a DC agenda perspective or political perspective, I don't see day after a significant change.
You know, ahead of those midterm elections, I felt like he tried to emphasize a lot of issues that have been part of sort of the Democratic messaging to voters. He talked about gun control, talked about the child tax credit, and also talked about not defunding the police, right? But actually funding the police now. We know that's been a sore spot for lots of Democratic areas around the country. Do you think that his messaging there was enough to bring back some of the Democrats who were maybe turning away from the party?
Yeah, Alexa, I think you are right, especially on the defund the police part of the conversation. What you have seen is that has been politically very damaging to Democrats and caused what was a weaker than expected outcome, especially in House and Senate races in 2020. You did see him lay out a number of proposals that are not going to pass into law. You look at the math in the Senate, it's just not there. You look at him adding back things to the Build Back Better agenda that Senator Manchin or Senator Sinema have already said that they're a no vote on. So I think the debate for the market has been when we look at some of those fiscal measures, are we seeing a pivot towards an election cycle and a pivot actually away from getting those signed into a law and more back to the political arena?
He again called inflation his top priority. It's going to be brought up by the Republicans, certainly, as we move closer to these midterm elections. Did you get the strong sense that he really had any plan to meaningfully deal with higher gas prices, higher grocery prices that all Americans are having to deal with and are probably top of mind for most voters?
I think that's one of the big criticisms of the speech is that it was a I feel your pain moment. But the policies in terms of what he was going to do were lacking. I think that you saw in the press conference he held about a month ago, it was, hey, Powell, Fed, this is your problem. Please solve this. When you add in the new layers of complexity with the geopolitical risk of the Ukraine and Russia war, you have higher commodity prices, more pressure on inflation without a kind of full-throated plan by the Biden administration. So unfortunately for him politically and for Americans who are paying more, inflation seems to kind of be sticking around more than he would like it to be.
And certainly he spent time on Ukraine. Some thought he should have spent a little more time. I think it was about 12 minutes worth at the top of the speech. But, you know, I really didn't hear any references to China. He failed to address other national security issues. What's your thought on that?
So the area where he suggested changes on China is what's known as the U.S.-China competition bill. And so all of the focus on Intel and their investment on a new semiconductor plant in Ohio was about a bill that is stalled in Congress. It's passed the House, it's passed the Senate, but we don't have agreement on some of the more controversial provisions. I do think that the Biden administration is going to push for that. That's about more research and development funding in the United States. It's another $52 billion of funding for the semiconductor industry. So kind of the agenda on China is how do we build more in the United States? How do we confront some of the competition? How do we invest in what they are seeing as a critical kind of technology that the United States has the technology capacity for, but doesn't necessarily have the manufacturing of. So that's more of the geopolitical push on China that I was focused on from the speech.
And Ed, just finally, anything compelling or new that you heard from the president last night? And I'm going to put you on the spot here. What grade would you give his first State of the Union address?
So overall, probably an incomplete because we are not going to see a lot of these policies put into place. One thing that was interesting to me was a conversation about new privacy regulations for children vis-a-vis social media. One of the ways to get legislation done when things stall is focus it on kind of protection of children. He talked about the PRO Act that has no real prospect in the Senate. That's a big priority of labor unions, but you could see the Department of Labor regulate there on independent contractors. So I guess one of the big takeaways I had from listening to this is beyond being a political pivot, is this also recognition that the next things that we see out of this government is more regulatory push as kind of the legislative agenda might be coming to an end.
All right, Ed Mills, Raymond James, Washington policy analyst. Thanks for your insights today. Karina?
Thanks, Alexa.
All right, thank you so much. And we will take a quick break. On the other side of it, a check of the energy sector as crude continues to soar. Welcome back to Yahoo Finance. Well, oil at another multi-year high today as the conflict turns uglier in Ukraine and as OPEC holds steady on output, announcing 400,000 barrels to be released in April, if they can actually even stick to that amount that they can deliver amid tight supply. Here with more on all of this, let's bring in our Yahoo Finance's Jared Blickery. A little bit of a surprise that they are holding steady despite a conflict in Ukraine.
Well, that's right. And as you said, there's not a lot of spare capacity by some of them, although Saudi Arabia still does have a lot of has a lot of spare capacity. They could increase that production if they wanted to, but 400,000 barrels increase per day was expected, and that's exactly what the market got. Now, WTI crude futures for April settlement just closed at $110.60. Haven't seen these prices in 8 years, and this is just an incredible move. I want to show a longer-term chart with candlesticks here. This is a 2-month. This is where oil is starting to go parabolic. There's incredible backwardation in the futures term structure. It means there's a lot of demand for the front month contracts and not a lot for the distant month contracts. And when we see these excesses, and we've seen them before, I haven't seen anything like this probably since 2007, 2008, when commodities peaked in their last super cycle. When this happens, you really have to be careful because we see declining open interest. That means not as many people are in the market right now, and yet the price is going parabolic. So it just creates a very volatile, dangerous situation for traders. And before we get to our energy stock heat map, I just want to point out, look at all this green action up here. Heating oil up 11%, wheat up 7%, RBOB gasoline futures up 7%. So a lot going on in this space. And let's take a look at the energy sector before we close out here. Exxon up over 2%, Chevron up over 3%, Shell up over 5%, Total 8%. So a lot of these energy majors benefiting from this rise in price. The question is, how high is it going to go, and how high will it correct, or how low will it correct to?
All right, and we'll be watching all of it, and not to mention Brent up at $112 as well. Okay, we're going to turn things over now. It's time for the ETF report brought to you by Invesco QQQ. And want to bring in our guest, Dave Noddig, CIO, Director of Research for ETF Trends. Thanks so much for being here, Dave, today. The Russian stock market is still closed, correct, for days. So what does that mean for Russian ETFs in general, because they're getting clobbered?
Yeah, so not only is it closed, it's going to be closed tomorrow. They just announced that a few minutes ago. I think we'd be shocked if they opened for one session on Friday before going into a weekend in the middle of the war. So I think it's safe to assume the Russian market is closed for the foreseeable future. The big ETFs that track this space are in an interesting position. The biggest one in the space is RSX. It's the VanEck Russia ETF. Until the last couple of days, it was about $1.5 billion. Now it's sitting at about $200 million for the obvious reasons. These funds don't generally own the underlying equity in the MOEX, in the Moscow exchange itself. They tend to own GDRs, global depository receipts, either in London or sometimes in the United States. And those are still trading. The challenge is they're trading now at really delistable prices. So something like Gazprom that previously was trading at a couple dollars, it trades in dollars in London, is now trading at literal pennies. And we have Sberbank, which is now pulling out of Europe, trading at actually bid zero for part of the day and bid a penny most of the day. Obviously, these are not viable securities anymore. So what happens in this environment is the ETF becomes price discovery for the Russian market at large. So when you're looking at something like RSX, it's important to focus on what it's trading at and not try to worry about net asset values or what it might be, quote unquote, worth in a fair market, because there is no fair market for those underlying securities right now. It's one of those cases where ETFs really become the entire market.
You know, if this conflict continues for a protracted amount of time, you know, what impact does global companies pulling out from Russian oil projects like Gazprom have on the sector as a whole?
Well, I mean, we're in really unknown territory. I mean, the last time we really had a push to effectively create a pariah state out of a connected state was probably the late 70s in Iran, when obviously global markets look nothing like they look right now. I've actually been somewhat shocked by the speed at which the global financial community has moved, not just in sort of a regulatory level, like in sort of official sanctions, but individual companies announcing that they're selling individual projects, particularly in the energy sector. I think it's very difficult to say what that means with sort of big air quotes around it. I think we are genuinely in untested territory. So what I'm telling people these days is to be very, very cautious trying to call a top or a bottom in any piece of this. I think it's a very dangerous time to start trying to play energy and oil. I think it's a very dangerous time to try to call a bottom in Russian stocks. I think there's far too many shoes to drop here.
How difficult a position are index providers in at this point? MSCI removing Russia from its index, others under pressure like JP Morgan.
Yeah, I think it puts index providers in an interesting position because things have moved so quickly. What we've seen most of the index providers say or announce so far has been effectively a cessation of any changes to the existing indexes. That is, you know, MSCI has a Russia index. They're not canceling the Russia index. They're simply saying we're going to freeze it for a while. We're not going to make any changes, additions, rebalances, corporate actions. It's going to stay static. That's what the MVIS index behind the big Russian ETF is doing as well. That's sort of a minimum condition. That's just sort of a pushing back from the desk and seeing what the world is going to look like in a few days. The bigger question is they move towards rebalance periods, say towards the end of this month, as they start looking towards a market that may not reopen for foreign investors at all. It creates interesting questions about what you do with Russia, say, in a broad emerging markets index. Do you kick it out right away? Do you transition out? It's a very difficult situation. It's not even clear to me what, say, a big broad emerging markets fund would do with their Russian stocks if it got kicked out of the market, kicked out of the index, because there is literally nowhere to sell them right now.
Only about a minute left, but I want to ask you, what does this do to energy ETFs, particularly renewables, amid this conflict?
Yeah, I mean, I've read notes today from bankers on both sides of this issue. The thing that I've been looking at that I think is very interesting is KRBN, which is the Crane Shares Carbon Credit ETF. It's been, pardon the pun, a little bit of a canary in the coal mine on reaction here. You would think that with prices for oil and frankly all fossil fuels headed through the moon, you would think that there'd be this pushback and then this need for carbon credits as you move towards dirtier and dirtier fuels like coal to make up the difference. But what we've actually seen is them trade way down. I think that's largely financial players moving to the sidelines to see whether or not we're going to see some change, particularly in EU commitments to renewable energy. The EU has been a huge driver of this. It's not inconceivable to think that those rules might at least get delayed or changed in the wake of, say, turning off all Russian fossil fuels, but we just don't know enough yet. So I think it's a very difficult sector to call right now. I would frankly advise people to stay away from it if you're not in it and be cautious about selling it if you already are.
All right, words to heed there. Thank you so much. We'll have to leave it there. Dave Naudig, CIO Director of Research for ETF Trends. Thanks for your time today. We're going to take a quick break, but on the other side of it, another squeeze on the Kremlin. Major shipping companies now pulling out of Russia. Welcome back. Well, major container shippers say they will not sail to Russia, halting cargo bookings. To help us discuss, let's bring in our next guest. Peter Sand is Zaneta chief analyst. Peter, thanks so much for your time today. So this is a fast-moving issue. The story is changing. It's very fluid and dynamic. But just help us put it all into context for us. So 3 of the largest shippers in the world, Maersk, which is the first company I ever worked with, MSC and CMA, all 3 cutting ties with Russia. What does it mean for global trade and supply and demand?
It means that global logistics just got a little bit more difficult to handle than the critical situation already suggests. I guess it's known to everyone that global supply chains are quite strained at the moment as a result of 2 years battling COVID. So having now Russia cut out of the global shipping networks, accounting for some 2 to 3% of global containerized goods, is obviously another disruption on top of what we see already in the market.
How big of a disruption is it, though, percentage-wise?
I think this is approximately 3% of the global containerized markets, but it's very much more significant in terms of how the impact is on Russia, Russian consumers, Russian industry, as it is for the global containerized industry that will, you can say, merely be without a few customers during these times of crisis, and they will omit calling ports like Novorossiysk in the Black Sea and St. Petersburg in the Baltic Sea. So obviously, this is something that requires yet another raft of contingency plans in terms of optimizing networks, and of course, for the global shippers, that also relies on efficient networks to ship goods from where they are produced to the customers that need them. It's just a sign of things getting worse soon, and most likely higher freight rates will follow in the wake of this.
Do you expect more shippers to follow suit, taking the lead of these big three? Because what are the risks right now of doing business with Russia?
I think the main risk, of course, is to be caught out in breach of sanctions. And that goes not only for the major container lines, which I think is the key element of their decision here. Obviously, they are in the need of staying clear of being in breach of anything. So they, of course, abide to what is now being decided. But every shipper on a global scale also needs to be safe and make sure that all risks are considered when doing business right now. Because if you are caught out being in breach of secondary U.S. sanctions, for instance, that can really hamper your business and your ability to do business with the Americans going forward. And that can be super critical for any international and global business.
How about bookings that are already made? Are those in jeopardy as well, or will those continue on?
Well, we have been accustomed to an equipment shortage in the key exporting regions, and what will happen to the so-called floating cargoes that we have on the ships right now? They will basically be discharged in places where they should not be. I mean, they were destined for Russian and Ukrainian ports. And now they will be discharged instead in Bulgaria, in Romania, in Greece, and around the Suez Canal, for instance, and Hamburg, of course, also being a major hub for exports via Baltic Sea into Russia. So we will have a worsening situation in terms of these boxes basically being stranded in the wrong places and not a part of the real circulation of this global network of supply chains.
And then in the meantime, what's happening with Ukrainian ports? Obviously, there's a lot of pressure there with all the conflict.
What the global carriers did at the very first day of this crisis was basically to call off any port calls in Ukraine. Instantly also, we had the big insurance body, the Joint War Committee, raising the risk premiums for going into the northern parts, basically the Ukrainian and Russian waters of the northern Black Sea. So that already elevated the cost of shipping into those areas, but mainly liners did not call primarily Odessa, the southern Ukrainian port in Black Sea. And of course, that already disrupted in the first place. It took them a few days also to find out that doing business with Russia was definitely also a no-go. So two countries taken out of, say, the rest of the world in terms of an otherwise very globalized shipping business.
It is definitely a difficult situation, and all sorts of products being impacted, everything from clothes and food to metals to electronics. All right, thank you so much for your time. We'll leave it there. Peter Sand, Soneta Chief Analyst. Alexis?
All right, thanks a lot, Karina. Coming up next, a Russian billionaire looking to sell his soccer club, plus the very latest on the Major League Baseball lockout when we return. Welcome back, everybody. Russian billionaire Roman Abramovich announced today that he plans to sell the Chelsea Football Club and will donate the proceeds to help Ukraine war victims. Yahoo Finance's Josh Schaefer here now with more details. And Josh, I know that he had come under pressure right away to sell the team right after Russia invaded Ukraine.
Yeah, Alexis, it's a story we've been following for a little over a week now, and it seemed earlier in the week like maybe Abramovich was just going to kind of separate himself publicly from Chelsea, but not necessarily financially. Turns out today, as rumors were swirling in the media, Chelsea comes out with an official statement from Abramovich that he intends to sell the club. So the Premier League club is one of the most expensive in the world. We should note it's at an estimated $3.2 billion per Forbes, and that's about $2.3 billion in pounds in England, where the club is. And Abramovich said the sale isn't planned to be fast-tracked. They're going to take their time, and he won't be asking for any of the estimated 1.5 billion pounds he's loaned Chelsea over the last 19 years as he's owned the club. Part of his statement here, he said that he said, quote, "I've instructed my team to set up a charitable foundation where all net proceeds from the sale will be donated. The foundation will be for the benefit of all victims of the war in Ukraine." This includes providing critical funds towards the urgent and immediate needs of victims, as well as supporting the long-term work of recovery. So now we're sort of left to see who's going to be interested in the club itself. Should mention several American ownership groups do own Premier League clubs. I'd expect some American billionaire or billionaire group to be interested in this club, and we'll see what happens there. And then the other big thing to watch here is going to be what does happen with that foundation. Does the foundation, where does the money exactly go that is going to be given to this charitable foundation, and how is it used? I think is going to be an interesting thing to watch as this sort of progresses.
Hey, Josh, and then switching gears back here at home, major problems for Major League Baseball. Fans have to wait longer for the start of the season because of the lockout. Bring us up to speed on what's happening with the negotiations there. And then what does it mean for businesses and brands as well tied to the season and to rely on it?
Yeah, Karina. So where we're at now is we're going to have the first stoppage in baseball, no games being played for the first time since the 94-95 strike. Late afternoon yesterday, the MLB declined what the league claimed was their best offer. It included some gameplay concessions, but sort of fell short of what the Players Association wanted financially. One of the key sticking points here is it's a critical point. It's the competitive balance tax, which is essentially the soft salary cap the MLB has. The MLB doesn't have the salary cap, how much teams can pay players, that a lot of other leagues have. So they have this competitive balance tax. The MLB's proposed competitive balance tax was about $33 million off from what the MLB was giving it. The MLB proposed no move up in this competitive balance tax. The players essentially just want to be paid more. So they're off on a few other sticking points too that I wanted to point out. They're off about $55 million for pre-arbitration players. So that's younger players that are sort of outperforming their contracts. They want those players to get more money. And the MLBPA and the MLB completely disagree on that. There's two sides. The two sides are also off by about $25,000 on the starting minimum league salaries. So they're way far off on those as well. And so we're showing some of the graphics now that I wanted to point out that kind of illustrate what the players are arguing here. So there you can see the player average salary there is pretty stagnant from 2017 through 2019 and starting in 2016. If we go to the other full screen that we have that shows how much the league makes, the league revenue, you can see that's a pretty big increase from 2016 to 2019. So we pretty much have the players saying, hey, you made about $1.3 billion more dollars in 2019 than you did in 2016, but our average salary isn't moving at all. What's up with that? And the final argument that they really make with that we showed as well is MLB players' minimum salary is lower than every other sport. They just want to make as much money as some of these other sports, and especially these lower level players want to get paid. Right now, the sides seem pretty far apart. They're not even in active negotiations anymore. They're not in the same place talking. So I don't think we're going to see any movement here for a little while, guys.
Unfortunate for all us baseball fans. All right. Thanks a lot, Josh Schaefer. Appreciate it. Karina?
Okay, and that about does it for Alexis Christoforous and myself. Thanks so much for sitting in these 2 hours with us. There is much more to come on this positive session, though. We're going to take a quick break and then throw it over to our colleagues for more Yahoo Finance Live. They will count you down to the closing bell and beyond as investors digest the latest Fed testimony and the conflict in the Ukraine.
Markets moving higher today as Fed Chair Jerome Powell backs a 25 basis point interest rate hike in March and says he's prepared to move more aggressively to cool inflation. He made the comments on day one of his two-day testimony to the U.S. House Committee on Financial Services. This comes on the heels of market reaction to President Biden's first State of the Union address. In focus, the response to Russia's war with Ukraine and efforts to shield the U.S. economy as oil prices hit multi-year highs. The president also addressing inflation sitting at a 40-year high and the toll it's taking on the middle class as he encouraged people to return to work amid falling COVID rates, plus his plans to levy a 15% minimum tax on global corporations. Plus, electric vehicles from GM and Ford also getting a shout out in the State of the Union. We break down a major announcement from Ford as it splits its EV and internal combustion into two separate units. Ford's Chief Financial Officer John Lawler joins us with more on those plans. And is a climate neutral car in your future? Sustainable EV maker Polestar sees it happening by the year 2030. We dive deeper into where EV innovation is headed with drones and all with Polestar's CEO Thomas Ingenlath. And the cost of putting America's favorite pastime on hold. Major League Baseball cancels its first week of the regular season as negotiations over a collective bargaining agreement stall. Collectively, MLB clubs worth $66 billion when you factor in assets, revenue sources, and expenses. We talked to the league's NFT partner, Candy Digital, about the impact on their business. CEO Scott Lorin joins us to break that down and what the company is exploring next. Welcome to Yahoo Finance Live. I'm Rochelle Akufo, along with Emily McCormick and Brad Smith.
Great to kick off another show here today, and we're taking a look at markets to start things as we always do with just about 58 minutes left in trading activity. Take a look at the Dow Jones Industrial Average, up right now by about 1.9%. We'll round that off to 623 points to the upside there. The S&P 500, you're also seeing that handedly in the green. That's up by about 86 points right now, 2% higher. And then the Nasdaq Composite, the tech-heavy average, you're also seeing that higher to the tune of about 1.75%, 238 points to the upside. And standing by with more on today's tape is Yahoo Finance's Jared Blickery. Jared, want to bring you in here.
That's right. And also, I'd add to that the Russell 2000 up over 2.5%. And let's check out the price action today in the S&P 500 and put some candlesticks in here, or not. We'll go back to our line chart. And this was a little bit of consternation here, exactly what Powell meant when he said, is it going to be 25 basis points? That's what he's pushing for. But he also held out that it could be 50 basis points. Nevertheless, I was looking at Fed fund futures. Those are the contracts that people bet on to guess how much the Fed is going to raise or lower interest rates. There's now a non-zero chance, just a 2% chance of no rate hikes. I don't think that's going to happen, but that's what the market is reading. And let's take a look at the sector action for today. We have value. Value is in vogue, and we see energy that is up 2.5%. WTI north of $110 per barrel. Incredible. Financials just took the lead. They're up 2.7%. To the downside, we got communication services, but guess what? That's up 1% as well. Want to take a look at the bond market. The reason value is surging today is because we have higher interest rates. We have the 10-year T-note yield, an astounding move, 16 basis points, but you can see only reclaiming about half of the prior 2 days' losses. So bond volatility has been spilling over into general market volatility, and that is producing some of the downdrafts that we've seen. I want to point out the S&P 500, this is a year-to-date chart. It has struggled to get through the 4,400 level. It does that, and it has a shot at establishing another uptrend. But first, you have to clear that hurdle. We'll see what happens in the final hour of trading. Want to check out a couple heat maps before we close here, and let's check out the NASDAQ. And we can see Apple up 2%, so is Microsoft. Some outsized gains from NVIDIA, CSX, the railroads, so kind of broad-based around here. Even Airbnb, is up 4.5%. And semiconductors are flying today, guys.
Yahoo Finance's Jared Blickery. Thank you so much for that breakdown. And with stocks back in rally mode, our next guest joins us to help make sense of these moves and where we may be heading. Chris Zaccarelli is Chief Investment Officer for Independent Advisors Alliance. And Chris, thank you so much for joining us this afternoon. I first want to get your reaction to what we heard from Fed Chair Jerome Powell this morning, and particularly what he said about what we should be expecting from the Fed's March meeting. Let's take a listen.
So this is where that leaves me. I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike. We're also going to write down our new summary of economic projection, individual forecasts, which will show each participant's views of the path forward. in the economy and with rates. I also expect that at this meeting, we'll make good progress toward an agreement on a plan to shrink the balance sheet. We will not finalize that plan at this meeting. We'll do that when we think the time is right at a coming meeting.
So, Chris, this was an unusually clear message about the rate hike and other moves that we should be expecting out of the Fed in just a couple of weeks. How much of this rally today do you think is being driven by the clarity that we received this morning from Powell?
Well, I think a large part of the rally is being driven by that clarity. To your point, by expressing that 25 basis points is a likely path to the Fed, that takes away some of the uncertainty. There was a big debate in the market about whether it be 25 basis points or 50 basis points out of the gate. Clearly the conflict in Ukraine and what's happening with Russia and global sanctions potentially dampening global economic growth. So that makes it more likely that the Fed would want to go a little bit more slowly. But on the other hand, inflation is rising. And if you just look at oil prices today or any other measures of the softs across the commodities complex, they have to do something. And so 25 basis points makes sense to start. It's our concern that they're going to have to go for longer and higher than people are currently expecting. But at least they provided some clarity to the market in terms of the size of the rate hike for next month or for later this month. And that's probably why people are buying the dip, because they're seeing a little bit more certainty, at least in the near term.
And yet, even with this near-term clarity on monetary policy and the move higher that we're seeing across stocks today, the VIX, the CBOE volatility index, is still above 30. Should investors be taking this as a sign to proceed with caution in the near term for stocks?
We think so. We think it makes sense to be to have some caution. I mean, the Fed is going to have to raise rates in order to fight inflation. They have an extremely large balance sheet. That's $9 trillion that they're looking to run off. And that was another thing that Powell talked about. Not only did he telegraph the 25 basis points rate hike, he made sure that people realize that they're still looking to run off their balance sheet. We would guess it'd be maybe sometime in June when they would make that announcement. So balance sheet is not going to be pushed to the end of this year. It will be happening in the next few months. And so I think that's something for investors to keep in mind. I'm not surprised to see the VIX elevated because there's a lot of uncertainty about where things may go from here. And there's plenty of air pockets ahead if there is volatility through the Fed or even if things take a turn for the worse in Ukraine.
So then with that in mind, then, what are some of the key questions that you're getting from retail investors versus institutional investors? And what answers do you have from them, knowing historically what we've seen happen once the market corrects after some of these risks?
Sure, great question. And it's really interesting. You see a lot of institutions talking about how wars and other conflicts are typically short-lived. The market will sell off and then immediately bounce back. And so I think a lot of people are trying to follow that playbook. What retail investors are much more worried about is, what's happening with inflation, what's happening with their portfolio. Whenever we hit all-time highs, investors start to wonder, should they take some money off the table? And usually we try to keep investors invested in the market for as long as possible. We want to make sure that they're not listening to the noise around them. However, I would say it's interesting that the noise in Ukraine, which is causing a lot of consternation amongst retail investors, I actually think that's probably not the biggest threat to the market. I do think the Federal Reserve raising rates, either because of inflation or because of the size of their balance sheet in terms of financial conditions tightening, there are some risks out there. So, as always, we want our investors to think long term. But as far as portfolio managers and active managers for our retail clients' money, we are exercising a little bit more caution than we would say even the last 2 years.
So then how will your investment strategy differ this year versus last year when it was really COVID at the front of mind, but now we have other things like prolonged inflation and the Ukraine crisis perhaps lingering for who knows how long?
No, absolutely. I mean, I think the Ukraine crisis, with the exception of seeing the troop buildup at the end of December, where we knew that something may happen in Ukraine, for the most part, I don't think most people were predicting even a few months ago that Russia would try to take over the entire country. And so that's something that was really not foremost in our minds as investors, and something to protect against. For something like that, where it's a little bit of an unexpected event, just having good diversification can help you. What we were worried about was inflation becoming entrenched, the Fed having to raise interest rates. And so in a higher inflationary environment, we were talking about how energy and financials, over the last couple of months, and even when I sent my notes out yesterday, were better places to put your money, because if rates go higher, all things being equal, that's good for financials. And energy is one of the biggest beneficiaries of inflation. And so we were pointing out that when everyone was making that risk-off move to utilities or to longer duration equities, it made a lot more sense to us to stick with the value trade, to look within financials and energy. And sure enough, that's what's happening today. We're not trying to make day-by-day predictions, but we do think there's a trend in place where ultimately value over the course of this year should outperform growth because of inflation, because of higher interest rates, regardless of what happens in Ukraine, which we also do believe will be somewhat of a short-term impact on markets, as bad as it is a humanitarian disaster, and clearly global growth will be affected. So it is a factor.
And so even with today's move, how far out do you believe that the markets are looking, even if we do have from Fed Chair Jerome Powell the signaling of a 25 basis point hike as of this point in time? There still is on the table that data dependency, which they're going to lean into, which could call for even more, not just quantity of hikes, but perhaps the quality of those hikes along the way could be even higher than 25 basis points.
From where we said it, we think the market's looking relatively short term. Clearly you're seeing a big rally in the major indices. You're seeing that kind of, well, I wouldn't say a rational exuberance, but you're seeing a buy the dip mentality. The idea that as long as the market is down because of what's happening in Ukraine, history will tell us that you should buy those dips because war and other conflicts, for the most part, are buying opportunities. We wouldn't be so aggressive. We would be a little bit more cautious. We would again look to what the Fed is doing. Powell did telegraph 25 basis points versus 50 basis points. So in the short run, that's bullish for the market. He did mention that they could raise higher amounts in the future and more often. So I think even though he's telegraphing that he believes inflation again will slowly take care of itself, he won't use the T word transitory, but he's still telegraphing that he thinks that inflation will largely come under control without as much effort as necessary from the Fed. But I think he has been humble, to use his own words, in terms of their predictions. And so the fact that they had to do that about face even a few months ago, from trying to let the economy run hot to quickly pivoting to interest rate hikes, which we're going to see in a couple of weeks, as well as balance sheet reduction, is an example of that. However, I think, again, the Fed may be surprised by how much inflation gets entrenched and how much they actually need to do to contain that inflation.
And so with what you said, in this market being extremely short-term looking as of right now, how much should investors be putting in play in terms of a percentage of their portfolio? What type of rotation and that activity should they also be putting in play?
For the way we've approached it is, we're trying to take a dollar cost averaging approach to any portfolios that are in cash. In portfolios that are fully invested, we're trying to be a little bit more safe with how we invest. We're not advocating that you go to cash or that we think the top is in by any means, but we just think the types of companies you should be buying should be a little bit more cautious. So again, back to the idea of a quality company in terms of pricing power in an inflationary environment, having a good balance sheet in case we do run into some financial difficulties, thinking about those companies with good brands, with good moats around their business, but a little bit more inflation protection than what you would normally need. And so we think it's the quality of the types of companies you're buying, not the binary decision about whether or not you should go to cash or get fully invested. That's really how we're approaching it, because I think there's so many unknowns, not only in the short run, but the medium term. And so we're trying to be a little bit more cautious without making a bold prediction one way or the other in terms of where the larger indices will go over the next few months, if not the next year.
Certainly. All right, Chris Zaccarelli, who is the independent advisor at Alliance Chief Investment Officer. Thanks so much for joining us here today. Certainly appreciate the time and insights. And everyone, coming up on the other side of this short break, we're going to be keeping a close eye on crypto here. It's actually turned negative for Bitcoin, Ethereum, and Litecoin here on the day, as well as Dogecoin. It's been on a run over the past week, though, as international currency movements prompted by sanctions amid the war between Ukraine and Russia have triggered a flight for cryptocurrency transactions. So how crypto exchanges are now engaged in their own gatekeeping after this quick break. Welcome back to Yahoo Finance Live, everyone. Global crypto market cap has been holding steady above $1.9 trillion over the past 24 hours. However, we've seen a little bit of a slip up for some of the major coins by market cap. Let's take a look at them. You've got a view of them here on your screen. Bitcoin right now lower to the downside by about 0.3%, sitting just below 44,000. We've also got on your screen Ethereum. That's down by 0.6% on the day's activity. Litecoin also lower by about 1.75%. However, holding on to some gains, you've got Solana that's in the green by about 3%. But Dogecoin rounding out our crypto performers here on the day that we're taking a look at, and they are lower by about 0.8% from what I can see here.
Well, as Brad just mentioned, Bitcoin prices are pulling back after rallying earlier this week, and these moves are coming as scrutiny mounts around how cryptocurrencies may be used to evade sanctions. Our next guest joins us for the latest on all of these developments. Nick Day is CoinDesk Managing Editor of Global Policy and Regulation and joins us now. Nick, thanks for being with us this afternoon. I want to start off with a development on Capitol Hill today. There have been increasing concerns that Russian individuals and organizations have been using crypto to avoid sanctions placed on them by the West. And to that end, 4 Democratic senators, including Elizabeth Warren and Mark Warner, wrote a letter to Treasury Secretary Janet Yellen asking whether crypto has been being used to hinder sanctions enforcement. Now, assuming the answer is yes, what are the measures that Congress or the Treasury Department could take to address this?
Hey, thank you for having me on. To that question, I'm not sure we've actually seen any evidence so far that crypto is being used to evade sanctions. If you look at Bitcoin and Tether trading pairs with the ruble, it's, there's been a spike, but it's not something significant. But, right now, a lot of exchanges, both in the US and elsewhere, are saying that they will enforce sanctions to the best of their ability as far as they are actually, required. So far, we've seen sanctions enforced against Russian banks, certain Russian oligarchs, but we have not seen any requirements that crypto exchanges or any other financial institution cut off Russian users entirely. And that's probably where the main concern might be, is if a sanctioned individual finds a way to bypass the know your customer requirements for an exchange. And should that happen, Treasury Department and OFAC in particular have a number of tools, including they've been sanctioning or finding crypto exchanges and ordering platforms to shut down over failing to comply. So it's not entirely, a case of this is going to lead to a runaway effect where, anarchists will bypass the financial system entirely.
And to your point about the fact that we have seen these crypto platforms like Binance, like Coinbase, saying that they will enforce sanctions to the best of their ability, but not unilaterally ban all Russian consumers. What do you think potentially went into this decision? What are the factors at play here for these platforms when we think about the enforcement, again, of these sanctions and deciding how they're going to treat their various consumers?
I think, it might be one part ideological, one part technical. On the ideological front, one of the ideas behind crypto is that it's accessible to anyone. And that includes, if you're a Russian citizen, Russian resident, and you want to be able to either, escape out of the ruble, which has had a pretty rough couple of days in terms of its value compared to the dollar. If you want to put your money someplace else into a different asset, crypto is supposed to be the one that's there, that's available for people to, utilize. On the technical front, it might also just be difficult, if not impossible, to try and block every single Russian resident, every single Russian IP address. You'd have to check and make sure that no one's using a VPN to mask their location. It would be a lot of work to preemptively do this, and even if the exchanges were decided that they should do this, or if they were ordered to, my guess is it would still take a little bit of time to set all this up in place.
And I'm wondering more broadly, too, do country-specific digital currencies also pose, in theory, a threat to sanctions enforcement, like China's digital yuan, for example? Or is there a way for regulators to have sanctions extend to these and extend to the enforcement of these as well in the future?
I think those regulations and enforcements would be the same as they are for the actual currencies that underpin these hypothetical digital currencies, right? The only way a digital yuan or a digital ruble would take off is if the actual underlying yuan or ruble also takes off as a reserve currency or as a potential reserve currency. So it would require the kind of buy-in and adoption that the dollar has from countries around the world. And so far, we haven't seen that happen. We haven't seen countries going around saying, yeah, we are definitely going to switch to this alternative, non-US dollar-based, non-SWIFT-based system. And so as long as that particular status quo remains unchanged, it seems difficult to see a future where central bank digital currency might usurp the dollar.
And when we just think about the price action that we've been seeing in Bitcoin over the past several days, of course, a major rally underway on Monday and Tuesday yesterday. Today, we saw prices top out at just above $45,000, now pulling back below $44,000. What do you think are the main factors at play driving Bitcoin prices? And what do you think that says about where we may be heading in the near term?
I think a lot of it is still, sort of speculative. When the sanctions were first announced, people thought, okay, well, we're going to have issues with growing inflation. We're going to see prices on, certain goods like gas and fuel spike. We're going to see a lot of these financial factors that, people are kind of looking at change. So crypto as a flight to safety has been, something that people have been looking towards. And speculative trading might have just, seen folks put money into Bitcoin and other cryptocurrencies. Right now, honestly, I found out that prices were slipping when I heard on the show, so I have not been keeping up with what's happening right at this moment. But if it is speculative, we're going to see some volatility, and so far, this has been a pretty small decline, at least as far as some of the utter falls and spikes we've seen in crypto.
All right, we'll leave it there for now. Nick Day, CoinDesk Managing Editor of Global Policy and Regulation. Thank you again so much.
All right, coming up after the break, our triple play. That's when we take a look at the three stocks catching our eye today and what's moving them. Intel, Tesla, and SoFi in our headlines. Welcome back to Yahoo Finance Live. I'm Rochelle Akufo, along with Emily McCormick and Brad Smith. It's time for our triple play, where we take a look at stocks that have really caught our eye today. Now, my pick is Intel. Now, in his State of the Union, President Biden called on Congress to pass the CHIPS Act. That's a law that would provide chip makers with $52 billion in subsidies to advance semiconductor manufacturing in the U.S. Now, that's welcome news for Intel, one of the largest semiconductor companies that's essentially cornered the market on PC and server processor markets. But you have to also remember, this is coming off of a time of being subject to a lot of shocks that we had from COVID, whether it was shipping delays from COVID, as well as the existing shortage of semiconductor chips. Now, it's interesting because Intel's chief executive and chairman recently purchased 5,600 shares and over 11,000 shares respectively, according to SEC filings. And that's when the stock was near a 52-week low. It'll be interesting to see that the investments that they've made heavily in spending in things like artificial intelligence and their automotive offerings, we'll see if those pay off. The stock is up for the day.
Yeah, and particularly on those automotive offerings, it'll be interesting what type of reception one of the spinoffs that they're going to push forward with Mobileye gets later on in 2022. That expected to come midway through this year. And so we'll see what type of reception that has. But it still comes back to this client computing group in this most recent year that brought in about $10.1 billion, which was actually down 7% year over year in a year that they had a record full year revenue once again, and I think that was the 6th consecutive year. And so it is a lot of the large questions that you mentioned about going forward from here. How will investors play the broader environment that Intel finds them in, and some of the necessary public sector movements that need to take place to prompt even more purchases, partnerships, but then even more so on making sure that they have the necessary materials just to manufacture for their end-based clients as well. And so that's going to be something that we watch on Intel, but still very interesting to watch them over the course and the stock action, the share price action over the course of this year. And since you mentioned the State of the Union, I'm going to kind of piggyback off of that for a hot second, because it's a company that wasn't mentioned during the State of the Union in Tesla. Of course, there was Ford, there was GM mentioned as the president was talking about some of the electric vehicle ambitions and what needs to be set up and put in place for that continued clean energy and clean consumption on the automotive front as well. And as we've seen this demand get prompted by, of course, Tesla entering in the market at the luxury end of the space, and then prompting even more of that kind of luxury annex, if you will, to the broader EV experience. I think for Tesla and what they've seen between Elon Musk and President Joe Biden, this saga has just continued. If you wanted some type of business saga to continue to watch, or perhaps business entertainment to continue to watch, then this is it right now. I mean, I've set up a Slack bot, and it's truly something to just keep tabs on all of the times that Elon Musk has kind of tried to counter President Joe Biden. And honestly, he has foundation for his claims because of the ground that Tesla has been able to break, not only here in the US, but internationally, and really bring EVs to the forefront in terms of that experience as well. And this is just the latest in the Twitter spat that you're seeing play out as well over the course of just the last 24 hours during that State of the Union address.
Well, Brad, and what I do think is interesting about this and the response that we've been hearing, this, of course, a very vocal response from Tesla CEO Elon Musk, is the fact that President Joe Biden did in previous remarks in early February acknowledge Tesla as America's largest electric vehicle manufacturer. So on one hand, it is a little bit interesting to not necessarily have heard a similar shout out of Tesla during the State of the Union address. But again, Tesla has made it into Biden public remarks in the past, not necessarily as frequently as we've heard him make mention of Ford and General Motors, for instance, but of course, always an interesting stock and an interesting personality to watch in CEO Elon Musk. But switching gears here, guys, I'm also keeping an eye on shares of the fintech company SoFi Technologies. Now, no State of the Union hook here, but this was company that reported earnings results recently that came in ahead of consensus expectations. We are seeing shares still up by about 5%, though off session highs from earlier today. Now, a couple of stats that I want to highlight here. New members to the SoFi platform were up by 523,000 quarter over quarter to reach a total of 3.5 million. That increase on a quarterly basis was a record in SoFi's history as a public company. So clearly there has been a lot of demand for SoFi's financial service products as well as lending products. And importantly, all of these improvements for the company are coming even as the moratorium on federal student loan payments was extended a few months back, meaning less revenue to SoFi from interest payments, at least in the very near term. And SoFi did say that it still expects revenue to grow as much as $285 million in the current quarter, with adjusted EBITDA coming in at between break even or as much as $5 million. And that does include a negative impact of as much as $35 million to sales due again to that extended pause on student loan payments until May 1st. So guys, I think overall a pretty strong report here from SoFi, and seeing the stock react in response to this as well.
And as you mentioned, with that growing number of members joining SoFi, we're seeing that growth really came along with SoFi launching a range of new products, as well as this broader adoption of digital banking. You know, with COVID, we weren't able to go into the bank as we usually would. People started exploring things. And SoFi has really been smart enough to take advantage and meet consumers where they are, which is on their mobile phones. And obviously, add to that its acquisition of companies like Galileo. That has also helped users who were already on that platform, and that's increased their use even more. So I think SoFi definitely ahead of the curve with its partnerships and as well as its rapid growth. So it'll be interesting to see where it goes from there as we continue to see more growth in the fintech and personal banking space.
It certainly doesn't hurt for SoFi to have all that free advertising as the host of the Super Bowl this most recent year, too. We're going to continue to track all of these brands and much more, but we're going to get back into the EV landscape, if you will, on the other side of this short break. Move over, Falcon Wings. The deployable drone is having its moment in the electric vehicle chat as Polestar drops the details on its second concept car, bringing a whole new meaning to cinematic mode. That is next. Electric performance car brand Polestar is revealing the Polestar 02 convertible that aims to provide sustainability combined with electric mobility. Joining us now with more is Thomas Ingenlath, who is the CEO of Polestar and Yahoo Finance's own automotive and mobility reporter, Subramanian. Great to have you both here with us for this conversation. First, let's dive in, Thomas, on why now was the time to reveal another concept like this and some of the features that we've already seen go viral within Polestar's newest edition of this sports car.
Yeah, hi. Nice to join you here today. Well, why now? On one hand, of course, our company is fully concentrated on the program to deliver till 25, the Polestar 3, 4, and 5 to get into production. Having said that, we have to, think about the future ahead, keep the vision alive, keep the research alive. What is all possible with the brand? And we discovered that this spot of electric roadster is actually not covered at all right now, and we felt it's really an opportunity to show what electrification can do to this premium sports car segment.
Hey, Thomas, Pross here. I'm curious, we've seen a lot of EV concepts coming out as SUVs, even pickup trucks. You mentioned the Roadster. Is it necessary to do this to kind of make the EV scene more sexy?
Well, it was always a big part of our ambition to promote the new sustainable mobility, strive for all of the reduction of CO2 footprint, but at the same time, of course, make sure people understand that this is connected with a highly emotional, great product, and that the future of cars in an electric age is as exciting as all the vintage cars and the glory of the sports cars that we love so much. So yeah, definitely it's important to emphasize this.
So there's also components of this car that really showcase some of the research and development. The dynamic response in particular comes to mind. And there's a larger question perhaps of how some of these new advancements lean on energy power any more so than perhaps preceding Polestar vehicles that are already in development.
Well, each and every work we do has, of course, is the next step in getting the CO2 footprint down. We, again, have materials in the car still to be research in terms of bringing them in production, but really putting that topic high up, bringing new sustainable materials that promote circularity, that promote keeping the natural fibers, replacing virgin plastic. All of that is part of our work. But then again, we bring as well features like the drone that you're showing here, which obviously go more into the psychology. How do we use cars in a modern time?
Hey, Thomas, so the O2 Roadster, does this sort of hint at a possible car in the future? I know you're using a lot of new materials and technologies. Is that going to be kind of what we'll see as a Roadster in the future? And also that drone you just mentioned, we've been talking about it here in the office. We think it's really cool. How did that idea come about?
Well, that idea about the drone was born in a conversation that I actually had with Eric Lichefu when I presented to him this Roadster concept. And feedback from his side was remarkable. He said, look, isn't the idea of this fairly, egocentric, you driving on your own in a fast track on a country road, isn't that a bit the old-fashioned world? How could we bring that into the modern times? And the modern times is about sharing moments, sharing experiences, being together with somebody, taking footage that you actually can remember and then, of course, as well share. So we created the drone concept, the drone being launched from your car, following your car. You can either have a very calm footage of you driving in there, or the drone makes a dramatic movie of zooming around the car and making really spectacular, dynamic footage. And that to be a great memory for yourself, but as well, of course, a memory that you can share and send to friends or the social media community.
Yeah, that's really exciting. Once you make the purchase, you got to be able to share what the experience is like, especially with a drone, basically as your kind of guide to exactly how that experience is going within the car too. When you think about the production and the production synergies that you're going to try and move forward with, as you have these next cars, launching 3 cars over the coming 3 years, starting in 2022, each of which has the potential to gradually realize some of the ideas presented by concept cars. how do you adequately source the materials necessary, and then essentially make sure that you do have that initial production target that is being able to be reached by the necessary materials that you also need to source?
Yeah, our portfolio has cars, the Polestar 3, an SUV coming, which is jointly together with Volvo built on a new electric platform, which we of course have sourced already, where we have production footprint which exists in the different parts of the world. Polestar 3 will be together with the future electric Volvo produced, for example, in Charleston here in the US for the US. So this is of course us being part and having access to an industrial footprint gives us this preparation to really scale up our business. With what we show here, the O2, we have as well in preparation a bonded aluminum body that we use for what was a concept car, Precept. We will put it into production, Polestar 5 coming. This is of course very much our sports car architecture, which is fully on the way of development. And here we show what door that opens to the sports car segment, which we then can cover with Polestar as well.
Hey, Thomas. So your guys' big Super Bowl ad this year really introduced the brand, I feel like, to a larger audience here in the States. What was the origination of that ad concept, and what do you think it says about Polestar as a brand?
Well, how do you talk to your audience? How do you talk to your customer? I think it was our way of making a point about being clear in your message, being transparent, not making false promises, and becoming a modern brand. I think that we really wanted to make a point of how our communication with the customer, what we stand for, is a different proposition.
Just very briefly, while we have you, we also know that Polestar also intends to list on the Nasdaq proposed business combination with Royce Guggenheim Inc., ticker symbol GGPI there. What percent of the proceeds anticipated from this SPAC are going to go towards some of the vehicle launch goals?
Actually, of course, here at the rooftop of the Gauss building, where we will present our O2 concept and our business, our joint business, us going together with Royce Guggenheim, is of course a very appropriate project for Polestar with our growth plans. We are very happy having found this experienced partner who really is great in the months that we had and the weeks to come, and we are very much looking forward to finalize this business combination and confident that this will happen in the second quarter of this year.
Excellent. Well, Thomas Ingenlath, it's been a pleasure to have this conversation with you, and really exciting. We got to get our hands on the vehicle as well here too. So we'll have to schedule a little test drive or something. It's Thomas Ingenlath, who is the CEO of Polestar, joining us here, and Yahoo Finance's own automotive and mobility reporter, Pras Subramanian.
Great.
And coming up, we'll discuss the latest on the Russia-Ukraine crisis, impact of sanctions, and response from the U.S. with Douglas Redeker, Brookings non-resident senior fellow. Don't go anywhere.
Welcome back to Yahoo Finance Live. Now, those rising oil prices above $112 a barrel showing that despite the president's State of the Union speech last night addressing the issue, markets weren't convinced. Let's take a listen to what he had to say.
A Russian dictator invading a foreign country has cost around the world. And I'm taking robust action to make sure the pain of our sanctions is targeted at the Russian economy and that we use every tool at our disposal to protect American businesses and consumers. Tonight, I can announce the United States has worked with 30 other countries to release 60 million barrels of oil from reserves around the world.
Well, for more on the State of the Union and the U.S. response to the Russian invasion of Ukraine, I'm joined by Douglas Redeker, Brookings non-resident senior fellow. Good to have you back on the show. Now, as we heard the president there bracing the American people for the pain of sanctions at home and trying to shield them by providing relief with lower oil prices. But to what degree can President Biden actually shield consumers and businesses from this fallout in such a globalized world?
Well, the oil specific issues are actually fascinating because to date, there has not been any disruption of the export of oil from Russia to the global markets. And yet prices are obviously exceptionally high. Similarly, the release of the Strategic Petroleum Reserve is much more of, I'm not saying it doesn't make a difference, it sort of does. But when you're talking about prices where they are right now, the market is making an assumption that there's going to be a massive disruption of supplies to warrant these high prices. And what President Biden announced is not really going to make a huge amount of difference. But the point is, neither what President Biden announced nor what's going on in Russia, Ukraine is actually directly related to what's going on in the pricing of oil. What's going on in the pricing of oil is that the markets are getting spooked by the uncertainty of the Russia-Ukraine crisis. That's fair. And they are extrapolating from that a traditional you see geopolitical risk manifest in oil prices. That's just a historical knee-jerk reaction almost. So that's what you're seeing. I'm not saying that the prices are right or wrong. I'm saying that to date, we have not seen a disruption in the oil flows that warrants this price. Ironically, if you looked at something like wheat, well, wheat has been disrupted. There's a war going on and major exports from Ukraine and Russia are being impacted. But the oil price is not actually reflective of supply and demand in the market today. It may be expectations driven. It's not based on what's happening in the market today.
Well, that's certainly important context to keep in mind there. Now, in terms of the sanctions, most analysts agree that this was a stronger response from the US and allies than President Putin was expecting, but the war is still going on. And that's after individual banking sanctions, followed by those on the SWIFT international payment system, Russia's central bank, individual sanctions on oligarchs and others, and of course, export controls. Break down the impact then of the effectiveness of these sanctions so far and the impact they're actually having.
All right, so sanctions can do a number of things. They can be a deterrent. Well, they weren't a deterrent in this case because, of course, the war is ongoing. They can be punitive, which means you are punishing the guy who started the war or who's doing the thing that you're trying to punish. And in this case, the Russians around Vladimir Putin himself, Russian citizens, Russian oligarchs, Russian banks, Russian companies are all being punished. And then sanctions can be used to negotiate leverage. The last part is the part that I don't want to say it troubles me, but that I haven't figured out yet. And that means at this point, it is hard to see how the sanctions that have been put in place are going to actually change Vladimir Putin's thinking. Simply because he's boxed into a corner, the sanctions we have put in place seem not to be the kind that you can dial up or dial down, meaning I can't see us in a situation where we say, we will let the central bank get involved in a little bit of ruble intervention, just not a lot, depending on what you do on the ground with your tanks and your bombs. It seems like it's pretty binary, and I'm not arguing with that. That's the right thing to do. But it does mean that the leverage we have to negotiate from these sanctions seems to me to be pretty limited. This seems to me primarily driven by a need to explain a response to the world for bad actions short of putting military boots on the ground. And sanctions are the hardest power we and our G7 partners have to show our displeasure and to try and make it hurt on the other end. But it's not really a negotiating strategy. Are they effective? They're very effective in shutting Russia off from the global financial and economic system that they've been very integrated with for the last several decades. What you've seen is a collapse of the ruble. You've seen an inability to do basic transactions at home. And you've seen oligarchs watch and say goodbye to their homes and their jets and their cars. This is all very effective in that level of effectiveness. Whether it will change the trajectory of the war is still an open question.
And just very quickly, I want to take a look at China and India, who are the two most populous countries in the world, who notably abstained from a United Nations resolution condemning the Russian invasion. What role do they play in undermining sanctions? And just very quickly, what does that mean for their relationships with the West and those who are putting sanctions on Russia?
Well, let's take them separately. India has a unique situation. India has historically, from the days back when Russia was the Soviet Union, has relied on Russia to provide it with its defense and military hardware and other defense capabilities. So India, which of course is adjacent to Pakistan, both of which are nuclear countries, and they don't always get along, India's military is deeply ingrained and reliant on Russia for spare parts, for military technical assistance, for all of the things that a military needs to be a functioning military. So India, while not defending their position, is really in a troubling relationship with Russia that they can't easily extricate themselves from. China is the big uncertainty here. China is what Russia is counting on to provide it with an economic and financial backstop. China, I don't think President Xi fully appreciated that there was going to be an invasion of this size and scale, nor that it would go as poorly as it has so far for President Putin, nor that the world would come out with such strong sanctions and condemnation. So China is now both allied with Russia and complicit in many people's eyes in this horrible exercise, but also at risk of alienating its two major trading partners, the US and the EU, which China's a self-interested economic actor. They're not so happy about that. China is stuck. And if this thing gets resolved at all, I think it's going to be because China has to step in and play a role.
We'll certainly have to see if that happens. We do thank you for your time and your insights. Douglas Redeker there, Brookings non-resident senior fellow. Thank you for your time this afternoon. All right, do stay with us. More just ahead on Yahoo Finance.
Welcome back to Yahoo Finance Live, everyone. Minutes left in today's trading activity. We got to check in with Yahoo Finance's Jared Blickery on the Yahoo Finance Interactive. Jared?
Yeah, we're looking at a close probably below 4,400. That's my critical threshold here. Want to see it above, but hey, tomorrow's another day. I think investors will take the gains that we're seeing. And you take a look at the NASDAQ 100. Nice story. A lot of dark green here. Apple up over 2%. Tesla and Amazon almost up to 2%. NVIDIA 3%. A lot of these high quality growth names are seeing some love today. Guess who is not? Aside from Tesla, the ARC components not really feeling much love today. And I think that's very telling. A lot of these names got beaten down because of their price multiples and because of their growthiness, lack of profits, et cetera. So I don't think the worst is over for necessarily these companies, but if we can close over 4,400, probably going to see a lot more green as we proceed higher in the coming days, guys.
All right, thank you, Jared Blickery there. All right, stay with us as we count down to the closing bell.
Welcome back to Yahoo Finance Live. I'm Emily McCormick here with Brad Smith and Rochelle Akufo. We want to get one final check of the markets before the closing bell as a rally is underway on Wall Street. We have all three major stock indexes solidly in positive territory. The Dow Jones Industrial Average up more than 600 points, or about 1.8%. The S&P 500 up about 1.9%, and the NASDAQ up about 1.7%. And here's the bell.
All right, there's the closing bell there. As we take a look at how things settled, I want to bring in our panel, Jamie Cox, Harris Financial Group Managing Partner, and Matt McCall, Stansberry Research Senior Technology Analyst. So as we saw there, quite the turnaround, seeing all three major indices ending in the green today. We're seeing the Dow up 1.79% today, the S&P up 1.86%, and the NASDAQ ending up 1.62%. So a strong day all around. Jamie, I want to first start with you. You were talking about looking past the carnage when it comes to software stocks. What are you keeping an eye on there, and why are you so bullish on them?
Well, you know, these particular companies have very durable revenue streams and growth prospects. I mean, the absolute carnage that you've seen in software stocks like ServiceNow and Shopify, these things actually come around every so often, probably almost once a year in the case of some of them. And we see corrections of these stocks all the time that see them drop 20+%, only to return, you know, back to high profitability, 18 months later. So if you get opportunities like this, you should be paying close attention to ServiceNow, Okta, Zscaler, And inside of software, you should be paying particular attention to the cybersecurity stocks, because when you see all the things that are going on with Russia, these companies are going to be sought after to try to help people thwart these attacks. They're going to be even higher revenue that they're going to receive over the next couple of months, or next couple of quarters. So in my view, these are the types of companies that you don't get very many opportunities to buy at these levels. So if you are looking for places to find opportunity, these are perfect spots to find it.
And Matt, in terms of some of these long-term buying opportunities, what are you looking at, given what we historically see after some of these geopolitical situations calm down and the market comes back up?
Well, Jamie makes a great point. Software stocks have been beaten up. Tech in general. I mean, the Nasdaq just a few days ago, about 47% of all Nasdaq stocks were down at least 50%. So just to get back where they are, that's 100% gain. That's a double. So I think there's a lot of opportunity right now in the tech stocks, and a lot of people focus on what the Nasdaq's doing, the big indices. But underneath the hood, a lot of stocks have been really beaten down. And yeah, they were a little ahead of themselves prior, but these geopolitical concerns wrapped in with inflation, higher interest rates, I believe that it's all been priced into a lot of these growth and innovation stocks. And regardless of geopolitical concerns or who's in office or inflation, innovation is going to win out over time. So I think these are a great opportunity right now. Within crisis often comes great opportunities to buy into quality companies. Short term, you don't know what's going to happen from day to day with the news headlines. But if you're looking long term, which most investors are, I think you start looking at the sweet spot and start picking up shares down here.
At what point does, Matt, buying on the dip start to fizzle out, especially if you have people who are setting those long positions and said, okay, I bought on the last dip. I'm set for my long-term horizon. Where do you then continue to see even more rotation perhaps within their portfolio?
That's a great question, because you look back and just as of late, you see we had a dip obviously in early 2020 with the COVID. Late 2018, we had a big dip in the markets, nearly going into a bear market. And if you look at any big winner over 5, 10 years or plus, most stocks are going to have pullbacks of 20+% several times, as Jamie alluded to, as software stocks. So to me, you have to kind of realize you're going to have to weather the ups and downs. To me, as long as the reason I bought that stock for the long term doesn't change, the business model doesn't change, the trend's still going, you have to just realize you have to weather that. And most people usually have powder on the sidelines that they can use that for the next dip that happens in stocks that they're looking to enter.
And so, Jamie, bringing you back into this, and I'm so glad you bring up the cloud names, because I've been tracking a few of them over the course of this year. I think this 30% plus move lower that we've been watching in Salesforce as well, which we just got fresh data from yesterday also. And so with all of that in mind, there is still within the technology landscape the rising interest rate environment that many of them were reactionary to even prior to this week, or even prior to the international conflict. And so how much longer do you anticipate they will be reactionary to, even if Fed Chair Jerome Powell is signaling that he's going to support 25 basis point hike? How much further do you believe that they will continue to be kind of in this toss-up scenario and perhaps just find themselves in their own malaise until the Fed clearly signals how many interest rate hikes it will be and the depth of those hikes?
Yeah, you hit the nail on the head. I mean, you've seen since November, the Fed say that it's going to delay interest rates and stay on its current path relative to the dot plot. And then a mere month later in December and in January, you hear the complete opposite. Oh my goodness, we're going to have to raise rates quickly. And so markets have really had a difficult time digesting exactly what the rate path will be. And that's basically ground zero for these high growth names. If you start raising interest rates really quickly, you start to see rotations out of them into value stocks. That's exactly what you saw. So as we went through January and in the middle of February, where 50 basis points on liftoff was sort of becoming the consensus, forecast for March, you started to see these names really get beaten down. But, I think Chair Powell basically wrapped the ribbon around it today and said, we're not going 50 in March. In fact, we're going to go 25 at most and then go slow, because we have heightened uncertainty with two things. The first is we have the Russia-Ukraine conflict that has an undefined duration. We don't know how that's going to play out with a lot of the unintended consequences of the sanctions and things like that. In addition, let's not forget, last night at the State of the Union, there were no masks. COVID is basically just sort of washing off. And so you're seeing what could potentially be the peak of inflation, and the Fed may not need to go as quickly. So if you are, if you anticipate that there's a big transition from goods to services, which are likely to happen, if the COVID restrictions reduce the friction of travel and things like that, you're going to see the rate environment may not need to be as accelerated as what people think. And if that's the case, it's even further credence to our argument that these stocks are beaten up too much, and that most of the interest rate path, the rate path of increase, the rate of change is probably priced into these stocks relative to that. So that's kind of where I think most investors should be paying close attention, that the Fed is basically wavering on some of its harsh language it had back in the early part of February, and maybe taking a little bit different view, maybe looking at balance sheet reduction versus, Fed fund rate, increases as its way to taper down inflation, which may be in the process of topping right now.
And Matt, I want to pose that question of the Fed to you as well, given what we heard from Fed Chair Jerome Powell earlier today. What do you expect the Fed to telegraph in a couple of weeks in terms of how many interest rate hikes may be on the table for this year?
Well, I think they're going to say it's data dependent, and within that data will be geopolitical conflicts, in my opinion. So it's really going to be a meeting to meeting decision, I think, is what they're going to say. But that being said, I think we're probably going to have 25 basis points for the next 4 or 5 meetings. And I think that's priced in. And Jimmy made a good point. I think we priced in probably the worst case scenario of 25 and maybe even potentially some 50 basis point rate hikes throughout this year and in early 2023. And I don't see that happening. I think it's going to be slower than most people anticipate. And the growth stocks, again, have priced in the worst case scenario. Then you add what's going on in Ukraine on top of it. I think we're seeing generational opportunities in some of these stocks that are down 50 to 60%. And, speaking of COVID, I've been in Florida for the last 2 years, recently moved here. You wouldn't even know COVID existed here. I can't tell you the last time I put a mask on. And if this is indicative of what the rest of the country and the world's going to be like, things are going to be picking up very, very quickly. And I like a lot of the service companies out there. Some of the fitness facilities that are opening up and booming, you can't get in right now because there's so many people. So I think you're going to see a boom to the economy. And keep in mind, corporate profits are projected to be an all-time high this year. And again, stock prices short term move up and down. Long term, they will follow profits. And that's why I think we'll have new all-time highs in the next 6 to 12 months.
All right, Jamie Cox, Harris Financial Group Managing Partner, and Matt McCall, Sainsbury Research Senior Technology Analyst. Thank you both so much for joining us here after the closing bell with some insights going forward from here. Also, switching gears here, everyone, Ford announcing the initiation of new internal business units, Ford Model E, dedicated to electric vehicle business, Ford Blue, dedicated towards its internal combustion engine business. We spoke with the CFO of Ford, and he joins us to discuss. Take a look.
The next phase in our Ford Plus plan and accelerating the Ford Plus plan. And we feel now is the time to create these different divisions. We're going to create the electric vehicle division as well as the internal combustion engine division so that our teams can have incredible focus on driving what's unique for each of those businesses and creating really exciting, outstanding products for our customers. And as we've been developing our Ford Plus plan, and as we've been moving the business forward, we think this focus and clarity for each of these teams is going to take us to the next level.
And specifically, when you think about the production, you're targeting annual production of more than 2 million electric vehicles by 2026. How do these moves today help make Ford even more competitive in the electric vehicle landscape against some of the other players like a GM here in the US and even like a Tesla that has had the head start largely on this space?
Yeah, as you said, 2 million EVs by 2026. Overall, the company is going to move to a 10% adjusted EBIT margin in 2026. And we should see margins on our electric vehicles in that time frame in 2026 greater than 8%. So, it's really about accelerating and being a first mover in this space. The focus of our EV team that we're creating, they're going to have the spirit of a startup. They're going to be focused. They're going to have the speed of a startup. They're going to look at breaking constraints. And they're going to look at creating the most incredible EV vehicles at scale. And when you think about at scale, you have to think about the strengths we have in Ford Motor Company. We have an incredible team that understands how to create those body engineering and the structures and the chassis that many of the EV startups would love to have, and then manufacturing at scale. So when you combine the capabilities of Ford Blue Now you can combine the capabilities of what we're experts at from an engineering standpoint, and with the spirit of a startup and a clean sheet of paper for our EV vehicles. You take those two things together, we think we have a winning combination, and that's going to allow us to beat not only the EV startups, but some of the traditional OEMs as well.
This announcement, it comes after the Ford Plus plan was unveiled last May. What's the biggest difference that you hope to drive in the customer experience?
Well, the customer experience for our EV vehicles, that is progressing, and it's about simplicity. It's about the ease of the purchase process. But we're also thinking about the next phase of that, right? So after they purchase the vehicle and how it's much easier from a customer standpoint there, what happens to them in ownership? And we'll have a great partnership with our dealers. They'll have dealers that they can go to if they have a fender bender or if they need parts that have worn out to be replaced. And one of the things we've noticed is that the Net Promoter Score, the way consumers feel, how positive they are about their vehicle, are really strong at the start for the new EV companies, but they taper off over time. And we think this new customer experience that we're creating is going to allow us to have that really strong customer experience at the start. But then with the benefit of having our dealer network and with our dealer partners, that Net Promoter Score will continue to be strong as they own the vehicle over time. So we think we've got a really good combination here and a way to satisfy our customers, not only at the start, but over time as well as they own the vehicle.
The creation of Ford Model E, as you put it in today's announcement, it was informed by the success of small mission-driven Ford teams that developed the Ford GT, Mustang Mach-E SUV, the F-150 Lightning pickup, as well as Ford's dedicated EV division in China. I'm wondering, considering the customer experience that you were mentioning a moment ago, what type of delta have you seen in average selling price with the electrification of some of the brand's most well-known models?
Well, I think what we're finding is the demand for these vehicles, the Mach-E, the Lightning, and even our electric transit van has been much greater than what we had anticipated, and we're attracting new customers to Ford. 70% of those customers are new to the brand. And so we see this as a growth opportunity, and that's why we're excited about the 2 million vehicles in 2026 and the growth potential for that. And that's why we're doing this, creating great products for our consumers, providing them the types of products that they're demanding, and growing our business.
You expect EVs to represent half of your global volume by 2030. You also received a specific mention during the State of the Union address by President Biden. Is there a percentage of the financial forecasts that you calculate to be annexed to anticipated government spending on EV supportive measures and infrastructure?
Now, we're looking at this as our business, and if those measures come down the road, that'll be a benefit for us. But we're not planning our business assuming that that's going to happen. We're going to build this business out. We're going to create great products. We're going to create value for our shareholders, and that's what we're focused on. If anything comes down and from those means, that'll be great. It'll be good for our business, but we're not planning on it at this point.
Certainly, and investors are going to be paying close attention to some of those public sector moves as well. Where has the company found some flexibility in navigating costs through supply chain challenges, both in chips or even in raw materials?
So we are seeing headwinds from a raw material standpoint. We saw them last year. We're seeing them again this year. The geopolitical issues are exacerbating that. And so that's just something that we're going to have to deal with and manage as a company. And that's another reason why we think this move is really beneficial for us, because when you look at our Ford Blue business, we're talking about a lean operation. We're talking about significant structural cost reductions, simplifying that business, and driving value to our shareholders through higher margins and lower costs. And so as we see some of those headwinds hit us, we're going to have to offset those, and we're focused on doing that. And that's part of what we're announcing today, significantly leaner business from in our ICE vehicles on Ford Blue.
Leaner business, cost reductions. To clarify, and perhaps for my own edification as well, do you anticipate that there will be any headcount reduction as a result of this restructuring?
Well, everything's on the table. We're going to look at every element of the income statement, and there'll be some skill changes that we'll need in new skills coming into the company for our Ford Model E team. And there'll be some skills that we'll be phasing out over time at Ford Blue. So everything's on the table. We're looking at it very closely. We'll work closely with our employees. And it's really about getting the right skills, having the right skills in the right place so that we can have the most effective and efficient company that we can, not only in Model E, but also in Ford Blue.
And that was our conversation with the Chief Financial Officer of Ford, John Lawler, earlier today. And coming up on the other side of this short break, everyone, we discuss the state of small business here in the U.S. with the U.S. Small Business Administrator on the other side.
Welcome back to Yahoo Finance Live. I'm Rochelle Akufo here. Now, as we know, about a third of small businesses were battered by the pandemic, but how are they faring now? We heard President Biden talking about them in his most recent State of the Union address. I'd like to bring in Danny Romero, Yahoo Finance's own, to tell us more about that.
Thank you. President Joe Biden delivered his State of the Union address yesterday amid a war in Ukraine that has inflamed global tensions and added to increased inflationary pressures on the economy. So small business owners were among the audience as many of them continue to recover from the pandemic. And to join us more on this discussion, we have the Small Business Administrator, Isabella Guzman. Thank you so much for joining us.
Pleasure to be here. Thanks for having me.
So in regards to the President's State of the Union address, what is your response? Do you believe that the administration really addressed the current concerns that small businesses owners are really up against?
From an overarching perspective, I think the president's plan and his hope for the future is strong and resonates with small business from the perspective of they want to seek those opportunities into the future and see more competition and opportunities for them to plug in to the global economy. And I think investing in America and believing that with those investments we can spur the economy further. I think that's what that's what small businesses are all about, is taking action to continue to deliver for their communities as well as the economy. I mean, we know how strong their contributions continue to be, as the president outlined. The economy has grown tremendously, and that includes around entrepreneurship. And we saw 5.4 million business applications last year, and that means more Americans are taking that leap into the American dream of business ownership. And the SBA is here as part of the president's plan to make sure that businesses have the capital and the resources and the connections to be able to leverage those opportunities.
And I wanted to play a clip from yesterday's address for you. We're going to play it right now.
Under my administration, the watchdogs are back. And we're going to go after the criminals who stole billions of relief money meant for small business and millions of Americans. And tonight, I'm announcing that the Justice Department will soon name a chief prosecutor for pandemic fraud.
And Isabella, what is your response to that? Is it too late?
The SBA continues to collaborate with the Inspector General of the SBA, as well as through the Department of Justice, to continue to prosecute fraud that was perpetrated as part of PPP. And the president's stance is firm and strong that we want to make sure that those funds got into the hands of the businesses that it was intended to serve. And so we're always completely cooperative and collaborative to make sure that those efforts continue.
And realistically, how much stolen money can be recovered now that so much time has passed and the Department of Justice is understaffed and has a lot on their plate?
The efforts have been ongoing throughout, and with the Inspector General collaborating internally with SBA and our data and our teams, we continue to uncover challenges uncover some of the the perpetrators, and so they will continue to pursue them. And so I think that's something that's ongoing, and I don't think it's too late to continue to investigate and explore those cases of fraud.
I wanted to shift gears a little bit on the Russia-Ukraine crisis. There's a lot of discussion around the global impacts on food. What are you hearing from small business owners on what they're anticipating on that front? And how is the SBA helping them navigate that as well?
I mean, I think throughout the pandemic, the global pandemic, our supply chains have been impacted, and small businesses have had to adapt, sometimes changing their whole business models to make sure that they could survive and continue to serve their customers and succeed in the marketplace. And so, the SBA has, of course, throughout this pandemic, provided over $1 trillion in relief to small businesses to help them survive this time as we continue to administer and deploy the final funding around the COVID economic injury disaster loan, as well as pivot to some of our core programs in capital loans to small businesses, as well as technical assistance. We're just here to advise them and help them, make sure that they can be agile and take what the marketplace challenges are and be able to strategically overcome.
And Administrator, just to wrap this all up, Fed Chairman Jerome Powell told Congress today that the Fed plans to raise interest rates. How would the Fed's rate hikes affect SBA or other government-backed loans?
The SBA is affordable capital for our small businesses. If anything, we need to continue to try to fortify our programs and make sure that we have strong lending networks that we can distribute our loans to and better meet businesses where they are with products that fit their needs. And, with simple processes and strong technology, which is how businesses are expecting for us to serve them these days, alongside some of the relief programs we've been able to administer. So, if anything, we just need to make sure that the SBA stands ready to support them with affordable capital to continue to help them leverage those opportunities like those in the bipartisan infrastructure law, where there are contract opportunities for our small businesses to participate in, or through the president's plan around making more in America. We know small businesses make the products and services that we depend on every day along our main streets and along our manufacturing centers. So we want to make sure that all of those businesses are positioned with capital to succeed and affordable capital.
And thank you so much again for joining us with this discussion. That was the Small Business Administrator, Isabella Guzman. And I'm going to toss it back to my colleague, Rochelle.
All right, thank you very much. Yahoo Finance's own Danny Romero there. All right, stay with us. On the other side of this break, what's been happening with some big earnings that came out after the bell? That's next. Welcome back to Yahoo Finance Live. A number of big companies reporting after the bell. We start with Okta. And so let's bring in our very own Jared Blickery to break that down for us.
That's right. Stock heading south right now, but it's not based on the headline numbers. Let's check out the adjusted loss per share of 18 cents. Now that's versus a loss per share expected by Wall Street of 24 cents, so narrower than expected. Revenue also beating $383.0 million. That's up 63% year over year. Estimate was for a bit lower, $359.7 million. And that breaks down into subscription revenues, $369.3 million, up 64% year over year. And billings, $603.2 million. That's up at 91% year over year. Now, the operating margin came in at negative 6%. I do not have a comp for that, but adjusted gross margin beating slightly, 77%. The estimate was for slightly lower at 76.7%. Now, their first quarter forecast, they're seeing revenue of $388 to $390 million, and that bests the estimate of $375.8 million. They're seeing adjusted loss per share of 34 to 35 cents, and the estimate is for a loss per share of 20 cents. So I think that's where the disappointment is coming from. Now, their full year forecast, they're seeing adjusted loss per share at $1.24 to $1.27. The estimate was for less than half of that, 46 cents, so another disappointment there. But for their full year revenue outlook, they're looking at $1.78 to $1.79 billion, and that does best the $1.75 estimate, $1.575 billion estimate. Now, this is what the stock has done over the last 3 months. A lot of software stocks have not performed that well. You can see it's down 17%. Now, taking a look over the last 2 years, did get an initial pandemic rise from the work from home trade, but now just falling off. Still up 36% over that time period. Now, we want to turn to Snowflake. This is where the real carnage is, down 30%. And let me just scroll to these results right now, excuse me. Fourth quarter results, Snowflake, fourth quarter loss per share of 43 cents. The estimate was for a profit of 2.6 cents, so a lot of disappointment there. Revenue, $383.8 million versus, $372 million expected. So that is a beat. And that breaks down into product revenue of $359.6 million versus $178.3 million. Nice beat there. Or the estimate was for $348.7 million, so that is a beat of about $10 million. And then also breaking down into professional services and other revenue, $24.2 million. The estimate was for just a little bit lower, $23.7 million. Now, adjusted operating margin is where things get really nasty here. That came in at 5% versus estimates of 67.1%. Adjusted gross margin of 71% versus a little bit lower than that, 70.8%. Now, their full year forecast, let's see, they're saying 2023 product revenue of $1.88 to $1.90 billion. That does beat the estimate of $1.89 billion, or actually the median just matches that. And they're also seeing full year 23 adjusted operating margin of only 1%. So it's that operating margin probably due to increased costs. We've seen this, a lot of companies having to retool, increase their capital expenditures. I think we're going to hear a lot about that on the call. Also, they have an announcement to make with regard to an acquisition, and that is a company called Streamlit, and they're saying this will allow them to empower developers and data scientists to mobilize the world's data. Bloomberg has 20 buys on the stock, 10 holds and 0 sells. Now let's take a look at what Snowflake has done since its IPO. Let's go to a max chart here, and we can see two spikes of interest, and you can see this has been a very volatile, nevertheless sideways trading stock. And since its first day of trading, it is now up a whopping 4.24%. So lots of disappointment here. We've seen this with other earnings this earnings season, especially with regard to Facebook and many others. And we'll just add this one to the list, Snowflake.
A tough afternoon here for both of these software stocks, Snowflake and Okta, after these results. Yahoo Finance's own Jared Blickery, thank you so much for that breakdown. With volatility hitting the broader stock market, Masterworks is making it easier for everyday investors to add fine art to their portfolios. We'll have a discussion with the CIO of Masterworks on the other side of this break.
Welcome back to Yahoo Finance. As investors seek out safe havens over uncertainty over Ukraine and Fed rate hikes, art often serves as a hedge against inflation. To help us explore ways to invest in times of volatility, I'm joined by Alan Sokolitsky, Masterworks Chief Investment Officer. Thank you for joining me today. So let's start with inflation then. What are some of the ways that you're seeing that affecting your industry and your portfolio?
Sure. So, the challenge for investors when it comes to inflation is that inflation ultimately can erode the value of an investor's portfolio. And so what we did is we went back in time and we did an analysis on how the art market performed from 1973 to 1981, when inflation in the US was running at around 9% on average each year. What we found, interestingly, is that the art market actually outpaced gold. And the reason I say that is because gold is often thought of as a popular tool for a portfolio when there's inflation. But as it turned out, art actually outperformed even gold, had very attractive performance during that period of time.
So this might be, welcome news for a lot of investors then. So with this approach that you take in fractional investment in art, how do you see people using this as a way to grow wealth? If you're a new investor to this space, how should you approach investing in art?
Sure. So we have a website that a lot of our self-directed investors go to. It's masterworks.io. We now have more than 350,000 registered users on our platform. So what they do is they sign up, and we schedule a membership interview with them. And basically, our membership team talks to our investors what their portfolios look like, what their goals are, their time horizons. We really do kind of a thorough check on each investor to make sure that art investing is appropriate for them. And then from there, we can go ahead and build the appropriate portfolio with the different paintings that we have on offer on the platform.
Then as you look at the selection of art that you do have on there, then what sort of returns are customers seeing in this space?
So the returns have been quite attractive. The paintings that we put on platform, they have historical appreciation rates that are typically, call it 10 to 30% historically for similar paintings. And so those are basically the returns that investors have been achieving. Now, if you even take a look at our platform as a whole across all the different offerings, the track record looks overall at around 15.8%. So it's really a way to say that the performance of all these different paintings has been very broad-based. Investors are seeing attractive performance.
Now, I want to get your opinion on what we're seeing with NFTs, because obviously we're seeing art and NFTs combining now. There's a lot of buzz, but investors are still quite divided on its worth and the potential for a lot of scams as well. What are your thoughts about investing in NFTs and how that affects the traditional art investment market?
Sure. So in a lot of ways, we think they can go hand in hand, call it NFTs and more traditional art investing. They are, at the end of the day, quite different from each other in some regards. So what we focus on at the moment at Masterworks is bringing blue chip artworks, real tangible works of art to the investment community for investment. NFTs, of course, are more digitally oriented than kind of an artwork that you can actually hold and touch and look at in front of you. But our business is always up for evolving. I mean, who knows? Maybe one day down the line, we'll consider the NFT market as part of it. But at the moment, we are primarily focused on real, tangible works of art that we bring to the platform.
So then, beyond just art, then what other opportunities do you see for retail investors versus some of these larger institutional investors who might be interested in this space?
Well, a lot of what we're doing is actually bringing similar opportunities to retail investors as well as the broader investor community. So the retail platform, I mentioned this earlier, we have more than 350,000 users now. We've had that for that business for several years now. We actually also recently launched what we're calling a diversified art portfolio that is catered for financial advisors and the institutional investor community. That portfolio is anticipated to hold, call it 60 to 80 works of art. It's intended to give diversified exposure to the art market for those specific channels. So at the end of the day, if you think about what Masterworks is doing overall, it's really just trying to bring art investment to the entire investor community. We started on the retail side, and now we're expanding our distribution channels.
And as we take it back to inflation, which is obviously still weighing on the markets amid everything else, we did hear Fed Chair Jerome Powell supporting a 25 basis point interest rate hike this month, while also being open to a more aggressive approach if inflation doesn't cool fast enough. With markets responding positively to that, how do you adjust your portfolio for the potential for more rate hikes this year?
So it's the thing with Jay Powell is that he's in a little bit of a challenging situation. And the reason why is because on the one hand, he should be raising rates if you're just focused on the inflation outlook. But on the other hand, we're in an economic growth environment that's been slowing for the last several months. We also have the unemployment rate, which is basically bottomed at this point in time, which means from here on, it might only be rising. So Powell has to be increasing rates at a time when the growth environment and the unemployment rate are not exactly the most favorable. Is it necessarily the best time to fully reallocate your portfolio? Usually when it's a volatile environment, you don't want to make drastic changes to your portfolio. But what we would suggest for consideration is adding some allocation to alternative investments. Art, as we've been discussing, is one type of alternative investment. We think it's one that can help manage risk in a portfolio and ultimately generate attractive appreciation over time.
Well, certainly one to watch. We do appreciate your insights. Alan Sokolitsky there, Masterworks Chief Investment Officer. Thank you for your time this afternoon.
Thank you very much.
The locks may be on the MLB ballparks for the foreseeable future, but how can the NFT partnerships the league has struck maintain their fanfare during the downtime? We've got more on that next.
Welcome back to Yahoo Finance Live. Major League Baseball's official NFT partner, Candy Digital, has its sights set on expanding within and beyond the sports industry. Here to discuss the latest on its MLB partnership and future plans for the NFT platform is Scott Lowen, CEO of Candy Digital. Yahoo Finance's own producer and sports reporter, Josh Schaefer, is joining us as well. Scott, thanks for your time this afternoon. I want to ask about your platform, but first, I do want to ask about what's been happening with MLB canceling the start of its upcoming regular season after the league and players union Association failed to come to a new collective bargaining agreement. Given your partnership with MLB, how does this impact Candy Digital and your work with the league?
Well, first of all, thanks for having me on. I guess I would say both from a business perspective and from a fan perspective, we're disappointed. First and foremost, we love the game. We're fans ourselves. We're collectors, and so we're really excited to have the league and the Players Association come together and work things out. As we think about fandom and what Candy is focused on doing, we're really looking to connect baseball fans and fans in general to the sport, to the players, to the teams they love in a new way. And so obviously we're excited for games to start. Some of our products are based on capturing those important moments for the games, but a lot of our products are really around celebrating the players and celebrating the teams. And so, we're ready to go to market to offer fans the next generation of baseball collectibles. We hope that the season starts up at the same time that we're ready to meet fans where they're at.
And Scott, given the fact that when we look at where both sides are at here, the lockout could potentially last even longer than the first two series that are canceled. How are you guys evaluating that as a business? And is there a point where it does become very detrimental for you if you say they miss, the whole month of April or April and May?
Yeah, I think for us, the timing is important in terms of as it relates to people's engagement with the sport following, what's happening with their favorite players or their favorite teams. But the world of collectibles also exists outside of the normal league schedule. And so if you think about the traditional world of sports collectibles, whether that's trading cards or whether that's sports memorabilia, fans are always looking for ways to express their fandom, connect with their community, and sort of tell their story as a fan. We're doing that through digital means. The products that Candy has partnered with Major League Baseball and the Players Association are kind of the next generation of those collectibles. And so, again, everyone's excited about, both sides coming together and the season starting. We feel very confident that we'll be able to bring products to market even ahead of the season starting that get fans excited.
How critical are these official partnerships like the one that Candy Digital has with MLB to the success of an NFT collectibles platform? And are you seeing that this is creating competition for exclusive partnerships and licensing agreements that generate a lot of upfront costs potentially for you in the near term?
We think official partnerships are key to our long-term success and certainly key to our focus. We have Fanatics as our majority investor and one of our core JV partners. And that business came together really around the philosophy that NFTs as a marketplace are still very early in their development and adoption. Obviously, the crypto community really came together around the NFT market. You saw huge volumes last year. You saw lots of new products, lots of new companies. But for the everyday sports fan, which is who Candy is focused on, one of the key things here is around authenticity and official items. There's a lot of confusion in the marketplace. It's hard to set up a digital wallet. Folks may be less comfortable with cryptocurrency. And so our approach to the marketplace is to make it really easy for fans to discover a digital asset, to purchase a digital asset with their credit card, and then sort of extend their fandom into this new world. What's really important there is that people feel very comfortable that they're purchasing authentic products and working with a partner that's an official licensee of both Major League Baseball and the Players Association.
And Scott, you mentioned the relationship with Fanatics. How did they sort of help maybe bring utility to the NFTs? And how does that relationship work with maybe a physical product that you could provide while also providing the digital product via the NFT?
Yeah, we're in a really unique position partnering with Fanatics on a couple of different levels. First of all, Fanatics is the largest e-commerce retailer in the sports space. We believe that for NFTs to become more pervasive across the fan communities, that we want to offer digital-only assets, digital physical combinations, and digital experiential. And so certainly, and we proved this out or started this process in the fall of last year, marrying up a digital asset, an NFT, along with the physical purchase of a piece of sports memorabilia. Our first product in that area was a partnership around the Atlanta Braves World Series championship. Folks who bought Atlanta Braves memorabilia were able to get a free NFT along with those purchases. And so sort of bringing the Fanatics customers and the Candy customers together in that space. And then obviously from a relationship perspective, Fanatics has deep relationships across all of the major leagues around the world and individual teams and players. And so finding those opportunities to create interesting experiences that we can embed in those NFTs, whether that's an experience with a particular player, whether that's an experience at a ballpark or an arena, those are the things that we think are going to add real value and utility to the NFT collectibles as this market continues to grow.
And Scott, you guys are doing some NFTs ahead of March Madness as well. How has that been as far as getting into the NIL space? I know some NFT companies we've talked to in the past working with NIL and NCAA athletes is a little bit different because they don't always have the licensing for the team logos and the jerseys and things like that. What's that experience been like? And are you guys going to be able to have NFTs that have official jerseys and players in them?
Yeah, we were really excited last year with the changes in the NIL laws to be able to bring to the market the very first project focused on college student athletes, giving them their opportunity to create their rookie card in a digital format. We kicked off our Sweet Futures product line in the fall of last year with 22 of the leading college football players. And as you have up on the screen there, we'll launch on Monday our second release under Sweet Futures, which is going to focus on 8 of the top college basketball players. The NIL landscape has evolved very quickly. I think a lot of folks were sort of surprised when the laws changed last year. We've developed great relationships with the individual athletes, and as part of that process, also been working closely with the universities. We think ultimately we want to create products that are the most meaningful to fans. And so if you're a fan of Memphis or a fan of Nebraska or Notre Dame, and you have an opportunity to purchase an NFT of one of your favorite players, we'd love to find the opportunity to not just have the player's name, image, and likeness, but also to use the school marks. Because it's a new space, I'd say the universities are still sort of figuring out how they want to work through that process. And so in some cases, we'll be able to include those, and in a few cases, we'll just be working directly with the athletes.
Are most of the buyers of Candy Digital NFTs buying these? Are you seeing for the collectible aspect of it, or are they seeing this as a long-term investment with appreciation potential?
I think first and foremost, this is about a digital collectible that extends that fan journey. We think about collectibles as, again, sort of telling that story of yourself as a fan, connecting to the stories of the athletes and the teams that you love, and connecting to your community. There's no question in sports collectibles, whether it's trading cards or memorabilia, some of those cards or signed jerseys or game gear from years back have become very valuable over time. So I think anyone who's a collector, probably thinks a little bit about that. But first and foremost, this is really about connecting fans to teams, athletes, and sports.
All right, we'll leave it there. Scott Lowen, CEO of Candy Digital, and Yahoo Finance's own Josh Schaefer. Thank you both so much. Much more on Yahoo Finance Live after this short break. Stick with us. Welcome back to Yahoo Finance Live. Before we say goodbye, we want to give you a quick rundown of what you should be watching in markets tomorrow. And guys, I'm keeping an eye on some jobs data. Now, we got the ADP private payrolls report out earlier today. That did come in much better than expected. Those private sector payrolls rising by 475,000 versus the 375,000 expected. We also saw a big upward revision to private payrolls in January. And for tomorrow, we will be getting the latest weekly jobless claims data out from the Labor Department, expected to show a slight improvement here for the week ended February 26, with those coming in, expected to come in at 225,000 versus 232,000 during the week prior. And Brad, what are you watching?
Going to be watching the Fed Chair Jerome Powell, particularly as he is going to be testifying before the semi-annual monetary policy reports to the Congress. That is the title of the particular event that's going to be taking place. And it's actually taking place before the Committee on Banking, Housing, and Urban Affairs for the U.S. Senate. And so with all of what Fed Chair Jerome Powell said today in mind, with him supporting a 25 basis point rate hike at the next meeting, and markets very clearly latching on to that. We'll see what more indication the Fed may signal vis-a-vis Fed Chair Jerome Powell in his commentary tomorrow ahead in front of the U.S. Senate, too.
Well, certainly a lot to keep an eye on there. Well, that'll do it for us. I'm Rochelle Akufo, along with Brad Smith and Emily McCormick. Don't forget, Yahoo Finance Live will be back at 9 a.m. Eastern tomorrow. Before we go, though, just a quick check of how markets ended the day. All green across the board. That market volatility calming somewhat after Fed Chair Jerome Powell indicating that a 25 basis point rate hike is on the horizon for March, timing in some of that volatility that we've seen the markets pricing that in there. That'll do it for us for now, but do stay with us and we'll be back tomorrow.